Insurance. A contractual agreement in which one party, the insurer, agrees to compensate another party, the insured, for specified losses, damages, or liabilities in exchange for payment of a premium. Insurance provides financial protection against uncertain future events by transferring risk from an individual or organization to an insurance company. Premium. The amount of money an individual or business pays to an insurance company in exchange for insurance coverage. Premiums are typically paid on a regular schedule, such as monthly, quarterly, or annually, and must be paid in full and on time for the policy to remain active. The premium amount is determined by factors including the type and amount of coverage, the level of risk being insured, the deductible selected, and the policyholder's claims history. Deductible. The specific dollar amount that the insured must pay out of pocket toward a covered loss before the insurance company begins to pay its portion of the claim. Deductibles can be structured per occurrence, per policy period, or as an aggregate amount. Generally, policies with higher deductibles have lower premiums because the insured is assuming more of the financial risk. Coverage. The scope of protection provided by an insurance policy, including the types of losses, damages, or liabilities for which the insurer will provide compensation. Coverage defines what is protected, under what circumstances, and up to what monetary limits. The specific coverage provided is detailed in the policy document and may include both inclusions and exclusions. Policy. The written contract between the insured and the insurer that outlines the terms, conditions, coverages, exclusions, and limits of the insurance agreement. The policy document serves as legal evidence of the insurance contract and contains all the rights and obligations of both parties. It typically includes the declarations page, ensuring agreement, conditions, and exclusions. Insured. The person, business, or entity that is protected under an insurance policy and has the right to receive benefits or compensation for covered losses. The insured is the party whose risk is being transferred to the insurance company in exchange for premium payments, also referred to as the policyholder when they are the same party. Insurer. The insurance company or organization that provides insurance coverage and assumes the financial risk of paying for covered losses in exchange for receiving premiums. The insurer is responsible for evaluating risks, issuing policies, collecting premiums, and paying valid claims according to the terms of the insurance contract. Claim. A formal request made by the insured to the insurance company seeking payment or compensation for a covered loss, damage, or liability that has occurred. The claim process involves notifying the insurer of the loss, providing documentation and evidence, and working with the insurer to determine coverage and settlement amount. Beneficiary. The person or entity designated to receive the benefits or proceeds from an insurance policy when a covered event occurs. In property and casualty insurance, the beneficiary is typically the insured party, or another party with an insurable interest, such as a mortgage lender. The beneficiary has the right to receive payment, but may not necessarily be the same party that pays the premiums. Loss. The financial harm, damage, or injury suffered by the insured that may be covered under an insurance policy. A loss is the triggering event that gives rise to a potential insurance claim and represents the reason insurance coverage exists. Losses can include physical damage to property, bodily injury, legal liability, or other specified events covered by the policy. Risk. The possibility or likelihood of a loss or adverse event occurring. In insurance, risk represents the uncertainty of loss that is being transferred from the insured to the insurer. Insurance companies evaluate and price risk based on the probability and potential severity of losses. Liability. Legal responsibility for causing harm, injury, or damage to another person or their property. Liability insurance protects the insured against financial loss resulting from being held legally responsible for injuries or damages caused to others. The insured may be liable due to negligence, contractual obligations, or other legal duties. Policyholder. The person or entity that owns an insurance policy and is responsible for paying the premiums. The policyholder has the legal rights under the policy, including the ability to make changes, cancel coverage, or file claims. While often the same as the insured, these can be different parties in some circumstances. Peril. A specific cause of loss or damage, such as fire, theft, windstorm, or collision. Perils are the actual events or circumstances that result in a loss. Insurance policies may cover specific named perils or provide broader coverage against all perils except those specifically excluded. Renewal. The continuation of an insurance policy for an additional policy period beyond the original expiration date. At renewal, the insurer may adjust premiums, modify coverage terms, or change policy conditions based on loss experience, changing risk factors, or market conditions. The policyholder typically has the option to accept the renewal terms or seek coverage elsewhere. Cancellation. The termination of an insurance policy before its scheduled expiration date, which can be initiated by either the insured or the insurer. Cancellation may occur for reasons such as non-payment of premiums, misrepresentation, increased risk, or at the request of the policyholder. The terms and conditions for cancellation are specified in the policy and may be regulated by state law. Hazard. A condition or circumstance that increases the likelihood or potential severity of a loss. Hazards can be physical, such as faulty wiring, moral, such as dishonesty, or morale, such as carelessness. Unlike a peril, which is the actual cause of loss, a hazard makes the occurrence or impact of a peril more likely. Effective date. The date on which insurance coverage begins under a policy. This is the starting point from which the insurer's obligation to cover losses commences and is clearly stated in the policy documents. Coverage is not in effect for losses that occur before the effective date, even if a policy has been applied for or purchased. Expiration date. The date on which insurance coverage ends under a policy. After the expiration date, the insurer is no longer obligated to cover losses unless the policy is renewed or extended. The expiration date marks the end of the policy period for which premiums have been paid. Policy period. The length of time for which an insurance policy provides coverage, running from the effective date to the expiration date. Most insurance policies have a policy period of 6 months or 1 year, though other durations are possible. All terms, conditions, and premium rates apply for the entire policy period. Binder. A temporary insurance contract that provides proof of coverage until a formal policy is issued. A binder is legally binding and offers the same protection as a permanent policy for the specified period, typically 30 to 90 days. Binders are commonly used when coverage needs to begin immediately, such as at a real estate closing. Quote, an estimate of the premium cost for requested insurance coverage based on information provided by the applicant. A quote is not a guarantee of coverage or final price, but gives the prospective insured an approximate cost to help them make purchasing decisions. The actual premium may differ once the insurer completes a full underwriting review. Application. The formal written request submitted by a prospective insured to an insurance company seeking coverage. The application contains information about the risk to be insured, including details about the applicant, the property or exposure to be covered, and the desired coverage limits. Information provided in the application is used by the insurer to evaluate the risk and determine whether to offer coverage. Insurable interest. A legitimate financial stake in the preservation of the insured property or person, such that the policyholder would suffer a financial loss if damage or harm occurred. Insurable interest must exist at the time of loss for property insurance and at the time the policy is purchased for liability insurance. This requirement prevents insurance from being used as a wagering contract. Named insured. The person or entity specifically identified by name in the insurance policy's declarations page as the primary insured party. The named insured has all rights and responsibilities under the policy, including the authority to make changes, cancel coverage, and receive policy documents. Additional parties may also be covered, but the named insured holds the primary contractual relationship with the insurer. Declarations page. The section of an insurance policy that provides a summary of the key policy information, including the named insured, policy period, coverage limits, deductibles, premium amounts, and covered property or locations. Also known as the DEC page, this document serves as a quick reference and proof of coverage. It is typically the first page or pages of the policy. Insuring agreement. The section of an insurance policy where the insurer makes its basic promise to pay for covered losses. The insuring agreement describes what the insurer will do in exchange for the premium, outlining the general scope of coverage provided. It forms the foundation of the insurance contract and specifies the insurer's obligations. Exclusion. A provision in an insurance policy that eliminates coverage for specified perils, losses, properties, or situations. Exclusions define what is not covered under the policy and help insurers manage risk by removing exposures that are uninsurable, covered by other policies, or subject to specialized coverage. Common exclusions include intentional acts, war, and certain natural disasters. Condition. A provision in an insurance policy that outlines the duties, rights, and obligations of both the insured and the insurer. Conditions specify what both parties must do to maintain coverage and receive benefits, such as requirements to report claims promptly, cooperate with investigations, or maintain the insured property. Failure to comply with policy conditions may result in denial of coverage. Endorsement. A written amendment or addition to an insurance policy that modifies the original terms, conditions, or coverage. An endorsement can add or remove coverage, change policy limits, update information, or clarify policy language. Also called a rider, an endorsement becomes part of the policy contract once attached. Limit. The maximum amount an insurance company will pay for a covered loss under a policy. Limits can be expressed per occurrence, per person, per policy period, or as aggregate amounts. The insured is responsible for any portion of a loss that exceeds the policy limits. Higher limits typically result in higher premiums. Occurrence. A single event or continuous exposure to conditions that results in injury or damage. In insurance, an occurrence is used to determine how coverage applies and limits are calculated. Multiple injuries or damages arising from the same event or repeated exposure to the same general conditions are typically treated as one occurrence. Proof of insurance. Documentation that demonstrates an individual or business has active insurance coverage. Proof of insurance typically includes the policy number, coverage dates, limits, and insurer information. Common forms include insurance cards, certificates of insurance, or declarations pages, which may be required by lenders, landlords, or regulatory authorities. Certificate of insurance. A document issued by an insurer or agent that provides summary information about an insurance policy, including the types of coverage, policy limits, policy number, and effective dates. Certificates are commonly used to provide proof of insurance to third parties such as clients, vendors, or property owners, but they do not alter or extend the coverage provided by the actual policy. Premium payment. The act of paying the required premium amount to the insurance company to activate or maintain coverage. Premium payments must be made according to the schedule specified in the policy, whether in full at inception or in installments. Late or missed premium payments can result in policy cancellation or lapse of coverage. Lapse. The termination of insurance coverage due to non-payment of premiums or failure to renew the policy. When a policy lapses, coverage ends, and the insured loses protection against losses. Depending on the insurer and circumstances, some lapsed policies may be reinstated if the insured pays overdue premiums and meets other requirements. Reinstatement. The restoration of a lapsed or canceled insurance policy to active status. Reinstatement typically requires payment of all overdue premiums and may involve a new application or underwriting review. The insurer may impose conditions or waiting periods, and not all lapsed policies are eligible for reinstatement. Grace period. A specified amount of time after a premium due date during which the insured can make a late payment without losing coverage or facing cancellation. During the grace period, the policy remains in force and covers losses that occur. Grace periods typically range from 10 to 31 days, depending on the type of insurance and state regulations. Pro rata. A method of calculating premiums or refunds based on the actual time period coverage was in effect. When a policy is canceled mid-term, a pro rata calculation returns the portion of premium corresponding to the unused coverage period. This proportional approach ensures the insured only pays for the time they had coverage. Short rate. A penalty method of calculating premium refunds when a policy is canceled by the insured before the expiration date. The short rate refund is less than the pro rata amount, with the difference retained by the insurer as a cancellation fee to cover administrative costs. This discourages mid-term cancellations initiated by policyholders. Earned premium. The portion of the total premium that corresponds to the coverage period that has already elapsed. As time passes during the policy period, the insurer earns the premium by providing coverage. Earned premium represents the insurer's revenue for insurance protection already provided. Unearned premium. The portion of the premium that corresponds to the coverage period that has not yet elapsed. If a policy is canceled before expiration, the unearned premium represents the amount that may be refunded to the policyholder, either on a pro rata or short rate basis. First-party coverage. Insurance that pays the policyholder directly for their own losses or damages to their own property. First-party coverage protects the insured's own interests, such as coverage for damage to the insured's vehicle or property. The claim is made by the insured against their own insurance company. Third-party coverage. Insurance that protects the policyholder against claims made by other people for injuries or damages the insured caused. Third-party coverage, such as liability insurance, pays others whom the insured has harmed rather than paying the policyholder directly. The third party is someone other than the insured and the insurer. Covered loss. A loss, damage, or injury that meets all the requirements for payment under an insurance policy. For a loss to be covered, it must result from a covered peril, occur during the policy period, not fall under any exclusions, and meet all policy conditions. Only covered losses trigger the insurer's obligation to pay. Uncovered loss. A loss, damage, or injury that does not qualify for payment under an insurance policy. Losses may be uncovered because they result from excluded perils, occur outside the policy period, involve excluded property, exceed policy limits, or fail to meet policy conditions. The insured bears full financial responsibility for uncovered losses. Property insurance. Insurance that protects against financial loss resulting from damage to or loss of physical property. Property insurance covers buildings, personal possessions, equipment, inventory, and other tangible assets against perils such as fire, theft, vandalism, and weather events. This broad category includes homeowners, renters, and commercial property insurance. Casualty insurance. Insurance that protects against legal liability for injuries or damages caused to other people or their property. Casualty insurance covers the insured's legal responsibility when they are found at fault for causing harm. This category primarily includes various forms of liability insurance and is often combined with property insurance in property and casualty (P&C) policies. Property and casualty insurance (P&C). A broad category of insurance that encompasses both property insurance, covering damage to physical assets, and casualty insurance, covering legal liability. P&C insurance includes most types of general insurance such as homeowners, auto, commercial, and liability policies, but excludes life and health insurance. Direct loss. The immediate physical damage to property caused by a covered peril. Direct loss is the primary damage that occurs as a direct result of the insured event, such as fire damage to a building or theft of belongings. This contrasts with indirect or consequential losses that occur as a secondary result. Indirect loss, a loss that results as a consequence of direct physical damage rather than from the covered peril itself. Indirect losses include things like lost income from business interruption, additional living expenses after a home is damaged, or loss of use. These consequential losses may require separate or additional coverage beyond standard property insurance. Total loss. A situation where property is damaged so severely that the cost to repair it equals or exceeds its actual value, or where the property is completely destroyed. When a total loss occurs, the insurer typically pays the full insured value of the property, subject to policy limits, rather than paying for repairs. The damaged property may then become the property of the insurer through salvage rights. Partial loss. A situation where property is damaged but not destroyed, and the cost to repair is less than the property's total value. In a partial loss, the insurer pays for the cost to repair or restore the damaged portion of the property according to the policy terms. The insured retains ownership of the property throughout the repair process. Actual loss. The real, measurable financial harm suffered by the insured as a result of a covered event. Actual loss represents the true economic impact of the damage or injury and forms the basis for the claim settlement. The concept of actual loss prevents the insured from profiting from insurance and upholds the principle of indemnification. Notice of loss. The formal notification provided by the insured to the insurance company that a loss has occurred and a claim will be filed. Prompt notice of loss is typically a policy condition that requires the insured to inform the insurer within a reasonable time or specified period after discovering the loss. This notification triggers the claims investigation process. Loss date. The specific date on which a covered loss, damage, or injury occurred. The loss date is critical for determining whether coverage applies, as the loss must occur during the policy period. It also affects statute of limitations deadlines and serves as the starting point for claims reporting requirements. Date of loss. An alternative term for loss date, referring to the specific calendar date when the insured event occurred. For occurrences that span multiple days, such as ongoing water damage, determining the date of loss may require investigation to establish when the damage actually began or when it should reasonably have been discovered. Insured event. Any occurrence, condition, or circumstance covered under an insurance policy that triggers the insurer's obligation to provide benefits or pay a claim. The insured event must meet all the criteria specified in the policy, including being caused by a covered peril, happening during the policy period, and not falling under exclusions. Material fact. A piece of information that would influence an insurance company's decision to provide coverage or determine the premium amount. Material facts must be disclosed truthfully in the insurance application, and failure to disclose or misrepresentation of material facts can void coverage. Examples include prior losses, existing damage, or occupancy changes. Misrepresentation. A false statement or concealment of material facts made by an applicant or insured when applying for or maintaining insurance coverage. Intentional misrepresentation can be grounds for policy cancellation or claim denial, as the insurer relied on inaccurate information when agreeing to provide coverage. Even unintentional misrepresentation of material facts may affect coverage. Good faith. The principle that both the insured and insurer will act honestly, fairly, and with integrity in their dealings with each other. Both parties are expected to fulfill their contractual obligations in good faith, which includes the insured providing truthful information and the insurer fairly evaluating and paying valid claims. Violation of good faith obligations can result in legal consequences. Utmost good faith. A heightened standard of honesty and disclosure required in insurance contracts, obligating both parties to act with complete transparency and fairness. Under this doctrine, the insured must voluntarily disclose all material facts, even if not specifically asked, and the insurer must deal fairly with the insured. Insurance contracts are considered contracts of utmost good faith due to their reliance on trust and disclosure. Contract of adhesion. An insurance policy prepared entirely by the insurer where the applicant's only option is to accept or reject the terms as written. Since the insured has no ability to negotiate the contract language, courts typically interpret any ambiguities in favor of the insured. This principle protects consumers from unclear or unfavorable terms in standardized insurance contracts. Aleatory contract. A contract where the exchange of value between parties is unequal and depends on an uncertain event. Insurance policies are aleatory contracts because the insured pays a relatively small premium but may receive a much larger payment if a covered loss occurs, or may receive nothing if no loss happens. The outcome depends on chance. Unilateral contract. A contract where only one party, the insurer, makes a legally enforceable promise. In insurance, the insurer promises to pay covered losses if they occur, but the insured is not legally required to continue paying premiums. They simply lose coverage if they stop. Only the insurer's promise can be legally enforced. Conditional contract. A contract where the insurer's obligation to perform, pay claims, depends on the insured meeting certain conditions. Insurance policies are conditional because the insurer will only pay if the insured has fulfilled their duties, such as paying premiums, providing timely notice of loss, and cooperating with investigations. Failure to meet conditions can void coverage. Personal contract. A contract based on the personal characteristics and circumstances of the individual insured rather than being automatically transferable with property. Insurance policies are personal contracts issued to specific individuals or entities based on their unique risk profile. Generally, policies cannot be transferred to another party without the insurer's consent. Valued policy. An insurance policy that pays a predetermined, agreed-upon amount in the event of a total loss, regardless of the actual cash value at the time of loss. The insured and insurer agree on the value when the policy is issued, and this amount is paid if the covered property is totally destroyed. This contrasts with policies that determine payment based on actual loss at the time of the claim. Indemnity. The principle that insurance is designed to restore the insured to their financial position immediately before a loss occurred, without allowing them to profit from the loss. Indemnification means making the insured whole by compensating for actual losses suffered, up to policy limits. This fundamental insurance principle prevents insurance from being used as a means of financial gain. Face amount. The death benefit amount stated in a life insurance policy that will be paid to the beneficiary upon the insured's death. The face amount is the primary coverage provided by the policy and is shown on the policy's face page or declarations. This amount may be level throughout the policy term or may increase or decrease based on the policy type and provisions. Death benefit. The amount of money paid by a life insurance policy to the designated beneficiary upon the death of the insured. The death benefit is typically equal to the face amount of the policy, but may be increased by riders or reduced by policy loans or unpaid premiums. It provides financial protection to survivors. Cash value. The savings or investment component that accumulates in certain types of life insurance policies, such as whole life or universal life. Cash value grows over time based on premium payments and interest or investment returns. The policyholder can borrow against, withdraw, or surrender the policy for its cash value. Surrender value. The amount of money the policyholder receives if they cancel or surrender a permanent life insurance policy before death or maturity. Surrender value equals the cash value minus any surrender charges or policy loans. It represents the liquidation value of the policy. Rider. An optional add-on or amendment to an insurance policy that provides additional benefits or modifies coverage beyond the base policy. Riders allow customization of coverage for specific needs and typically require additional premium. Common riders include accidental death benefit, waiver of premium, and critical illness coverage. Waiver of premium. A policy rider or provision that waives premium payments if the insured becomes totally disabled and unable to work. The waiver keeps the policy in force without requiring premium payments during the disability period. This prevents policy lapse due to inability to pay premiums while disabled. Pre-existing condition. A health condition, illness, or injury that existed before an individual applied for or became covered under a health insurance policy. Pre-existing conditions may be subject to waiting periods, exclusions, or coverage limitations depending on the policy type and applicable laws. Federal law prohibits pre-existing condition exclusions in most health insurance. Waiting period. A specified time period after coverage begins during which certain benefits are not payable or certain conditions are not covered. Waiting periods may apply to pre-existing conditions, specific treatments, or entire categories of coverage. They are designed to prevent adverse selection and claims for conditions existing before coverage started. Open enrollment. A designated period during which individuals can enroll in or make changes to health insurance coverage without needing a qualifying life event. Open enrollment typically occurs annually for employer-sponsored plans and marketplace plans. Missing open enrollment generally means waiting until the next period unless a qualifying event occurs. Qualifying life event. A significant life change that allows an individual to enroll in or modify health insurance coverage outside the standard open enrollment period. Qualifying events include marriage, divorce, birth or adoption of a child, loss of other coverage, or change in residence. Special enrollment periods follow these events. Dependent. A person who relies on another for financial support and who may be covered under that person's insurance policy. Dependents commonly include spouses, children, and sometimes other family members. Insurance policies specify eligibility requirements for dependent coverage. Primary beneficiary. The person or entity first in line to receive benefits from an insurance policy when the insured event occurs. Primary beneficiaries receive the full benefit unless they predecease the insured or disclaim the benefit. Multiple primary beneficiaries can share benefits in specified percentages. Contingent beneficiary. A person or entity designated to receive insurance benefits if the primary beneficiary is unable to receive them due to death or other reasons. Contingent beneficiaries serve as backups, ensuring benefits are distributed according to the insured's wishes. They are also called secondary beneficiaries. Irrevocable beneficiary. A beneficiary designation that cannot be changed without the beneficiary's consent. Irrevocable beneficiaries have vested rights in the policy and must agree to any changes in beneficiary designation, policy loans, or surrenders. This designation is less common than revocable beneficiary status. Revocable beneficiary. A beneficiary designation that the policyholder can change at any time without the beneficiary's knowledge or consent. Revocable beneficiaries have no vested rights until the insured's death. This is the most common form of beneficiary designation. Contestability period. A specified time period, typically 2 years from policy issue, during which an insurer can investigate and potentially void a life insurance policy due to material misrepresentation in the application. After the contestability period expires, the insurer generally cannot contest the policy except for non-payment of premiums. This protects policyholders from indefinite scrutiny. Incontestability clause. A policy provision stating that after a specified period, usually 2 years, the insurer cannot void the policy or deny claims based on misstatements in the application except for fraud or non-payment of premiums. The incontestability clause provides security to policyholders that their coverage cannot be challenged indefinitely. Suicide clause. A life insurance policy provision that excludes or limits coverage for death by suicide during a specified period, typically the first 2 years of the policy. If the insured dies by suicide during this period, the policy may only return premiums paid rather than paying the death benefit. After the exclusion period, suicide is covered like any other cause of death. Health Maintenance Organization, HMO. A type of health insurance plan that requires members to receive care from a network of providers and typically requires selection of a primary care physician who coordinates care and provides referrals to specialists. HMOs generally offer lower premiums and out-of-pocket costs, but less provider flexibility. Care outside the network is usually not covered except in emergencies. Preferred Provider Organization, PPO. A type of health insurance plan offering a network of preferred providers with lower cost sharing, but also allowing members to see out-of-network providers at higher cost. PPOs provide more flexibility than HMOs and don't require referrals for specialists. Members pay less when using in-network providers. Primary Care Physician, PCP. A doctor who serves as the main point of contact for a patient's healthcare needs and coordinates overall care. In HMO plans, members must select a PCP who provides routine care and referrals to specialists. The PCP manages preventive care, treats common conditions, and coordinates with other healthcare providers. Referral. Authorization from a primary care physician for a patient to see a specialist or receive specific services. Referrals are typically required in HMO plans before seeing specialists. Without a proper referral, the plan may not cover the specialist visit. Network. The group of healthcare providers, hospitals, and facilities that have contracted with a health insurance plan to provide services at negotiated rates. Using in-network providers typically results in lower out-of-pocket costs for members. Network adequacy ensures access to necessary care. In-network. Healthcare providers, facilities, or pharmacies that have contracted with an insurance plan to provide services at pre-negotiated rates. Using in-network providers results in lower cost sharing and better coverage. Benefits are maximized when members stay in-network. Out-of-network. Healthcare providers or facilities that have not contracted with an insurance plan. Using out-of-network providers typically results in higher cost sharing, and some plans may not cover out-of-network care at all except in emergencies. Members pay significantly more when going out of network. Explanation of Benefits, EOB. A statement sent by an insurance company to a policyholder explaining what medical services were covered, what the provider charged, what the insurer paid, and what the patient owes. EOBs are not bills, but help members understand how their benefits were applied. They detail deductibles, copayments, and coinsurance. Coordination of Benefits, COB. The process used when a person has coverage under more than one health insurance plan to determine which plan pays first and how much each plan pays. COB prevents duplicate payment for the same service and ensures total benefits don't exceed 100% of the cost. Rules determine primary and secondary coverage. Primary coverage. The insurance plan that pays first when a person has multiple insurance policies covering the same loss or service. Primary coverage processes claims before any secondary coverage is applied. Determining which plan is primary follows specific COB rules. Secondary coverage. Insurance that pays after primary coverage has been applied when a person has multiple policies. Secondary coverage may pay some or all of the remaining balance after primary insurance pays. It fills gaps left by primary coverage up to the total allowable amount. Birthday rule. A coordination of benefits rule used to determine which parent's health insurance is primary when a child is covered under both parents' plans. The plan of the parent whose birthday falls earlier in the calendar year is primary. This rule simplifies determining primary coverage for dependent children. Prescription drug coverage. Insurance that pays for medications prescribed by a physician. Prescription drug coverage may be part of a health insurance plan or offered as separate coverage. Coverage typically includes formularies, tiered copayments, and requirements like prior authorization for certain drugs. Formulary. A list of prescription drugs covered by a health insurance plan, often organized into tiers with different cost-sharing levels. Formularies encourage use of preferred medications and generic drugs. Plans may require step therapy or prior authorization for non-formulary drugs. Generic drug. A medication that contains the same active ingredients as a brand-name drug but is sold under its chemical name after the brand name patent expires. Generic drugs are therapeutically equivalent to brand name versions but cost significantly less. Insurance plans encourage generic use through lower copayments. Brand name drug. A medication sold under a trademarked name by the company that developed and patented it. Brand name drugs are typically more expensive than generic equivalents. Insurance plans charge higher copayments for brand name drugs when generics are available. Prior authorization. A requirement that a healthcare provider obtain approval from an insurance company before performing certain services, procedures, or prescribing specific medications for coverage to apply. Prior authorization helps control costs and ensures medical necessity. Services provided without required authorization may not be covered. Medical necessity. The requirement that healthcare services, treatments, or procedures be appropriate, necessary for diagnosis or treatment of a condition, and consistent with accepted standards of medical practice. Insurance plans only cover medically necessary care. Services deemed not medically necessary are denied. Preventive care. Healthcare services designed to prevent illness or detect disease early, such as annual physicals, vaccinations, and screenings. Preventive care is typically covered at 100% without cost sharing under most health plans. It promotes wellness and early intervention. Wellness program. Initiatives offered by health insurers or employers to promote healthy behaviors and prevent disease through screenings, education, fitness activities, and incentives. Wellness programs may offer premium discounts, reduced cost sharing, or rewards for participation. They aim to improve health and reduce costs. Premium tax credit. A federal tax credit that helps eligible individuals and families afford health insurance purchased through the health insurance marketplace. Premium tax credits are based on income and household size and can be applied monthly to reduce premium payments. They make coverage more affordable for qualifying individuals. Cost sharing reduction, CSR. Financial assistance that reduces out-of-pocket costs for deductibles, copayments, and coinsurance for eligible individuals purchasing silver-level marketplace plans. CSRS are based on income and make healthcare more affordable by lowering cost sharing. They apply only to silver-tier plans. Lifetime maximum. A cap on the total amount an insurance policy will pay in benefits over the life of the insured. Lifetime maximums were common in health insurance before being prohibited by the Affordable Care Act for essential health benefits. Some policies still have lifetime maximums for specific benefits. Annual maximum. The total amount an insurance policy will pay in benefits during a policy year. Annual maximums cap the insurer's obligation for the year. The Affordable Care Act prohibits annual limits on essential health benefits in most health plans. Elimination period. The waiting period in disability or long-term care insurance between when a condition begins and when benefits start being paid. Elimination periods function like deductibles, measured in time rather than dollars. Common elimination periods range from 30 to 180 days. Benefit period. The maximum length of time for which benefits will be paid under a policy, commonly used in disability insurance and long-term care insurance. Benefit periods may range from months to years or even lifetime. Longer benefit periods cost more but provide more comprehensive protection. Pre-certification. The process of obtaining approval from an insurance company before receiving certain healthcare services to confirm they are covered. Pre-certification verifies medical necessity and coverage eligibility before care is provided. It is similar to prior authorization and helps prevent claim denials. Utilization review. The evaluation of the necessity, appropriateness, and efficiency of healthcare services, procedures, and facilities. Utilization review helps insurance companies manage costs and ensure quality care. It may occur before, during, or after care is provided. Case management. A collaborative process involving assessment, planning, coordination, and advocacy for healthcare services to meet an individual's needs, especially for complex or chronic conditions. Case managers work with patients, providers, and insurers to optimize care and outcomes. They help navigate the healthcare system. Disease management. programs designed to help individuals manage chronic conditions like diabetes, asthma, or heart disease through education, monitoring, and coordinated care. Disease management aims to improve health outcomes and reduce complications and costs. Participants receive guidance and support for their specific conditions. Policy form: the standardized document template that establishes the basic framework and language of an insurance policy. Policy forms are often developed by organizations like the Insurance Services Office, ISO, or created by individual insurance companies. The form contains the standard insuring agreement, conditions, exclusions, and definitions that apply to a particular type of coverage. Manuscript policy: a customized insurance policy written specifically for a particular insured rather than using standardized policy forms. Manuscript policies are typically used for unique or complex risks that cannot be adequately covered by standard forms. The policy language is drafted to address the specific needs and exposures of the individual insured. Standard policy: an insurance policy that uses widely accepted, uniform policy language and forms, often developed by industry organizations. Standard policies provide consistency across the insurance industry and are easier for regulators to review and approve. Most personal and small commercial insurance uses standard policy forms. Policy jacket: the physical or digital folder that contains all the components of an insurance policy, including the declarations page, policy forms, endorsements, and any other attached documents. The policy jacket holds together all elements that comprise the complete insurance contract. It typically includes the cover page with basic identifying information. Coverage part: a section of an insurance policy that provides a specific type of coverage. In commercial insurance packages, different coverage parts address different exposures, such as general liability, property, or crime. Each coverage part contains its own insuring agreement, conditions, exclusions, and definitions specific to that type of coverage. Section: a major division within an insurance policy that addresses a distinct aspect of coverage or policy terms. Policies are often organized into sections such as coverage, conditions, exclusions, and definitions. Each section groups related provisions together for clarity and ease of reference. Coverage section: the portion of an insurance policy that details what perils, losses, and damages are covered and under what circumstances. The coverage section includes the insuring agreement and specifies the scope of protection provided. It defines what the insurer promises to pay for and any sublimits or special provisions that apply to specific coverages. Conditions section: the part of an insurance policy that outlines the duties, responsibilities, and obligations of both the insured and the insurer. The conditions section specifies what actions must be taken to maintain coverage and make valid claims, such as requirements for notification, cooperation, and documentation. Failure to comply with these conditions can result in denial of coverage. Exclusions section: the portion of an insurance policy that explicitly lists what is not covered under the policy. The exclusions section removes certain perils, property, persons, locations, or circumstances from coverage. Exclusions help define the boundaries of coverage and manage the insurer's exposure to certain types of risk. Definitions section: the part of an insurance policy that provides specific meanings for key terms used throughout the policy. Defined terms typically appear in quotation marks, bold, or italics when used in the policy. The definitions section ensures clarity and consistency in interpretation by establishing precise meanings that may differ from common usage. Insuring agreement section: the core section of an insurance policy where the insurer states its promise to provide coverage. The insuring agreement describes what the insurer will cover, under what circumstances, and the basis for determining payment. This section forms the foundation of the insurance contract and establishes the insurer's primary obligations. Policy schedule: a component of the insurance policy that lists specific information about the insured, covered property, locations, or other details relevant to the coverage. The schedule provides itemized information such as covered buildings with their addresses and values, or listed equipment with descriptions and limits. The policy schedule customizes the coverage to the specific insured's situation. Schedule of forms and endorsements. A listing within the policy that identifies all the forms and endorsements that are attached to and comprise the complete policy. This schedule provides a table of contents showing each component by form number, edition date, and title. It helps ensure that all intended coverage modifications are properly included in the policy. Named perils. A policy structure where coverage is provided only for specific perils explicitly listed in the policy. If a loss is caused by a peril not named in the policy, no coverage exists. Named perils policies provide narrower coverage than open perils policies, but are typically less expensive. Open perils. A policy structure that provides coverage for all causes of loss except those specifically excluded. Also known as all-risk coverage, open perils policies offer broader protection than named perils policies. The burden is on the insurer to prove a loss falls under an exclusion, rather than on the insured to prove it falls under a covered peril. All-risk coverage. An alternative term for open perils coverage, indicating that all causes of loss are covered unless specifically excluded. Despite the name, all-risk does not mean absolutely everything is covered, as exclusions still apply. This terminology is less commonly used today in favor of open perils to avoid misunderstanding. Specified perils. Another term for named perils, referring to coverage that applies only to explicitly listed causes of loss. Specified perils policies enumerate each covered peril such as fire, lightning, windstorm, hail, explosion, and theft. Any peril not specifically listed is automatically excluded from coverage. Basic form. A type of insurance policy that provides coverage for a limited number of named perils, typically the most common causes of loss. Basic forms offer the narrowest scope of coverage and are usually the least expensive option. They cover fundamental perils like fire, lightning, explosion, windstorm, and hail. Broad form. A type of insurance policy that provides coverage for a wider range of named perils than a basic form, but not as comprehensive as an open perils policy. Broad form policies include additional covered perils beyond those in basic forms, such as falling objects, weight of ice or snow, and water damage from certain sources. They represent a middle ground in coverage breadth and cost. Special form. A type of insurance policy that typically provides open perils coverage for buildings or structures and named perils coverage for contents. Special forms offer broader protection for real property while maintaining more limited coverage for personal property. This hybrid approach balances comprehensive coverage with reasonable premiums. Coverage form. The specific insurance document that establishes what is covered under a particular type of insurance. Coverage forms are standardized documents that can be attached to policies to provide various types of protection, such as building coverage, business personal property coverage, or liability coverage. Different coverage forms can be combined to create a complete insurance program. ISO form. A standardized insurance policy form developed by the Insurance Services Office, an organization that creates and maintains standard policy language for the insurance industry. ISO forms provide consistency across insurers and states and are regularly updated to reflect legal and market changes. Most property and casualty insurers use ISO forms or adapt them for their own use. Proprietary form. An insurance policy form developed and owned by a specific insurance company rather than using industry-standard forms. Proprietary forms allow insurers to differentiate their products, customize coverage, and potentially offer unique features. These forms must still comply with regulatory requirements, but can vary significantly from standard forms. A mandatory endorsement. An endorsement that makes changes to the standard policy language to comply with specific state laws or regulations. Mandatory endorsements ensure that policies meet the legal requirements of the state where the risk is located. These endorsements typically override conflicting provisions in the base policy to bring it into compliance. Modifying endorsement. An endorsement that alters, adds to, or removes coverage from the base policy. Modifying endorsements can broaden or restrict coverage, change limits, adjust deductibles, or add specific conditions. They customize the policy to meet the insured's particular needs or address unique exposures. Broadening endorsement. An endorsement that expands coverage beyond what is provided in the standard policy. Broadening endorsements add perils, increase limits, reduce exclusions, or otherwise enhance protection. These endorsements typically increase the policy premium due to the additional coverage provided. Restrictive endorsement. An endorsement that reduces or limits coverage provided in the base policy. Restrictive endorsements may add exclusions, reduce limits, or impose additional conditions. These endorsements are often used to manage specific risks or reduce premium costs. Scheduled endorsement. An endorsement that lists specific items of property individually with their corresponding values and coverage limits. Scheduled endorsements are commonly used for high-value items like jewelry, fine arts, or specialized equipment that need coverage beyond standard policy limits. Each listed item receives its own specified amount of insurance. Blanket endorsement. An endorsement that provides a single combined limit of coverage for multiple items, locations, or categories of property, rather than specifying individual limits for each. Blanket coverage offers flexibility by allowing the full limit to be applied to any covered property, regardless of location or distribution. This approach simplifies coverage and eliminates the risk of being underinsured at any one location. Common policy conditions. A set of provisions that apply to all coverage parts in a commercial insurance package policy. Common policy conditions address items such as cancellation, changes to the policy, examination of books and records, and inspections. These conditions apply universally across the entire policy rather than to individual coverage sections. Coverage conditions, provisions specific to a particular coverage part that outline duties and requirements related to that specific type of coverage. Coverage conditions apply only within their respective coverage part and address matters directly related to that coverage, such as claim procedures, valuation methods, or loss settlement options specific to that type of insurance. Policy definitions. Terms given specific meanings within an insurance policy that may differ from their common usage. Policy definitions establish precisely what words and phrases mean when interpreting the policy, ensuring consistent application of terms throughout the document. Defined terms are typically indicated by quotation marks, bold text, or italics. Defined term. A word or phrase that is given a specific meaning in the policy's definitions section. When a defined term appears in the policy, it carries the exact meaning specified in the definitions rather than its ordinary dictionary definition. Recognizing and understanding defined terms is essential for proper policy interpretation. Per occurrence limit. The maximum amount an insurer will pay for all losses, damages, or injuries arising from a single occurrence or event. This limit applies regardless of how many claims or claimants result from the same occurrence. Once the per occurrence limit is exhausted, the insured is responsible for any additional costs from that event. Aggregate limit. The maximum total amount an insurer will pay for all covered losses during the entire policy period, regardless of the number of occurrences. The aggregate limit represents the cumulative cap on the insurer's liability under the policy. Once the aggregate limit is reached, no additional coverage is available for the remainder of the policy period, even for new, separate occurrences. Per person limit. The maximum amount an insurer will pay for injuries or damages to any one individual in a covered occurrence. This limit applies separately to each injured person, but the per occurrence limit still caps the total payment for all persons injured in the same event. Per person limits are common in liability policies. Per accident limit. Another term for per occurrence limit, representing the maximum the insurer will pay for all damages arising from a single accident or event. This limit encompasses all injuries and damages to all parties resulting from one accident. It is distinguished from aggregate limits, which apply across multiple accidents during the policy period. Sublimit, a limit of coverage for a specific type of loss or peril that is lower than the overall policy limit. Sublimits restrict the amount available for certain categories of property, specified perils, or particular types of losses. For example, a policy might have a $500,000 overall limit but a $10,000 sublimit for jewelry theft. Special limit, a specific restriction on the amount of coverage available for certain types of property or causes of loss, similar to a sublimit. Special limits typically apply to categories of property that are particularly susceptible to loss or difficult to value, such as cash, securities, collectibles, or certain business property. These limits apply regardless of the total policy limit. Inside limit, a limit that applies to specific items or coverages within the broader policy limits. Inside limits are subordinate to and cannot exceed the overall policy limit, but they restrict coverage for particular categories. For instance, within a $300,000 contents coverage limit, there might be a $5,000 inside limit for silverware. Combined single limit, a single amount of coverage that applies to all damages from an occurrence, including both bodily injury and property damage combined. Rather than having separate limits for different types of damages, a combined single limit allows the full amount to be available for any combination of covered losses. This provides maximum flexibility in claim settlement. Split limits, a limit structure that specifies different maximum amounts for different types of coverage within the same policy. Split limits are commonly expressed as three numbers, such as 100/300/50, representing per person bodily injury, per occurrence bodily injury, and per occurrence property damage, respectively. This structure separates available coverage by category of loss. Policy limits, the maximum amounts an insurance company will pay under a policy for covered losses. Policy limits can be structured in various ways, including per occurrence, aggregate, per person, or for specific types of property or perils. The insured is responsible for any loss amount exceeding the applicable policy limits. Maximum limit, the highest amount of coverage available under a policy or for a particular type of loss. The maximum limit represents the cap on the insurer's financial obligation. This term may refer to per occurrence maximums, aggregate maximums, or the maximum available from the insurer for any single risk. Minimum limit, the lowest amount of coverage that can be purchased under a policy or that is required by law or contract. Some jurisdictions mandate minimum liability limits for certain types of insurance, such as auto insurance. Lenders or contract parties may also require minimum coverage amounts to protect their interests. Coinsurance clause, a policy provision that requires the insured to carry insurance equal to a specified percentage of the property's value to avoid a penalty at the time of loss. If the insured carries less than the required percentage, they become a co-insurer for the deficiency and will not be fully reimbursed for partial losses. The coinsurance clause encourages adequate insurance to value. Coinsurance penalty, the financial reduction in claim payment that occurs when an insured fails to maintain coverage equal to the percentage of value required by the coinsurance clause. The penalty is calculated by dividing the amount of insurance carried by the amount that should have been carried, then multiplying the resulting fraction by the loss amount. This results in a proportional reduction in the claim payment. Agreed value, a policy provision that suspends the coinsurance clause by establishing an agreed-upon value for the insured property. The insurer and insured agree on the property's value at policy inception, and the coinsurance penalty is waived as long as insurance equal to this agreed value is maintained. This eliminates disputes about property value and coinsurance compliance at the time of loss. Stated amount, a valuation method where the insured declares a specific value for property, but recovery is limited to the actual cash value or replacement cost at the time of loss, whichever is less. Unlike agreed value, stated amount does not establish a guaranteed settlement amount, but serves as the maximum the insurer will pay. The stated amount also satisfies coinsurance requirements in some policies. Inflation guard. A policy provision that automatically increases coverage limits periodically throughout the policy period to keep pace with inflation. Inflation guard adjusts the amount of insurance upward at specified intervals, typically quarterly, by a stated percentage. This feature helps prevent property from becoming underinsured due to rising construction costs or property values. Peak season endorsement. A policy provision that automatically increases coverage limits during specific times of the year when inventory or business values are typically higher. This endorsement recognizes that businesses may have seasonal fluctuations in property values, such as retailers before holidays. Coverage automatically increases during peak periods and decreases afterward without manual policy adjustments. Value reporting form. A policy provision requiring the insured to periodically report the current value of covered property to the insurer. The insurer adjusts premiums based on these reported values, and coverage limits may fluctuate accordingly. Value reporting is common for inventory and other property with significant value fluctuations, ensuring coverage stays aligned with actual values. Automatic increase. A policy feature that systematically raises coverage limits over time without requiring the insured to request changes. Automatic increases help maintain adequate coverage as property values rise due to inflation or appreciation. The premium adjusts correspondingly as limits increase. Coverage territory. The geographic area within which coverage applies under an insurance policy. The coverage territory defines where losses must occur or where liability must arise for the policy to respond. Most policies specify coverage territories such as the United States and its territories, Canada, or worldwide, depending on the type of insurance and insured's needs. Policy territory. Another term for coverage territory, indicating the geographical boundaries within which the insurance policy provides protection. Losses or liabilities occurring outside the policy territory are typically not covered unless specifically endorsed. The policy territory is clearly defined in the policy provisions. Named insured provision. The policy section that identifies who is specifically protected as a named insured under the policy. This provision establishes which individuals or entities have all the rights and responsibilities of the insurance contract, including the authority to make changes, cancel coverage, and receive claim payments. The named insured provision clarifies the primary party to the insurance contract. Additional insured provision. A policy section that extends coverage to parties other than the named insured. Additional insureds receive coverage under the policy, but typically have limited rights compared to named insureds and cannot make policy changes or cancel coverage. This provision is commonly added by endorsement to extend liability protection to landlords, contractors, or other parties with whom the named insured has a relationship. Insured's duties after loss. A policy condition that specifies actions the insured must take following a covered loss. These duties typically include promptly notifying the insurer, protecting property from further damage, preparing an inventory of damaged property, providing documentation, submitting to examinations under oath, and cooperating with the insurer's investigation. Failure to fulfill these duties may jeopardize coverage. Notice requirement. A policy condition requiring the insured to notify the insurer of a loss, occurrence, or potential claim within a specified time period or as soon as practicable. Notice requirements ensure the insurer learns of claims promptly, so investigation can begin while evidence is fresh. Late notice may result in claim denial if it prejudices the insurer's ability to investigate or defend. Cooperation clause. A policy condition requiring the insured to cooperate with the insurer during claim investigation, settlement negotiations, and legal proceedings. Cooperation includes providing information, attending hearings, assisting in securing witnesses, and helping the insurer defend against claims. Failure to cooperate can result in denial of coverage. No action clause. A policy provision preventing a third party from suing the insurance company directly until the insured's liability has been established through judgment or settlement. The no-action clause ensures that liability questions are resolved before the insurer becomes involved in litigation. This protects the insurer from being brought into lawsuits prematurely. Severability of interests. A policy provision stating that coverage applies separately to each insured as if a separate policy had been issued to each. This clause prevents one insured's actions or knowledge from affecting coverage for other insureds under the same policy. It ensures that exclusions applicable to one insured don't automatically apply to all insureds. Other insurance clause. A policy provision that explains how coverage applies when the insured has other insurance policies covering the same loss. The other insurance clause determines whether the policy will pay on a pro rata basis, excess basis, or primary basis when multiple policies respond to the same claim. This prevents duplicate payment and clarifies each insurer's responsibility. Primary coverage. Insurance that responds first to a covered loss before any other applicable insurance. Primary coverage pays claims up to its policy limits before excess or secondary insurance is triggered. When multiple policies apply, the primary policy bears the initial responsibility for losses. Excess coverage. Insurance that provides coverage above the limits of an underlying primary policy. Excess coverage only pays after the primary policy limits are exhausted. This additional layer of protection increases total available coverage for catastrophic losses while keeping primary coverage affordable. Pro rata liability, a method of sharing loss payment among multiple insurance policies covering the same risk. Each insurer pays a proportional share of the loss based on its policy limit relative to the total limits of all applicable policies. This approach distributes responsibility fairly among insurers when multiple policies apply. Contribution by equal shares, a method used when multiple insurance policies cover the same loss, where each insurer contributes equally until either the loss is paid in full or one insurer has paid its policy limit. After an insurer reaches its limit, remaining insurers continue sharing equally. This method differs from pro rata sharing based on policy limits. Escape clause, a provision in an insurance policy stating that the policy will not pay if other valid insurance is available for the same loss. The escape clause attempts to make the policy excess to any other coverage, essentially making it not apply when other insurance exists. Courts often do not enforce escape clauses when multiple policies contain them, instead requiring contribution among insurers. Apportionment clause, a provision that divides loss payment responsibility among multiple interests or policies according to a specified method. Apportionment clauses establish how coverage is distributed when multiple parties have insurable interests in the same property, or when multiple policies provide overlapping coverage. The clause defines the basis for dividing payment obligations. Loss payable clause, a provision designating a third party, such as a lender or lien holder, to receive claim payments for covered property losses. The loss payable clause protects the financial interest of parties who have a security interest in the insured property. The named loss payee receives payment, but does not have other policy rights, like the named insured. Lender's loss payable clause, a specific type of loss payable clause that protects a lender's or lien holder's interest in insured property. This clause ensures that the lender receives payment if the property securing their loan is damaged or destroyed. The lender's loss payable clause typically provides that the lender's rights cannot be invalidated by actions of the borrower. Mortgagee clause, a provision that protects the mortgage lender's financial interest in insured property by making the lender a party to the insurance contract. The standard mortgagee clause provides that the lender's rights cannot be invalidated by actions or negligence of the borrower/insured. If a claim is denied for the insured, the mortgagee may still have valid coverage for their interest. Standard mortgagee clause, a specific form of mortgagee clause that provides the strongest protection for lenders by creating a separate contract between the insurer and the mortgagee. Under this clause, the lender has rights independent of the borrower. meaning coverage for the lender's interest remains even if the borrower violates policy conditions. The lender can receive payment even when the insured's claim is denied. Waiver of subrogation, a policy provision or endorsement in which the insurer gives up its right to recover from a third party who caused a loss for which the insurer has paid. Waivers of subrogation are often required in contracts where parties agree not to sue each other. The waiver prevents the insurer from pursuing recovery after paying the insured's claim. Transfer of rights of recovery. A policy condition, also known as subrogation rights, that assigns to the insurer any rights the insured has to recover payment from responsible third parties. When the insurer pays a claim, they acquire the insured's right to pursue the party who caused the loss. This allows the insurer to seek reimbursement and prevents the insured from releasing liable parties without the insurer's consent. Assignment clause, a policy provision addressing whether and how the insured's rights under the policy can be transferred to another party. Most insurance policies prohibit assignment without the insurer's written consent because insurance is a personal contract based on the specific insured's risk characteristics. Assignment attempts to transfer policy ownership or benefits to someone else. Liberalization clause, a policy provision that automatically provides the benefit of any coverage, broadening changes the insurer makes to its standard forms during the policy period. If the insurer adopts broader coverage without additional premium, the liberalization clause extends that improvement to existing policies automatically. This ensures all insureds receive the benefit of mid-term coverage enhancements. Nuclear exclusion, a policy provision that eliminates coverage for losses caused by nuclear reaction, radiation, or radioactive contamination. The nuclear exclusion is nearly universal in property and casualty insurance due to the catastrophic potential of nuclear events. Nuclear risks are typically handled through specialized insurance pools or government programs. War exclusion, a policy provision that eliminates coverage for losses caused by war, invasion, rebellion, insurrection, or similar military actions. The war exclusion protects insurers from catastrophic losses due to armed conflicts that could threaten their solvency. War risks are generally uninsurable through commercial insurance markets. Governmental action exclusion, a policy provision that eliminates coverage for property destruction or seizure by governmental authority. This exclusion applies to actions like eminent domain, confiscation, or demolition ordered by government entities. It removes coverage for losses resulting from the exercise of governmental powers. Ordinance or law exclusion, a policy provision that eliminates coverage for losses caused by enforcement of building codes, ordinances, or laws. This exclusion removes coverage for costs to comply with current building codes when repairing or rebuilding after a loss, costs to demolish undamaged portions of buildings when required by law, and increased construction costs due to code requirements. Separate ordinance or law coverage can be purchased to fill this gap. Earth movement exclusion, a policy provision that eliminates coverage for losses caused by earthquakes, landslides, mudslides, sinkholes, or other earth movement. This exclusion is standard in most property policies, and earthquake coverage must typically be purchased separately. The exclusion protects insurers from catastrophic losses due to seismic events. Water exclusion, a policy provision that eliminates coverage for certain types of water damage, particularly flood, surface water, and water that backs up from sewers or drains. The water exclusion distinguishes between covered water damage, like burst pipes, and excluded water damage, like rising floodwaters. Flood insurance must be obtained separately through the National Flood Insurance Program or private insurers. Flood exclusion, a specific exclusion for damage caused by flood, typically defined as surface water, overflow of bodies of water, or mudflow. The flood exclusion is one of the most significant gaps in standard property insurance and requires separate flood insurance coverage. Flood is often defined broadly to include various water-related perils. Mold exclusion, a policy provision that eliminates or limits coverage for losses caused by, resulting from, or relating to mold, fungus, or bacteria. Mold exclusions became common after significant mold-related claims in the late 1990s and early 2000s. Limited mold coverage may be available through endorsement or as a sublimit in some policies. Intentional acts. Exclusion. A policy provision that eliminates coverage for losses caused by intentional or criminal acts of the insured. This exclusion prevents insureds from profiting from their own wrongdoing and upholds public policy against insuring intentional harm. Coverage applies only to accidents or occurrences, not deliberate acts. Expected or intended injury exclusion. A liability policy provision that eliminates coverage for bodily injury or property damage expected or intended by the insured. This exclusion removes coverage for harm that the insured meant to cause or knew was substantially certain to result from their actions. It distinguishes between accidental injuries, covered, and deliberate harm, not covered. Contractual liability exclusion. A provision in liability policies that eliminates coverage for liability the insured assumes under a contract or agreement. This exclusion removes coverage for liabilities that wouldn't exist except for the insured's contractual assumption of another party's liability. Limited contractual liability coverage is often provided back through exceptions to this exclusion. Professional services exclusion. A policy provision that eliminates coverage for liability arising from the rendering or failure to render professional services. This exclusion removes coverage for malpractice, errors, and omissions in professional work, which requires specialized professional liability insurance. The exclusion protects insurers from exposures requiring professional expertise to evaluate. Pollution exclusion. A policy provision that eliminates coverage for bodily injury or property damage arising from the discharge, dispersal, release, or escape of pollutants. The pollution exclusion removes coverage for environmental contamination and related cleanup costs. Pollution insurance must be purchased separately for businesses with environmental exposures. Employers' liability exclusion. A provision in liability policies that eliminates coverage for injuries to employees of the insured. This exclusion exists because employee injuries are covered under workers' compensation insurance, which provides statutory benefits regardless of fault. The exclusion prevents overlap between workers' compensation and commercial liability policies. Care, custody, or control exclusion. A liability policy provision that eliminates coverage for property damage to property in the insured's care, custody, or control. This exclusion prevents liability insurance from functioning as property insurance for items the insured is working on or responsible for. Damage to the insured's own property or property in their possession is not covered. Your work exclusion. A provision in liability policies that eliminates coverage for property damage to work performed by the insured. This exclusion prevents liability insurance from covering warranty-type claims for defective workmanship. The exclusion removes coverage for repairing or replacing the insured's own faulty work, though it may cover resulting damage to other property. Your product exclusion. A provision in liability policies that eliminates coverage for damage to products manufactured, sold, or distributed by the insured. This exclusion prevents product liability insurance from covering recall or replacement of defective products. Coverage applies to damage caused by the product to other property or persons, not to the product itself. Damage to impaired property exclusion. A liability policy provision that eliminates coverage for property damage to impaired property or property that has not been physically injured arising from defective products or work. This exclusion removes coverage for economic losses when property cannot be used because of the insured's defective product or work, but the property itself is not physically damaged. Recall exclusion. A policy provision that eliminates coverage for costs associated with withdrawing, inspecting, repairing, replacing, or disposing of the insured's products or work. The recall exclusion removes coverage for recall campaigns and related expenses. Separate product recall insurance is needed for this exposure. Aircraft exclusion, a policy provision that eliminates coverage for liability arising from the ownership, maintenance, or use of aircraft. Aircraft exposures require specialized aviation insurance due to their unique risks and high severity potential. The exclusion removes aircraft-related liability from general liability policies. Watercraft exclusion, a policy provision that eliminates or limits coverage for liability arising from the ownership, maintenance, or use of watercraft above certain size thresholds. Larger watercraft require specialized marine insurance. The exclusion typically allows coverage for small boats below specified length, while removing coverage for larger vessels. Motor vehicle exclusion, a provision in liability policies that eliminates coverage for liability arising from the ownership, maintenance, or use of motor vehicles. Motor vehicle exposures are covered under separate auto insurance policies. The exclusion prevents overlap and clarifies that auto liability is not covered under general liability policies. Named insured's location, a provision identifying specific premises, addresses, or geographic locations where coverage applies. The policy may limit coverage to scheduled locations or provide coverage at any location where the named insured operates. The location provision defines where covered operations can occur. Newly acquired property, a policy provision that automatically extends coverage to property acquired by the insured during the policy period. This provision typically provides automatic coverage for a limited time period, often 30 days, and up to a specified limit, giving the insured time to report the acquisition and adjust coverage. It prevents gaps in coverage when the insured acquires additional property. Newly acquired locations, a provision that automatically extends coverage to locations or premises acquired by the insured during the policy period. Similar to newly acquired property provisions, this feature provides temporary automatic coverage for new locations, usually with time and limit restrictions. The insured must report new locations to ensure continued coverage. Automatic coverage extension, a policy feature that automatically extends certain coverages to new exposures, properties, or operations acquired during the policy period. Automatic extensions provide seamless coverage without requiring immediate notification or endorsement, though reporting within specified timeframes is typically required to maintain coverage beyond the automatic extension period. Property in transit, a policy provision that extends coverage to insured property while being transported from one location to another. Coverage in transit addresses the period when property is being moved and may have different coverage terms, limits, or deductibles than when property is at a fixed location. Transit coverage is important for businesses that regularly move goods or equipment. Premises liability, coverage for liability arising from conditions on the insured's owned, leased, or controlled property. Premises liability provisions address injuries to third parties who are on the insured's premises, such as customers, vendors, or visitors. This coverage is foundational in general liability policies. Operations liability, coverage for liability arising from the insured's ongoing business operations or activities. Operations liability provisions cover injuries or damages caused by the insured's work activities away from their premises. This complements premises liability to provide comprehensive coverage for business activities. Products completed operations. Hazard, a defined term in liability policies encompassing liability for bodily injury or property damage arising from the insured's products or completed work. This hazard includes injuries occurring away from the insured's premises after operations are completed or products are sold. It represents ongoing liability exposure after work is finished or products leave the insured's control. Occurrence, the policy's specific definition of what constitutes an occurrence, typically described as an accident or continuous or repeated exposure to conditions that results in injury or damage. The occurrence definition is critical because it triggers coverage and determines how limits apply. Some policies define occurrence differently, affecting coverage scope. Bodily injury, the policy's specific definition of bodily injury, typically including physical injury, sickness, disease, or death. The bodily injury definition establishes what types of personal harm are covered under liability provisions. Mental anguish or emotional distress may or may not be included depending on the policy's definition. Property damage. The policy's specific definition of property damage, typically including physical injury to or destruction of tangible property, or loss of use of tangible property. The property damage definition determines what types of harm to physical property trigger coverage. Pure economic loss without physical damage is typically excluded. Personal injury. The policy's definition of specified offenses such as false arrest, malicious prosecution, wrongful eviction, slander, libel, invasion of privacy, or defamation. Personal injury coverage addresses non-physical harms and violations of personal rights. This differs from bodily injury, which involves physical harm to persons. Advertising injury. The policy's definition of offenses committed during advertising activities, such as copyright infringement, slander, libel, misappropriation of advertising ideas, or invasion of privacy in advertising. Advertising injury coverage protects against liability arising from the insured's advertising efforts. This is typically included in commercial general liability policies. Mobile equipment. The policy's definition of land vehicles and equipment that are not considered autos for insurance purposes. Mobile equipment includes items like bulldozers, cherry pickers, and air compressors that are used primarily off public roads. This definition determines whether coverage falls under general liability or auto policies. Auto. The policy's specific definition of what constitutes an automobile, typically including land motor vehicles designed for travel on public roads. The auto definition determines what vehicles are covered under auto policies versus other types of coverage. Trailers and mobile equipment may or may not be included depending on the definition. Insured contract. The policy's definition of contracts or agreements under which the insured assumes liability. This definition specifies what types of contractual liability the policy will cover, despite the general contractual liability exclusion. Insured contracts typically include leases, easements, railroad sidetrack agreements, and certain indemnification agreements. Suit. The policy's specific definition of what constitutes a lawsuit, which may include civil proceedings, arbitration, mediation, or alternative dispute resolution. The suit definition determines what types of legal actions trigger the insurer's duty to defend. Some policies define suit narrowly as only civil court proceedings. Pollutants. The policy's definition of what substances are considered pollutants, typically including any solid, liquid, gaseous, or thermal irritant or contaminant. The pollutants definition is critical in determining what falls under pollution exclusions. Definitions vary and may include or exclude items like smoke, vapor, or building materials. Fungi. The policy's definition of mold, mildew, yeast, mushrooms, or other fungi, and any byproducts or substances they produce. The fungi definition is used in mold exclusions and limited coverage provisions. Some definitions also include bacteria or other microorganisms. Diminution in value. A policy concept addressing reduction in property value even after repairs are completed. Some policies exclude coverage for diminution in value, meaning they will only pay to repair damage, but not for any reduction in market value that remains after repairs. This is common in auto insurance when vehicles lose value after accidents despite proper repairs. Business personal property. A defined category of covered property including furniture, fixtures, equipment, inventory, and other movable property used in business operations. Business personal property coverage protects contents and equipment owned by the insured or for which they are liable. The definition specifies what types of property are included and excluded. Building. The policy's specific definition of what constitutes a building, typically including the structure itself and permanently attached fixtures, machinery, or equipment. The building definition determines what is covered under building coverage versus business personal property coverage. Items like outdoor property, building additions, or certain equipment may or may not be included based on the definition. Stock. The policy's definition of merchandise, goods, materials, or products held for sale, distribution, or use in manufacturing. Stock coverage protects inventory and raw materials. The definition clarifies what business property is considered stock versus equipment or supplies. Tenants' improvements and betterments. Fixtures, alterations, installations, or additions made by a tenant to a building they do not own. Tenants' improvements and betterments coverage protects the tenant's investment in improving leased space. The definition specifies that the property must be acquired or made at the tenant's expense and must become part of the building. Valuable papers and records. Inscribed, printed, or written documents, manuscripts, or records that have value beyond their physical material. Valuable papers coverage addresses the cost to research, replace, or restore important documents. Standard property limits for paper are typically very low, making this specialized coverage important for businesses with significant documents. Accounts receivable. Records of amounts owed to the insured by customers for goods or services provided. Accounts receivable coverage protects against loss when records are damaged and the insured cannot collect from customers. The coverage pays for amounts that cannot be collected due to loss of records, plus related collection expenses. Money and securities. Currency, coins, banknotes, bullion, checks, drafts, and marketable securities. Money and securities coverage provides protection for these items, which typically have very low or no coverage under standard property policies. Special coverage or safeguards are required for businesses handling significant amounts of money. Electronic data. Information, facts, or computer programs stored electronically on computer systems or electronic media. Electronic data provisions address coverage for data loss, restoration costs, and business interruption from data loss. Many policies exclude or severely limit electronic data coverage, making specialized cyber coverage necessary. Master policy. A single insurance policy issued to a group sponsor, such as an employer or association, that covers all eligible group members. The master policy contains all terms, conditions, and coverage details, while individual members receive certificates of coverage. Group members are not direct parties to the insurance contract. Certificate of coverage. A document provided to individuals covered under a group insurance policy summarizing their benefits and coverage. Certificates of coverage serve as proof of insurance but are not the actual policy. They outline key provisions applicable to the certificate holder. Group policy. An insurance policy that covers multiple individuals under a single contract, typically issued to an employer, association, or other organization. Group policies spread risk across many members and typically offer lower rates than individual coverage. Eligibility is based on membership in the group. Individual policy. An insurance policy issued directly to an individual rather than through a group. Individual policies are personally owned and portable, remaining in force regardless of employment or association membership. They are underwritten based on the individual applicant's characteristics. Portability. The ability to maintain insurance coverage when changing employment, residence, or other circumstances. Portability provisions allow individuals to continue coverage without reapplying or proving insurability. HIPAA and COBRA provide portability protections in certain situations. Conversion privilege. The right to convert group insurance coverage to an individual policy when leaving the group, typically without providing evidence of insurability. Conversion privileges allow continued coverage when group coverage terminates. The individual policy may have different terms and higher premiums. Summary of Benefits and Coverage, SBC. A standardized document required for health insurance plans that summarizes key features, costs, and coverage in plain language. SBCs allow easy comparison between plans using uniform format and terminology. They must be provided during enrollment and upon request. Essential health benefits. 10 categories of healthcare services that most health insurance plans must cover under the Affordable Care Act, including emergency services, hospitalization, prescription drugs, and preventive care. Essential health benefits ensure comprehensive coverage. Plans cannot impose annual or lifetime limits on these benefits. Minimum Essential Coverage, MEC. Health insurance that meets the Affordable Care Act requirement for individuals to have coverage or pay a penalty, though the penalty was reduced to zero. MEC includes employer plans, individual market plans, Medicare, Medicaid, and other qualifying coverage. It satisfies the individual mandate requirement. Actuarial value, the percentage of total covered healthcare costs that an insurance plan pays on average, with the remainder paid by the enrollee through deductibles, copayments, and coinsurance. Actuarial value determines metal tiers: bronze, 60%, silver, 70%, gold, 80%, and platinum, 90%. Higher actuarial values mean more comprehensive coverage. Metal tier, the categorization of health insurance plans in the marketplace based on actuarial value: bronze, silver, gold, and platinum. Metal tiers indicate how costs are shared between the plan and the enrollee. Higher tiers have higher premiums but lower out-of-pocket costs when receiving care. Catastrophic plan, a health insurance plan with very low premiums but high deductibles, available only to individuals under 30 or those with hardship exemptions. Catastrophic plans cover essential health benefits after the deductible is met and provide 3 primary care visits and preventive services before the deductible. They protect against worst-case scenarios. Summary Plan Description, SPD, a document that employers must provide to participants in employee benefit plans, explaining coverage, rights, and responsibilities in understandable terms. SPDs summarize key plan provisions and are required under ERISA for employer-sponsored plans. They must be provided within specific timeframes. Evidence of insurability, EOI. Documentation or proof of good health required by an insurer before approving coverage, particularly for amounts above guaranteed issue limits. EOI typically involves completing health questionnaires or undergoing medical examinations. It protects insurers from adverse selection. Guaranteed issue, a requirement that insurers must offer coverage to all applicants regardless of health status, age, or other factors. Guaranteed issue provisions prevent denial based on pre-existing conditions. The Affordable Care Act requires guaranteed issue for individual and small group health plans. Guaranteed renewable, a policy provision requiring the insurer to renew coverage as long as premiums are paid, though rates may be adjusted for entire classes of insureds. Guaranteed renewable policies cannot be cancelled due to health status changes. The insurer must continue coverage, but can raise premiums for all policyholders in a class. Non-cancelable, a policy provision guaranteeing that coverage cannot be cancelled, and premiums cannot be increased during the policy term as long as premiums are paid on time. Non-cancelable policies provide the strongest renewal protection. They are common in individual disability insurance. Conditionally renewable, a policy provision allowing the insurer to refuse renewal or modify coverage under certain specified conditions, such as reaching a certain age or changing occupations. Conditionally renewable policies have less protection than guaranteed renewable policies. The conditions for non-renewal must be stated in the policy. Optionally renewable, a policy provision giving the insurer the right to refuse renewal at any policy anniversary or premium due date. Optionally renewable policies offer the least renewal protection to policyholders. Insurers have broad discretion to terminate coverage. Free look period, a specified time period after purchasing an insurance policy during which the policyholder can cancel for a full refund of premiums paid. Free look periods typically range from 10 to 30 days, depending on the policy type and state. This allows consumers to review policies thoroughly without commitment. Policy anniversary, the annual recurrence of the date on which a life insurance policy was issued. Policy anniversaries are important for cash value accumulation, policy loans, and dividend calculations. Many policy provisions reference the anniversary date. Policy year. The 12-month period following the policy effective date or anniversary date. Policy years are used to measure benefits, accumulation periods, and maximum limits. They may differ from calendar years. Policy loan. Money borrowed by a policyholder from the cash value of a permanent life insurance policy. Policy loans accrue interest and reduce the death benefit if not repaid. They provide liquidity without surrendering the policy. Loan interest rate. The rate charged on money borrowed against a life insurance policy's cash value. Loan interest rates are specified in the policy and may be fixed or variable. Unpaid interest is added to the loan balance and reduces the death benefit. Automatic premium loan. A policy provision that automatically uses cash value to pay overdue premiums and prevent policy lapse. Automatic premium loans keep coverage in force when policyholders miss payments. The loan must be repaid with interest, or it reduces the death benefit. Dividend. A return of premium to policyholders when a participating life insurance policy's actual experience is more favorable than assumed in premium calculations. Dividends are not guaranteed and vary based on insurer performance. They can be taken as cash, used to reduce premiums, left to accumulate, or purchase additional coverage. Participating policy. A life insurance policy that pays dividends to policyholders when the insurer's experience is favorable. Participating policies are typically offered by mutual insurance companies. Policyholders share in the company's financial success. Non-participating policy. A life insurance policy that does not pay dividends to policyholders. Non-participating policies typically have lower premiums than participating policies, but do not share in insurer profits. They are common with stock insurance companies. Dividend options. The choices available to policyholders for receiving dividends from participating life insurance policies. Common options include receiving cash, reducing premiums, purchasing paid-up additional insurance, accumulating at interest, or purchasing one-year term insurance. Policyholders can change options subject to policy rules. Paid-up additions. Additional life insurance coverage purchased with policy dividends that becomes fully paid and requires no further premiums. Paid-up additions increase both the death benefit and cash value. They also earn future dividends. Reduced paid-up insurance. A non-forfeiture option allowing the policyholder to stop paying premiums and receive a reduced amount of permanent insurance based on the accumulated cash value. Reduced paid-up insurance requires no further premiums and remains in force for life. The death benefit is lower than the original policy. Extended term insurance. A non-forfeiture option that uses the policy's cash value to purchase term insurance for the same face amount as the original policy for as long as the cash value allows. Extended term insurance requires no further premiums, but coverage ends when the term expires. It maintains the full death benefit temporarily. Non-forfeiture options. Choices available to permanent life insurance policyholders who stop paying premiums, including cash surrender, reduced paid-up insurance, and extended term insurance. Non-forfeiture options ensure policyholders receive value from premiums paid. They prevent complete loss of benefits. Settlement options. Methods by which life insurance proceeds can be paid to beneficiaries beyond a lump sum, including interest only, fixed period, fixed amount, and life income options. Settlement options provide flexibility in how death benefits are distributed. They can provide ongoing income rather than a single payment. Lump sum. A one-time payment of the entire death benefit or policy proceeds. Lump sum settlements provide immediate access to all funds. They are the default settlement option unless the policyholder or beneficiary selects another method. Interest-only option. A settlement option where the insurance proceeds are held by the insurer, and only interest is paid to the beneficiary. The principal remains with the insurer, and can be withdrawn later or paid to contingent beneficiaries. This preserves the principal while providing income. Fixed period option. A settlement option where insurance proceeds are paid in equal installments over a specified time period. Fixed period options liquidate both principal and interest over the selected time frame. The payment amount depends on the proceeds, time period, and interest rate. Fixed amount option. A settlement option where insurance proceeds are paid in specified dollar amounts until the proceeds plus interest are exhausted. Fixed amount options provide predictable payments, with the duration varying based on total proceeds. Payments continue until funds are depleted. Life income option. A settlement option that converts insurance proceeds into periodic payments for the beneficiary's lifetime. Life income options provide guaranteed income that cannot be outlived. Various forms include life only, life with period certain, and joint and survivor. Accidental death benefit. A rider that pays an additional death benefit if the insured dies as a result of an accident. Accidental death benefits typically double or triple the face amount, and are sometimes called double indemnity or triple indemnity. The death must meet specific criteria to qualify. Accelerated death benefit. A provision or rider allowing the insured to receive a portion of the death benefit while still living if diagnosed with a terminal illness or meeting other qualifying conditions. Accelerated death benefits provide funds for medical care or other expenses during the insured's lifetime. The amount received reduces the death benefit paid to beneficiaries. Living benefits. Policy provisions or riders that allow access to death benefits before death under specified circumstances, such as terminal illness, chronic illness, or critical illness. Living benefits provide financial assistance when needed most. They reduce the death benefit paid to beneficiaries. Critical illness rider. An optional benefit that pays a lump sum if the insured is diagnosed with a specified critical illness, such as cancer, heart attack, or stroke. Critical illness riders provide funds to cover medical expenses and lost income during serious illness. The benefit is paid regardless of actual expenses incurred. Chronic illness rider. A rider that pays benefits if the insured becomes chronically ill and unable to perform activities of daily living. Chronic illness riders accelerate the death benefit to help pay for long-term care expenses. They provide living benefits for qualifying chronic conditions. Long-term care rider. A life insurance rider that accelerates the death benefit to pay for long-term care expenses if the insured meets benefit triggers. Long-term care riders combine life insurance and long-term care coverage. They provide flexibility to use benefits for either long-term care or death benefit. Return of premium rider. A rider that returns all or a portion of premiums paid if the insured survives to a specified age or the end of the policy term. Return of premium riders increase the cost of coverage, but eliminate the use it or lose it aspect of term insurance. They appeal to those who view insurance as an investment. Cost of living adjustment. COLA. A rider or provision that automatically increases benefit amounts periodically to keep pace with inflation. COLA adjustments help maintain purchasing power over time. They are common in disability insurance and long-term care insurance. Maximum benefit. The highest amount an insurance policy will pay either per occurrence, per policy period, or over the lifetime of the policy. Maximum benefits cap the insurer's total obligation. They may apply to specific services or overall coverage. Daily benefit amount. The maximum amount a long-term care or disability insurance policy will pay per day for covered services or benefits. Daily benefit amounts are selected when purchasing coverage and affect premium costs. They represent the daily limit of coverage. Monthly benefit amount. The amount paid each month under disability insurance or long-term care insurance policies. Monthly benefit amounts are typically expressed as a percentage of pre-disability income or as a flat dollar amount. They provide ongoing income replacement. Activities of daily living. ADLS. Basic self-care tasks used to determine eligibility for long-term care insurance benefits, including bathing, dressing, toileting, transferring, continence, and eating. Inability to perform a specified number of ADLs, typically 2 or 3, triggers benefit payments. ADLs are standard measures of functional ability. Benefit trigger, the specific condition or event that must occur for insurance benefits to become payable. Benefit triggers for long-term care include inability to perform ADLS or cognitive impairment. Clear benefit triggers define when coverage begins. Cognitive impairment, deterioration of mental function severe enough to require substantial supervision, used as a benefit trigger in long-term care insurance. Cognitive impairment includes conditions like Alzheimer's disease and dementia. It qualifies for benefits even if physical ADLS can still be performed. Inflation protection, a feature in long-term care or disability insurance that increases benefit amounts over time to keep pace with rising costs. Inflation protection can be simple, fixed percentage increases, compound, increasing percentage, or based on actual cost increases. It prevents erosion of purchasing power. Premium mode, the frequency with which insurance premiums are paid, such as annually, semi-annually, quarterly, or monthly. Premium mode affects the total annual cost, with annual payments typically receiving discounts. Policyholders can often choose their preferred mode. Level premium, a premium structure where the amount paid remains constant throughout the policy term or life of the policy. Level premiums are common in permanent life insurance and provide predictability. They are higher initially, but don't increase with age. Graded premium, a premium structure where the amount increases gradually over time according to a predetermined schedule. Graded premiums start lower than level premiums, but increase periodically. They may appeal to younger buyers expecting income growth. Modified premium, a premium structure where lower premiums are charged for an initial period, such as the first 5 years, with higher premiums thereafter. Modified premiums make coverage more affordable initially, while maintaining permanent coverage. They balance early affordability with long-term cost. Single premium, a premium structure where the entire cost of the policy is paid in one lump sum at policy inception. Single premium policies require no further payments and are immediately fully funded. They are common in certain life insurance and annuity products. Flexible premium, a premium structure allowing the policyholder to vary the amount and timing of premium payments within specified limits. Flexible premiums are characteristic of universal life insurance. They provide adaptability to changing financial circumstances. Target premium, the suggested premium amount for universal life or variable universal life policies that, if paid regularly, is expected to keep the policy in force to a specified age. Target premiums are guidelines rather than requirements. Paying less may cause the policy to lapse. Minimum premium, the smallest premium payment required to keep a flexible premium policy in force. Minimum premiums cover insurance costs and expenses, but may not build cash value. Consistently paying only minimum premiums may cause policy lapse. Mortality charge, the cost of providing the pure insurance protection, death benefit, in a life insurance policy, deducted from cash value in universal life policies. Mortality charges increase with age as death risk rises. They are based on the net amount at risk. Cost of insurance, the amount charged for the pure insurance protection in a policy, representing the cost of the death benefit. Cost of insurance varies based on age, health, sex, and the net amount at risk. It is a key component of universal life policies. Party, any person, business, or entity involved in an insurance contract or claim. Parties to insurance transactions include the insured, the insurer, agents, brokers, claimants, loss payees, and other stakeholders. Each party has specific rights, duties, and roles within the insurance relationship. First party, the insured or policyholder who purchases insurance coverage and has a direct contractual relationship with the insurance company. The first party is the person or entity seeking protection for their own property, interests, or liabilities. First-party claims are made by the insured against their own insurance policy. Second party, the insurance company or insurer that issues the policy and assumes the risk in exchange for premium payments. The second party is obligated to pay covered claims and provide the promised insurance protection. The insurer is the other principal party to the insurance contract, along with the insured. Third party, a person or entity who is not a party to the insurance contract, but who may make a claim against the insured for damages or injuries. Third parties are outsiders to the insurance relationship who suffer harm allegedly caused by the insured. Liability insurance protects the insured against third-party claims. Claimant, a person or entity making a demand for payment under an insurance policy, either as the insured seeking first-party benefits or as a third party seeking damages from the insured. The claimant asserts that a covered loss has occurred and seeks compensation. Claimants must substantiate their claims with evidence and documentation. Agent, an insurance professional who represents one or more insurance companies and is authorized to sell policies, collect premiums, and service policyholders on behalf of the insurer. Agents may be captive, representing only one insurer, or independent, representing multiple insurers. Agents typically have binding authority to commit the insurer to coverage within their scope of authority. Captive agent, an insurance agent who represents and sells policies exclusively for a single insurance company. Captive agents work directly for one insurer and can only offer that company's products. They typically receive training, support, and benefits from their single insurer and may have access to proprietary products. Independent agent, an insurance professional who represents multiple insurance companies and can offer policies from various insurers to clients. Independent agents are not employed by any single insurer and can shop coverage among their carrier partners to find the best fit for clients. They own their client relationships and typically operate their own agencies. Managing General Agent, MGA, a specialized agent or agency with underwriting authority granted by an insurer to bind coverage, set rates, and manage policies within specified parameters. MGAs operate with greater autonomy than standard agents and may handle claims, collect premiums, and perform other insurer functions. They typically specialize in particular types of insurance or markets. General Agent, an insurance agent with broader authority than a typical agent, often including the ability to appoint sub-agents within a territory. General agents may have some underwriting authority and typically manage a region or territory for an insurer. They combine sales responsibilities with administrative and management functions. Broker, an insurance professional who represents the insurance buyer rather than the insurance company in procuring coverage. Brokers work on behalf of clients to find suitable insurance, negotiate terms, and place coverage with insurers. Unlike agents, brokers typically do not have binding authority and must obtain insurer approval for coverage. Insurance broker, another term for a broker, emphasizing their role as the client's representative in insurance transactions. Insurance brokers owe fiduciary duties to their clients and must act in the client's best interests when procuring coverage. They are compensated through commissions paid by insurers or fees charged to clients. Retail broker, a broker who works directly with individual and business clients to assess their insurance needs and place coverage. Retail brokers serve as the primary point of contact for insureds and handle policy service, claims assistance, and coverage reviews. They may work with wholesale brokers to access specialized markets. Wholesale broker, a broker who acts as an intermediary between retail agents or brokers and insurance companies, typically specializing in hard-to-place risks or specialty coverages. Wholesale brokers do not deal directly with the ultimate insured, but help retail brokers access markets and insurers they cannot reach directly. They provide expertise in specialized insurance areas. Producer, a general term for any insurance professional who sells insurance, including both agents and brokers. Producers generate business for insurance companies by marketing policies and bringing in new clients. The term encompasses all sales-oriented insurance professionals, regardless of their specific role or relationship with insurers. Surplus lines broker. A specialized broker licensed to place insurance with non-admitted or surplus lines, insurers for risks that cannot be covered in the standard admitted market. Surplus lines brokers must be specially licensed and typically must demonstrate that coverage is unavailable in the admitted market before placing business with surplus lines carriers. They handle unique, high-risk, or unusual exposures. Underwriter. An insurance professional who evaluates risks, determines whether to accept them, and establishes appropriate coverage terms and pricing. Underwriters analyze applications, assess exposures, review loss history, and make decisions about issuing policies. They are responsible for maintaining a profitable book of business while providing competitive coverage. Field underwriter. An underwriter who works outside the home office, often meeting directly with agents, brokers, and insureds to evaluate risks. Field underwriters conduct on-site inspections, assess properties and operations firsthand, and provide local market expertise. They combine traditional underwriting analysis with direct risk assessment. Senior underwriter. An experienced underwriter with authority to handle more complex or higher-value risks and make binding decisions within broader parameters. Senior underwriters often mentor junior underwriters, handle special situations, and have greater autonomy in risk acceptance and pricing. They typically manage the most challenging accounts. Underwriting authority. The power granted to an agent, underwriter, or other insurance professional to bind coverage, set rates, or make underwriting decisions within specified limits. Underwriting authority defines the scope of risks, premiums, and terms a person can approve without seeking higher approval. Authority levels vary based on experience and position. Binding authority. The power to commit an insurance company to coverage, making the policy effective immediately upon acceptance. Those with binding authority can create enforceable insurance contracts on behalf of the insurer. This authority is carefully controlled and limited to qualified agents, brokers, or underwriters. Claims adjuster. An insurance professional who investigates, evaluates, and settles insurance claims on behalf of the insurer. Adjusters determine coverage, assess damages, verify losses, interview parties and witnesses, and negotiate settlements. They ensure claims are handled fairly and according to policy terms while protecting the insurer's interests. Staff adjuster. A claims adjuster who is a direct employee of an insurance company and handles claims exclusively for that insurer. Staff adjusters work from company offices or in the field and have ongoing employment relationships with their insurer. They handle the full range of claims for their employer. Independent adjuster. A claims adjuster who operates as an independent contractor and handles claims for multiple insurance companies. Independent adjusters are retained by insurers on an as-needed basis, particularly during catastrophes or claim surges. They provide flexibility and specialized expertise while maintaining independence from any single insurer. Public adjuster. A claims adjuster who represents the policyholder rather than the insurance company in the claims process. Public adjusters are hired and paid by insureds to advocate for maximum claim settlements. They assess damages, document losses, prepare claims, and negotiate with the insurer's adjusters on behalf of the insured. Loss adjuster. Another term for a claims adjuster, emphasizing their role in evaluating and settling losses. Loss adjusters investigate the circumstances of losses, determine the extent of damages, and recommend appropriate settlements. The term is more commonly used in international insurance markets. Appraiser. A qualified professional who determines the value of property for insurance purposes, either for establishing coverage amounts or settling claims. Appraisers provide independent valuations based on their expertise in specific types of property. In claims disputes, appraisers may be appointed by each party to reach agreement on loss amounts. Umpire. A neutral third party selected to resolve disagreements between appraisers when they cannot agree on the value of a loss. The umpire reviews the appraiser's findings and makes a binding decision. This appraisal process is often specified in policies as an alternative dispute resolution method for valuation disagreements. Loss payee, a person or entity designated in an insurance policy to receive payment for property losses, typically someone with a financial interest in the insured property. Loss payees do not have the full rights of a named insured, but are entitled to receive claim payments. Common loss payees include lenders, lessors, and secured creditors. Mortgagee, a lender who holds a mortgage on insured property and is named in the policy to protect their financial interest. The mortgagee has the right to receive claim payments to the extent of their interest in the property. Standard mortgagee clauses provide strong protection that survives even if the borrower's coverage is voided. Lienholder, a person or entity that has a legal claim or security interest in property as collateral for a debt. Lienholders are similar to mortgagees, but the term applies more broadly to any secured interest, such as auto loans or equipment financing. They are typically named as loss payees to protect their financial stake in the collateral. Lessor, the owner of property who leases it to another party and who may have an insurable interest requiring protection. Lessors are often named as additional insureds or loss payees on policies covering leased property. They want assurance that their property is protected while in the lessee's possession. Lessee, the party who rents or leases property from an owner and who typically carries insurance on the leased property. Lessees are usually required by lease agreements to maintain insurance and name the lessor as an additional insured or loss payee. They are responsible for protecting the lessor's property while using it. Bailee, a person or business that temporarily holds property belonging to others, such as repair shops, warehouses, or dry cleaners. Bailees have a legal duty of care for property in their custody and may be liable for damage or loss. Bailee's customer insurance covers the property of others while in the bailee's care. Bailer, the owner of property who temporarily entrusts it to a bailee for storage, repair, transport, or other purposes. The bailer retains ownership while the property is in the bailee's possession. Understanding the bailer-bailee relationship clarifies who needs what type of insurance coverage. Landlord, the owner of real property who leases it to tenants and who often requires tenants to carry insurance. Landlords typically maintain property insurance on buildings and may require tenants to name them as additional insureds on liability policies. They have an insurable interest in both the property and protection from tenant-caused liabilities. Tenant, a person or business that rents or leases property from a landlord and who typically carries insurance to protect their interests and liability. Tenants need coverage for their personal property, improvements they make, and liability arising from their occupancy. Lease agreements usually specify insurance requirements tenants must meet. Additional insured, a person or entity added to an insurance policy who receives coverage for specified liabilities under the named insured's policy. Additional insureds have coverage but limited policy rights compared to named insureds and cannot make policy changes. This status is typically granted through endorsement to extend liability protection to others with whom the named insured has a relationship. Certificate holder, a person or entity who receives a certificate of insurance showing that the named insured has coverage, but who does not necessarily have any coverage under the policy. Certificate holders may require proof of insurance for contractual or regulatory purposes. Being a certificate holder alone does not provide insurance coverage or additional insured status. Vendor, a person or business that sells products manufactured by others and who may be added as an additional insured on the manufacturer's liability policy. Vendors can be liable for injuries caused by products they sell, so they often require suppliers to provide them with additional insured coverage. Vendors' coverage protects retailers and distributors. Franchisee, a person or business that operates under a franchise agreement using the franchisor's brand, systems, and business model. Franchisees are typically required by franchise agreements to maintain specified insurance coverages, and name the franchisor as an additional insured. They operate independently but must meet the franchisor's insurance standards. Franchisor, the company that grants franchise rights and typically requires franchisees to carry insurance protecting both parties. Franchisors are commonly named as additional insureds on franchisee policies to protect against liability arising from franchised operations. They may also provide or require group insurance programs for all franchisees. General contractor, a contractor who oversees a construction project and typically hires subcontractors to perform portions of the work. General contractors are usually required to maintain insurance and may need to provide additional insured coverage to project owners. They also typically require subcontractors to name them as additional insureds. Subcontractor, a contractor hired by a general contractor to perform specific portions of a construction project. Subcontractors typically must provide insurance and name the general contractor and sometimes the project owner as additional insureds. Their insurance provides coverage for their work and resulting liabilities. Project owner, the person or entity that owns a construction project and hires contractors to perform work. Project owners typically require contractors to maintain insurance and provide additional insured coverage to the owner. They have an insurable interest in the project and face potential liability from construction activities. Contractor, a person or business hired to perform work or provide services, typically in construction but also in other fields. Contractors need insurance to protect against liability for their work and injuries occurring during operations. They often must provide proof of insurance and additional insured coverage to those who hire them. Insured person, any individual who is protected under an insurance policy, including the named insured and other covered persons. The policy specifies which persons qualify as insureds and the extent of their coverage. Different classes of insured persons may have different coverage grants or limitations. Permissive user, a person who uses insured property with the owner's permission and who may be covered under the owner's insurance policy. Permissive user coverage is common in auto insurance, extending coverage to anyone driving the vehicle with the owner's consent. The extent of permissive user coverage varies by policy type and jurisdiction. Omnibus clause, a policy provision that extends coverage to additional persons beyond the named insured, such as family members or permissive users. The omnibus clause broadens who qualifies as an insured under the policy. It is particularly common in auto insurance to cover household members and those using vehicles with permission. Household member, a person who resides in the same household as the named insured and who may be covered under the policy as an additional insured. Household member coverage is common in personal insurance policies like homeowners and auto insurance. The definition of household member and extent of their coverage varies by policy. Spouse, the husband or wife of the named insured who typically receives coverage as an insured under personal insurance policies. Spouses are usually automatically included as insureds without being specifically named. Their coverage is often equal to that of the named insured for most purposes. Resident relative, a family member who lives in the same household as the named insured and who is covered under certain insurance policies. Resident relatives typically include children, parents, siblings, or other relatives residing with the named insured. Personal auto and homeowners policies commonly extend coverage to resident relatives. Family member, a relative of the named insured who may be covered under the insurance policy, with specific definitions varying by policy type. Family member status affects coverage eligibility in personal insurance policies. The policy defines which relationships qualify and whether residence in the same household is required. Employee, a person who works for the insured under an employment relationship and whose work-related injuries or liabilities may involve the employer's insurance. Employees are typically excluded from coverage under the employer's liability policies, covered instead by workers' compensation, but may be covered for non-work activities. Employee status affects multiple types of insurance coverage. Volunteer worker. A person who donates their time and services to an organization without expectation of payment and who may be covered under the organization's insurance. Volunteer workers create liability exposures for organizations and may need coverage similar to employees. Many liability policies extend coverage to include volunteer workers in the definition of insured persons. Executive officer. A high-level corporate leader such as a president, vice president, secretary, or treasurer who holds a management position in a company. Executive officers have specific coverage considerations in various insurance policies, including potential exclusions from workers' compensation or special treatment under liability policies. Their status affects coverage in multiple ways. Partner. A co-owner of a partnership business who shares in management, profits, and liabilities of the enterprise. Partners may be covered as insureds under business insurance policies or may require separate coverage. The partnership structure affects insurance needs and coverage grants. Member. An owner of a limited liability company, LLC, who has membership interests in the organization. Members have roles similar to partners or shareholders depending on the LLC structure. Their insurance coverage as insureds depends on policy definitions and the nature of their involvement in the business. Shareholder. An owner of stock in a corporation who holds an ownership interest but may not be actively involved in management. Shareholders are typically not covered as insureds under corporate insurance policies unless they also serve as officers, directors, or employees. Large shareholders may have special coverage considerations. Director. A member of a company's board of directors who provides governance and oversight but may not be involved in day-to-day operations. Directors face liability exposures requiring specialized directors and officers D&O insurance. Their status as insureds under various policies depends on policy language and their activities. Officer. A corporate leader appointed to a specific position such as president, vice president, chief financial officer, or secretary who manages company affairs. Officers have both management authority and potential liability exposure. Their coverage as insureds varies across different types of insurance policies. Principal. The person or entity on whose behalf an agent acts or who authorizes another to act on their behalf. In insurance, the principal is the party represented by an agent or broker. In construction, a principal is a party to a bonded contract. The term has different specific meanings in various insurance contexts. Subsidiary. A company controlled by another company, the parent, through ownership of voting stock or other means. Subsidiaries may be automatically covered as insureds under a parent company's policy, may require separate coverage, or may need to be specifically added depending on policy terms. The parent-subsidiary relationship affects insurance structure. Parent company. A company that controls one or more subsidiary companies through ownership or other means. Parent companies typically coordinate insurance programs for their corporate families and may purchase policies covering all entities. The relationship between parent and subsidiaries affects insurance coverage and program structure. Affiliated company. A company related to another through common ownership, control, or business relationships. Affiliated companies may share insurance programs or require separate policies depending on their legal structure and relationships. Understanding affiliation is important for determining who is covered under various policies. Joint venturer. A party to a joint venture, which is a temporary business arrangement where two or more parties collaborate on a specific project while remaining separate entities. Joint venturers may need special insurance coverage for the venture and may have coverage issues under their respective individual policies. Joint venture insurance addresses unique exposures of collaborative projects. Co-insured. A person or entity who shares insured status with others under the same insurance policy. Co-insureds have equal coverage rights, though specific grants of coverage may differ among them. The term indicates that multiple parties are protected under a single policy. Trust. A legal entity created to hold and manage property for beneficiaries, which may be a named insured or additional insured on policies. Trusts have insurable interests in property they hold and may need coverage for their activities and liabilities. Understanding trust ownership affects how insurance should be structured. Trustee: a person or entity appointed to manage a trust and who may need to be named as an insured on policies covering trust property or activities. Trustees have fiduciary duties and potential liability exposures requiring appropriate insurance coverage. Their role affects insurance needs and policy structure. Estate: the total property and interests owned by a deceased person that may have ongoing insurance needs during administration. Estates may need to maintain insurance on property until it is distributed to heirs. The executor or administrator of an estate may need to be recognized in insurance policies. Executor: a person named in a will to administer a deceased person's estate and who may need to manage insurance matters for estate property. Executors have responsibilities that may include maintaining coverage, filing claims, and ensuring proper insurance protection during estate administration. Their authority and insurance needs must be addressed. Administrator: a person appointed by a court to administer an estate when there is no will or named executor, with responsibilities similar to an executor. Administrators may need to handle insurance matters for the estate and ensure proper coverage during administration. Their legal authority affects insurance decisions and policy management. Guardian: a person appointed by a court to make decisions for someone unable to manage their own affairs, such as a minor or incapacitated adult. Guardians may need to manage insurance matters on behalf of their wards, including maintaining coverage and filing claims. Their authority in insurance matters is established by court appointment. Conservator: a person appointed to manage the financial affairs of someone unable to do so themselves, with responsibilities that may include insurance management. Conservators handle property, investments, and insurance for their protected persons. Their role is similar to a guardian, but typically focuses specifically on financial matters. Fiduciary: a person or entity in a position of trust who must act in the best interests of another party, such as trustees, executors, or agents. Fiduciaries have legal and ethical obligations in their dealings and may need specialized fiduciary liability insurance. The fiduciary relationship creates special duties and potential liability exposures. Insolvency: the financial condition of being unable to pay debts as they become due, which affects insurance coverage and claims. When an insurer becomes insolvent, state guarantee funds may provide limited protection to policyholders. Insured parties declaring insolvency may face coverage issues or policy cancellations. Guarantee fund: a state-operated fund that provides limited protection to policyholders when an insurance company becomes insolvent. Guarantee funds pay claims and continue coverage up to statutory limits when insurers fail. Coverage and limits vary by state and type of insurance. Reinsurer: an insurance company that insures all or part of the risks underwritten by another insurance company. Reinsurers provide financial backing and capacity to primary insurers, allowing them to write larger policies or more business. The reinsurer has no direct relationship with the original insured. Ceding company: an insurance company that transfers some or all of its risk to a reinsurer. The ceding company remains responsible to the policyholder but obtains protection from the reinsurer for covered losses. Ceding companies use reinsurance to manage their risk exposure and increase capacity. Fronting company: an insurer that issues policies and assumes legal responsibility but immediately transfers most or all of the risk to a reinsurer or other entity. Fronting arrangements allow unauthorized insurers to operate in markets where they are not licensed by fronting through a licensed insurer. The fronting company provides a licensed paper and regulatory compliance. Retrocessionaire: a reinsurer that accepts reinsurance from another reinsurer. Retrocession allows reinsurers to manage their own risk exposure by transferring some risks to other reinsurers. This creates additional layers in the reinsurance chain. Third-party administrator, TPA: a company that handles administrative functions for insurance policies or self-insured programs but does not assume insurance risk. TP as process claims, maintain records, and provide customer service on behalf of insurers or self-insured entities. They provide expertise and efficiency without being the actual insurer. Claims administrator, an organization or person responsible for managing the claims process, including receiving claims, investigating losses, and processing payments. Claims administrators may be insurance company employees, TPAs, or specialized firms. They ensure claims are handled efficiently and according to policy terms. Service representative, an insurance company employee or agent who provides customer service to policyholders, answering questions, processing changes, and assisting with policy needs. Service representatives maintain the ongoing relationship with insureds after policies are issued. They handle routine service requests and policy administration. Account manager, an insurance professional who manages the relationship with a client account, coordinating coverage, service, and communication. Account managers serve as the primary contact for insureds, handling renewals, coverage changes, and problem resolution. They ensure client needs are met and manage the overall insurance program. Risk manager, a professional responsible for identifying, analyzing, and managing risk exposures for an organization. Risk managers determine insurance needs, negotiate coverage, implement loss control measures, and oversee claims management. They develop comprehensive risk management strategies combining insurance and other risk financing techniques. Loss control specialist, a professional who identifies hazards and recommends measures to prevent or reduce losses. Loss control specialists conduct safety inspections, provide training, and help implement risk reduction programs. They work to prevent losses before they occur, benefiting both insureds and insurers. Safety inspector, a professional who examines premises, operations, or equipment to identify safety hazards and code violations. Safety inspectors may work for insurers, regulatory agencies, or third-party firms. Their findings can affect insurance availability, pricing, and policy terms. Insurance consultant, a professional who provides expert advice on insurance matters without selling policies or representing specific insurers. Insurance consultants analyze coverage needs, review existing programs, and recommend improvements for a fee rather than commissions. They provide independent expertise to help clients make informed insurance decisions. Actuary, a professional who uses mathematics, statistics, and financial theory to analyze risk and uncertainty in insurance. Actuaries calculate premium rates, establish reserves, assess insurer solvency, and analyze trends. Their work ensures insurance is priced adequately to cover expected losses while remaining competitive. Insurance commissioner, the state official responsible for regulating the insurance industry within their jurisdiction. Insurance commissioners approve policy forms and rates, license insurers and agents, investigate complaints, and enforce insurance laws. They protect consumers while ensuring a stable insurance marketplace. Regulator, a government official or agency responsible for overseeing and enforcing insurance laws and regulations. Regulators ensure insurers remain solvent, treat customers fairly, and comply with legal requirements. Insurance regulation occurs primarily at the state level in the United States. Annuitant, the person on whose life an annuity contract is based and who receives periodic payments from the annuity. The annuitant's age and life expectancy determine payment amounts in life contingent annuities. The annuitant may also be the owner and beneficiary, but these can be different parties. Contract owner, the person or entity who owns an insurance or annuity contract and has the right to make changes, designate beneficiaries, and access cash value. The contract owner controls the policy even if someone else is the insured or annuitant. Ownership can be transferred or assigned subject to policy terms. Certificate holder, an individual covered under a group insurance policy who receives a certificate of coverage rather than the actual policy. certificate holders are not parties to the insurance contract, which exists between the insurer and the group policyholder. They have coverage rights, but limited policy control. Group sponsor: the organization, employer, or association that obtains and administers group insurance coverage for its members or employees. Group sponsors negotiate terms with insurers, handle enrollment, and may contribute to premium costs. They hold the master policy. Plan administrator: the entity responsible for managing and administering an employee benefit plan, including enrollment, claims processing, and compliance with regulations. Plan administrators may be employers, third-party administrators, or insurance companies. They have fiduciary duties under ERISA. Plan participant: an employee or member who is covered under an employee benefit plan or group insurance program. Plan participants have rights to benefits, information, and appeal processes. Their eligibility is determined by plan rules. Eligible employee: a worker who meets the requirements to participate in an employer-sponsored benefit plan, typically based on employment status, hours worked, or length of service. Eligible employees may choose to enroll during enrollment periods. Eligibility criteria are defined in plan documents. Enrollment period: a designated time frame during which eligible individuals can sign up for insurance coverage or make changes to existing coverage. Enrollment periods may be initial, upon hire, annual, open enrollment, or special, following qualifying events. Missing enrollment typically means waiting until the next period. Special enrollment period: a time outside regular enrollment when individuals can enroll in or change health insurance due to qualifying life events. Special enrollment periods typically last 60 days from the qualifying event. They provide flexibility for life changes like marriage or job loss. COBRA administrator: the entity responsible for managing continuation coverage requirements under the Consolidated Omnibus Budget Reconciliation Act, including notifications and premium collection. COBRA administrators ensure compliance with federal continuation coverage rules. They may be employers, third-party administrators, or insurers. Qualified beneficiary: an individual who is eligible for COBRA continuation coverage after losing group health coverage due to a qualifying event. Qualified beneficiaries include covered employees, spouses, and dependent children. They have rights to continue coverage by paying the full premium. Covered dependent: a family member of the primary insured who receives coverage under the policy, such as a spouse or child. Covered dependents must meet policy eligibility requirements regarding relationship, age, and sometimes student or financial dependency status. Their coverage is derivative of the primary insured's coverage. Domestic partner: an individual in a committed relationship with the insured who may be eligible for coverage under the insured's health or life insurance policy. Domestic partner coverage availability and definition vary by employer and state. Some policies extend coverage to domestic partners on the same basis as spouses. Surviving spouse: the husband or wife of a deceased insured who survives the insured's death and may be entitled to benefits, continuation coverage, or conversion rights. Surviving spouses have special rights under pension plans, life insurance, and health insurance continuation provisions. They may also be entitled to Social Security survivor benefits. Legal guardian: a person appointed by a court to make decisions for a minor or incapacitated person, including insurance and health care decisions. Legal guardians may enroll wards in coverage, file claims, and designate beneficiaries. Their authority is established by court order. Power of attorney: legal authorization allowing one person to act on behalf of another in financial or healthcare matters, including insurance decisions. Power of attorney for healthcare allows someone to make medical decisions if the individual becomes incapacitated. Financial power of attorney covers insurance and financial matters. Healthcare proxy: a legal document designating someone to make healthcare decisions on behalf of an individual if they become unable to make decisions themselves. Healthcare proxies ensure medical wishes are followed when individuals cannot communicate. They are critical for healthcare decision-making. Agent of record. The insurance agent or broker officially designated to service a particular policy or client account. The agent of record receives commissions and handles policy servicing. Changing agents of record requires formal notification to the insurer. Broker of record. The insurance broker officially designated to represent a client in procuring and servicing insurance, similar to agent of record. Brokers of record have authority to negotiate on behalf of the client and receive compensation for placed business. Changes require written authorization. Enrollment counselor. A professional who assists individuals in understanding insurance options and enrolling in coverage, particularly for marketplace or Medicare plans. Enrollment counselors must be certified and trained. They help navigate complex coverage choices. Navigator. A type of enrollment counselor specifically certified to help individuals enroll in health insurance marketplace plans under the Affordable Care Act. Navigators provide unbiased assistance and education about coverage options. They are funded by grants and cannot receive insurance company compensation. Insurance marketplace. An organized platform where individuals and small businesses can compare and purchase health insurance plans, established under the Affordable Care Act. Marketplaces may be operated by states or the federal government. They determine eligibility for subsidies and special enrollment. Exchange. Another term for insurance marketplace, referring to the platform for purchasing health insurance. Exchanges facilitate comparison shopping and subsidy administration. The terms marketplace and exchange are used interchangeably. Enrollment broker. A licensed agent or broker authorized to assist with enrollment in marketplace or Medicare plans. Enrollment brokers can recommend specific plans and earn commissions. They must be certified and follow specific rules. Benefits coordinator. An employer representative who manages employee benefits, assists with enrollment, answers questions, and processes claims. Benefits coordinators serve as liaisons between employees and insurance companies. They ensure smooth benefits administration. Health advocate. A professional who helps individuals navigate the healthcare system, understand medical bills, resolve insurance issues, and make informed healthcare decisions. Health advocates may work independently or through employer or insurance programs. They provide personalized assistance with complex health situations. Care coordinator. A healthcare professional who organizes and manages patient care across different providers and settings to ensure comprehensive, efficient treatment. Care coordinators help patients with chronic conditions or complex needs access appropriate services. They improve care quality and outcomes. Medical director. A physician who oversees medical policies, utilization review, and clinical decisions for an insurance company or healthcare organization. Medical directors ensure medical necessity determinations are appropriate and consistent. They provide clinical expertise in coverage decisions. Attending physician. The doctor primarily responsible for a patient's care and treatment. Attending physicians complete forms, certify disabilities, and provide medical information to insurers. Their statements carry significant weight in claim determinations. Examining physician. A doctor who evaluates an insurance applicant or claimant on behalf of the insurance company, separate from the individual's personal physician. Examining physicians provide independent medical assessments for underwriting or claims purposes. They conduct exams specifically for insurance evaluation. Independent medical examiner, IME. A physician who conducts an objective medical evaluation of a claimant at the insurance company's request to assess injuries, disabilities, or treatment needs. IME opinions help resolve disputes about medical conditions or appropriate treatment. They provide unbiased medical assessment. Utilization Review Organization, URO. An entity that conducts utilization review to determine the medical necessity, appropriateness, and efficiency of healthcare services. UROs may be part of insurance companies or independent contractors. They help manage healthcare costs and quality. Peer review. Evaluation of medical treatment, procedures, or claim decisions by a physician in the same specialty to ensure appropriateness and necessity. Peer review provides expert assessment of clinical decisions. It is used in appeals and quality assurance. Appeals coordinator. A professional who manages the process of appealing denied insurance claims or coverage decisions. Appeals coordinators ensure proper procedures are followed and deadlines are met. They facilitate communication between claimants, providers, and insurers. Pharmacy Benefit Manager, PBM. A company that administers prescription drug benefits on behalf of health insurers and employers, negotiating with pharmacies and drug manufacturers. PBMs manage formularies, process claims, and control drug costs. They are intermediaries in the prescription drug supply chain. Specialty Pharmacy. A pharmacy that dispenses high-cost, complex medications typically used to treat rare or chronic conditions. Specialty pharmacies provide additional services like patient education, monitoring, and side effect management. They handle medications requiring special handling or administration. Mail order pharmacy. A pharmacy that fills prescriptions and ships medications directly to patients' homes, typically for maintenance medications. Mail order pharmacies often provide 90-day supplies at reduced cost. They offer convenience for ongoing prescriptions. Preferred pharmacy. A pharmacy in an insurance plan's network that offers lower co-payments or co-insurance than non-preferred pharmacies. Preferred pharmacies have contracted rates with the plan. Using them reduces out-of-pocket costs. Non-preferred pharmacy. A pharmacy outside an insurance plan's preferred network where patients pay higher cost sharing for prescriptions. Non-preferred pharmacies may still be in-network, but at higher cost tiers. Some plans don't cover non-preferred pharmacies at all. Dental provider. A dentist, dental specialist, or dental practice that provides covered dental services. Dental providers may be in-network with specific dental plans or out-of-network. Many health plans include dental coverage or offer it separately. Vision provider. An optometrist, ophthalmologist, or optical retailer that provides eye care services and eyewear. Vision providers contract with vision insurance plans to offer services at negotiated rates. Vision coverage is often separate from medical coverage. Durable medical equipment, DME, supplier. A company or provider that furnishes medical equipment like wheelchairs, oxygen equipment, or hospital beds prescribed for home use. DME suppliers must be approved by insurance plans for coverage. They provide equipment needed for medical conditions. Home Health Agency. An organization that provides healthcare services in patients' homes, including nursing care, therapy, and personal care. Home health agencies must be licensed and certified for Medicare and insurance coverage. They enable care at home rather than in facilities. Hospice provider. An organization that provides end-of-life care focused on comfort and quality of life rather than curative treatment. Hospice providers offer medical care, pain management, and emotional support for terminally ill patients. Coverage is available under Medicare, Medicaid, and most insurance plans. Skilled Nursing Facility, SNF. A healthcare facility providing skilled nursing care and rehabilitation services for patients who need daily nursing care but not hospital-level treatment. SNFs bridge the gap between hospital and home. Coverage typically requires a qualifying hospital stay. Assisted Living Facility. A residential setting providing personal care services, meals, and activities for individuals who need assistance with daily living but not skilled nursing care. Assisted living facilities offer a home-like environment with support services. Most health insurance doesn't cover assisted living, but long-term care insurance may. Nursing home. A facility providing 24-hour nursing care and assistance with activities of daily living for individuals unable to care for themselves. Nursing homes provide both custodial and skilled care. Long-term care insurance and Medicaid are primary payment sources. Adult Day Care Center. A facility providing daytime supervision, activities, meals, and sometimes healthcare services for seniors or disabled adults who live at home. Adult daycare allows caregivers to work while ensuring loved ones receive care and socialization. Some long-term care policies cover adult daycare. Centers for Medicare and Medicaid Services, CMS. The federal agency that administers Medicare, Medicaid, the Children's Health Insurance Program, HEHIP, and parts of the Affordable Care Act. CMS sets coverage policies, payment rates, and quality standards. It is part of the Department of Health and Human Services. Medicare beneficiary. An individual enrolled in Medicare who is entitled to receive benefits under the program. Medicare beneficiaries are typically age 65 or older, or younger individuals with disabilities or specific conditions. They may have Original Medicare or Medicare Advantage coverage. Medicare Advantage Organization. A private insurance company approved by Medicare to offer Medicare Advantage plans as an alternative to Original Medicare. Medicare Advantage organizations must meet CMS requirements and provide at least the same benefits as Original Medicare. They often include additional benefits like dental and vision. Medicare Supplement Carrier. An insurance company that offers Medigap policies to help pay costs not covered by Original Medicare, such as deductibles and coinsurance. Medicare supplement carriers must follow federal and state regulations on standardized plans. Their policies work alongside Original Medicare. Medicaid Managed Care Organization, MCO. A private company that contracts with state Medicaid programs to provide healthcare services to Medicaid beneficiaries. Medicaid MCOs operate like HMOs with provider networks and care coordination. They receive capitated payments per enrollee. State Health Insurance Assistance Program, RAICP. Free counseling and assistance programs funded by the federal government to help Medicare beneficiaries understand their options and rights. SHIP counselors are trained volunteers who provide unbiased information. Every state has a SHIP program. Qualified Health Plan, QHP. A health insurance plan certified by a health insurance marketplace that meets Affordable Care Act standards for coverage and cost sharing. QHPs cover essential health benefits and meet actuarial value requirements. Only QHPs qualify for premium tax credits and cost-sharing reductions. Coverage trigger. The event or circumstance that activates an insurance policy's obligation to provide coverage for a claim. The coverage trigger determines when a policy responds to a loss and which policy period applies. Different types of insurance use different triggers, such as when an injury occurs, when a claim is made, or when damage is discovered. Occurrence policy. A liability insurance policy that covers claims arising from incidents that occurred during the policy period, regardless of when the claim is actually filed. Occurrence policies provide long-tail coverage because claims can be made years after the policy expires, as long as the incident happened during the policy period. This trigger is common in general liability insurance. Claims-made policy. A liability insurance policy that covers claims only if both the incident and the claim are reported during the policy period or an extended reporting period. Claims-made policies require that the claim be made while the policy is in force, even if the incident occurred earlier. This trigger provides more predictable coverage periods for insurers, but requires careful management during policy changes. Claims made and reported. A type of claims-made policy that requires both the claim to be made against the insured and reported to the insurer during the policy period for coverage to apply. This is the most restrictive form of claims-made coverage, requiring two conditions to be met within the policy period. It provides the narrowest coverage window. Retroactive date. The date specified in a claims-made policy before which incidents are not covered, even if the claim is made during the policy period. The retroactive date limits how far back in time coverage extends for incidents that result in claims during the current policy period. Only incidents occurring on or after the retroactive date and claimed during the policy period are covered. Prior acts coverage. Coverage under a claims-made policy for incidents that occurred before the current policy's inception date, but after the retroactive date. Prior acts coverage extends protection backward in time for older incidents as long as they are first claimed during the current policy period. This coverage is essential when switching between claims-made policies or insurers. Nose coverage. Insurance industry terminology for prior acts coverage, referring to coverage that extends backward from the policy inception date to cover older incidents. The term nose reflects coverage going back in time before the current policy begins. Nose coverage protects against claims arising from past acts. Tail coverage. An extended reporting period that allows claims to be reported after a claims-made policy expires for incidents that occurred during the policy period. Tail coverage extends the time to report claims beyond policy expiration, providing continuing protection for covered incidents. This is essential when discontinuing claims-made coverage or switching insurers. Extended reporting period, ERP. A provision in claims-made policies that allows the insured to report claims for a specified time after the policy expires for incidents that occurred during the policy period. The ERP provides additional time to discover and report claims that arise from covered incidents. It may be included automatically, purchased as an endorsement, or triggered by specific events. Basic extended reporting period. A limited automatic extended reporting period provided in most claims-made policies at no additional charge. The basic ERP typically provides 60 days to report claims after policy expiration and may include a limited time to report incidents that occurred during the policy period. Coverage is limited and automatic upon policy termination. Supplemental extended reporting period. An optional purchased extension that provides longer reporting periods than the basic ERP, often unlimited time. The supplemental ERP must typically be elected and paid for within a short time after policy cancellation or non-renewal. It provides comprehensive tail coverage for an additional premium. Unlimited extended reporting period. An extended reporting period with no time limit on when claims can be reported after policy expiration, as long as incidents occurred during the policy period. Unlimited ERPs provide perpetual tail coverage for past acts. This is the most comprehensive and expensive form of extended reporting coverage. Occurrence trigger. A coverage trigger based on when bodily injury or property damage actually occurs, activating the policy in force at that time. The occurrence trigger has been the traditional trigger for liability insurance and determines coverage based on timing of the injury or damage. Multiple policies may respond if injury occurs over time, spanning different policy periods. Injury in fact trigger. A coverage trigger based on when actual bodily injury or property damage first takes place, regardless of when it is discovered or manifests symptoms. This trigger focuses on the objective moment of injury occurrence. It is similar to the occurrence trigger, but emphasizes the actual injury event. Manifestation trigger. A coverage trigger based on when injury or damage becomes apparent or is discovered rather than when the harmful exposure occurred. The manifestation trigger activates the policy in force when symptoms appear or damage is first evident. This trigger has been applied in cases involving latent diseases or hidden property damage. Exposure trigger. A coverage trigger that activates policies in force during all periods when the claimant was exposed to harmful conditions, even if injury manifested later. The exposure trigger can result in multiple policy periods responding to a single claim. This trigger is often applied in asbestos and environmental claims where exposure occurred over many years. Continuous trigger. A coverage trigger theory holding that all policies in force from initial exposure through manifestation of injury are triggered and share responsibility for the claim. The continuous trigger spreads liability across multiple insurers and policy periods. Courts have applied this trigger in long-tail liability claims involving progressive injury. Triple trigger. A coverage trigger theory that activates policies in force during exposure, during injury in fact, and during manifestation. The triple trigger maximizes available coverage by potentially invoking multiple policy periods. It has been applied in some jurisdictions for environmental and occupational disease claims. Discovery trigger. A coverage trigger based on when a loss is discovered rather than when it occurred. Discovery triggers are common in fidelity bonds, crime insurance, and errors and omissions policies where losses may not be immediately apparent. The policy in force, when the loss is discovered, responds to the claim. Loss occurrence trigger. Another term for occurrence trigger, emphasizing that coverage is determined by when the loss event happens. The loss occurrence trigger ties coverage to the timing of the actual loss-causing incident. This is the traditional trigger for most property and liability insurance. Batch clause. A provision in products' liability policies defining multiple claims from the same product defect or from a single production lot as one occurrence. The batch clause limits the insured's exposure by capping claims from related products at one occurrence limit. It prevents each individual claim from a defective batch from being treated as a separate occurrence. Single occurrence. The treatment of multiple injuries or damages arising from the same event or continuous conditions as one occurrence for purposes of applying policy limits and deductibles. Determining what constitutes a single occurrence affects how much coverage is available. Courts analyze the cause, time, and location of events to determine if they constitute one occurrence or multiple occurrences. Multiple occurrences. Separate events or distinct causes of loss that are each treated as individual occurrences for insurance purposes. Multiple occurrences trigger separate per-occurrence limits and deductibles. Distinguishing multiple occurrences from a single occurrence is often a complex coverage issue. Number of occurrences. The determination of how many separate occurrences exist for a series of injuries or damages which directly impacts the amount of available coverage. The number of occurrences affects both the total limits available and the number of deductibles that apply. This is often a disputed issue in complex claims. Accident. A sudden, unexpected, and unintended event that causes injury or damage. In insurance, accident is often used interchangeably with occurrence, though some policies define them differently. The accidental nature of an event is essential for coverage under most policies that exclude intentional acts. Fortuitous event. An occurrence that happens by chance or accident rather than by intention or through the insured's deliberate action. Fortuity is a fundamental principle of insurance. Only unintended losses are insurable. Insurance does not cover losses the insured intentionally causes or expects to occur. Named peril coverage. Insurance that provides coverage only for specific perils explicitly listed in the policy. Under named peril coverage, if a loss results from a cause not specifically listed, no coverage exists. The insured bears the burden of proving the loss resulted from a covered peril. Specified peril coverage. Another term for named peril coverage, emphasizing that only enumerated perils trigger coverage. Specified peril policies list each covered cause of loss explicitly. Any peril not specified is automatically excluded from coverage. Open peril coverage. Insurance that covers all causes of loss except those specifically excluded in the policy. Open peril coverage provides broader protection than named peril coverage because the insurer must prove an exclusion applies, rather than the insured having to prove a peril is covered. This coverage is also called all-risk coverage, despite not covering absolutely all risks. All-risk coverage. An alternative term for open peril coverage, indicating coverage for all causes of loss unless specifically excluded. Despite the name, all-risk policies still contain exclusions and do not cover literally every possible risk. The term has fallen out of favor due to its potential to mislead insureds. Special peril coverage. Another term sometimes used for open peril coverage, particularly in older policy forms. Special peril coverage responds to all causes of loss except those excluded. The term distinguishes this broader coverage from basic or broad-named peril forms. Direct physical loss. Actual tangible damage to or destruction of property, as opposed to intangible or economic loss. Most property insurance requires direct physical loss to trigger coverage. The requirement of physical loss or damage distinguishes covered property claims from pure financial losses. Physical damage. Tangible harm to property that alters its physical condition or structure. Physical damage is typically required to trigger property insurance coverage. The damage must be observable and affect the property's physical state, not merely its value or usefulness. Ensuing loss. Damage that results as a consequence of an initial loss, which may be covered even if the initial cause is excluded. Ensuing loss provisions allow coverage for resulting damage from an excluded peril if the ensuing damage itself is from a covered cause. For example, fire resulting from earthquake might be covered as an ensuing loss, even if earthquake is excluded. Resulting loss. Damage that follows from or is caused by a prior event, similar to ensuing loss. Resulting loss provisions may provide coverage for secondary effects even when the initial cause is not covered. The connection between the excluded cause and the resulting covered loss must be analyzed. Proximate cause. The primary or predominant cause of a loss, which determines whether coverage applies. When multiple causes contribute to a loss, the proximate cause is the efficient, dominant, or moving cause that sets events in motion. Courts look to proximate cause to determine which peril triggered the loss for coverage purposes. Efficient proximate cause. The doctrine that when multiple perils contribute to a loss, the predominant or most important cause determines coverage. The efficient proximate cause is the primary force that sets the chain of events in motion. This doctrine helps resolve coverage disputes when both covered and excluded perils contribute to a loss. Concurrent causation. A situation where two or more independent causes combine to produce a loss, with one cause covered and another excluded. Concurrent causation creates coverage disputes about whether the loss should be paid. Some policies contain anti-concurrent causation clauses, excluding losses where any contributing cause is excluded. Sequential causation. A situation where one peril follows another in a chain of events leading to loss. Sequential causation involves analyzing which cause was proximate and whether ensuing loss provisions apply. The sequence and relationship between causes affects coverage determination. Independent causes. Multiple perils that contribute to a loss but operate separately rather than one causing the other. When independent concurrent causes exist, coverage analysis must determine whether both must be covered for the loss to be paid. The relationship between causes affects how coverage applies. Dependent causes. Perils that are related in a causal chain where one cause leads to or triggers another. Dependent causes are analyzed using proximate cause and ensuing loss principles. The causal relationship between perils determines which policy provisions apply. Anti-concurrent causation clause. A policy provision stating that coverage is excluded if any contributing cause of the loss is excluded, even if other contributing causes are covered. Anti-concurrent causation clauses eliminate coverage disputes about concurrent causes by making any excluded cause determinative. These clauses are controversial, and their enforceability varies by jurisdiction. Actual cash value, ACV. A valuation method that determines payment based on replacement cost minus depreciation for age, wear, and tear. ACV represents the property's market value or depreciated value at the time of loss. This settlement method results in lower payments than replacement cost because it accounts for the property's used condition. Replacement cost. A valuation method that provides payment to repair or replace damaged property with new property of like kind and quality without deduction for depreciation. Replacement cost coverage pays the full cost to replace property at current prices. This settlement method provides more comprehensive recovery than actual cash value. Functional replacement cost. A valuation method that pays to replace property with functionally equivalent property that may not be identical to the original. Functional replacement cost allows substitution of modern materials or methods that serve the same purpose. This approach is practical when exact replacement is impractical or unavailable. Depreciation. The reduction in property value over time due to age, wear and tear, deterioration, or obsolescence. Depreciation is deducted from replacement cost to determine actual cash value. The amount of depreciation depends on the property's age, condition, and expected useful life. Recoverable depreciation. The difference between replacement cost and actual cash value that can be recovered by the insured after repairs are completed. Under replacement cost policies, insurers often initially pay ACV, then pay recoverable depreciation once the insured completes repairs. This approach ensures the insured actually replaces the damaged property. Non-recoverable depreciation. Depreciation that is deducted from a claim payment and not refunded to the insured even after repairs. Non-recoverable depreciation occurs under actual cash value policies where depreciation is permanently deducted. The insured absorbs this loss in value. Market value. The price property would sell for in the open market between a willing buyer and willing seller. Market value reflects what others would pay for the property in its current condition. This valuation method may be used in actual cash value determinations or for certain types of property. Fair market value. The price at which property would change hands between a willing buyer and willing seller, both having reasonable knowledge of relevant facts. Fair market value is an objective measure based on market conditions. It is used for valuation in some insurance settlements and in establishing insurable values. Agreed amount. A settlement method where the insurer and insured agree on the value of a loss rather than using a predetermined valuation method. Agreed amount settlements resolve valuation disputes through negotiation. The agreed amount becomes the basis for payment. Stated value. A valuation approach where the insured declares the value of property, but payment is limited to the lesser of the stated value or the actual loss at the time of claim. Stated value provides a maximum payment amount but does not guarantee that amount will be paid. Actual cash value or replacement cost may be lower than the stated value. Agreed value coverage. A valuation method where the insurer and insured agree on property value when the policy is issued and that value is paid in case of total loss. Agreed value eliminates valuation disputes by establishing value upfront. This method is common for classic cars, fine arts, and other hard-to-value property. Blanket limit. A single limit of insurance that applies to multiple items, locations, or categories of property rather than separate limits for each. Blanket limits provide flexibility by allowing the full amount to apply wherever loss occurs. The total coverage is shared among all covered property under the blanket. Specific limit. A separate limit designated for particular property, locations, or types of coverage, rather than shared with other property. Specific limits allocate coverage amounts to individual items or categories. Each specific limit applies only to its designated property. Schedule coverage. Insurance that lists individual items with specific coverage amounts for each item. Scheduled coverage itemizes property with individual values, ensuring adequate coverage for each piece. This approach is used for valuable items like jewelry, fine arts, or specialized equipment. Unscheduled coverage. Insurance that covers categories of property without itemizing individual pieces, typically with sublimits or special limits. Unscheduled coverage provides broader, simpler coverage, but may have lower limits for certain property types. Most personal property is covered on an unscheduled basis. Floater policy. Insurance that covers property regardless of its location, moving with the property as it travels. Floater policies are designed for property that is frequently moved or not kept at a fixed location. The coverage floats with the property wherever it goes within the coverage territory. Inland marine coverage. Insurance for property in transit over land, property in the custody of bailees, movable equipment, and other specialized property. Despite its name, inland marine coverage applies to land-based property with certain characteristics like mobility or specialized nature. It evolved from ocean marine insurance to cover property moving across land. Personal property floater. A policy providing all-risk coverage for personal property both at home and away, typically with higher limits than standard homeowners coverage. Personal property floaters cover valuables like jewelry, cameras, and fine arts wherever they are taken. Coverage follows the property and is usually written on an open peril basis. Scheduled personal property. Individual items of personal property specifically listed in a policy with separate amounts of insurance for each. Scheduled personal property receives broader coverage and higher limits than unscheduled property. Items are described and valued individually. Pair or set clause. A policy provision addressing how loss is paid when one item from a matched pair or set is damaged or destroyed. The pair or set clause typically limits payment to a proportional value of the pair or set, the cost to replace the damaged item, or the cost to repair the pair or set. It prevents paying the full value when only part of a pair or set is lost. Matching coverage. Insurance that pays the additional cost to replace undamaged property when damaged items cannot be matched due to discontinuation, obsolescence, or other reasons. Matching coverage ensures aesthetic or functional consistency when partial losses occur. This addresses situations where replacing only damaged items would result in mismatched appearance. Building ordinance coverage. Insurance for the increased costs resulting from enforcement of building codes or ordinances when repairing or rebuilding damaged property. This coverage addresses costs to bring property up to current building codes, demolish undamaged portions required by law, and increased construction costs due to code requirements. Standard policies often exclude ordinance or law coverage, making this endorsement important. Increased cost of construction. Additional expenses incurred to repair or rebuild property to meet current building codes, energy standards, or other requirements beyond simple replacement. These costs arise when codes have changed since the original construction. Coverage for increased construction costs typically requires special endorsement. Law and ordinance coverage. Another term for building ordinance coverage, addressing costs to comply with laws regulating construction or repair. Law and ordinance coverage provides three types of protection. Loss to the undamaged portion of a building when ordinance requires demolition, demolition costs, and increased cost of construction to meet current codes. Each coverage may have separate limits. Demolition cost coverage. Insurance for the expense of tearing down undamaged portions of a building when required by law after partial damage. Demolition cost coverage applies when building codes require complete demolition, even though parts of the building were not damaged by the covered peril. This cost is typically excluded under standard property policies. Guaranteed replacement cost. A coverage enhancement that pays the full cost to rebuild or replace property, even if it exceeds the policy limit. Guaranteed replacement cost removes the policy limit for rebuilding, providing complete protection against construction cost increases. This coverage typically requires the property to be insured at 100% of estimated replacement cost and may have percentage caps. Extended replacement cost. Coverage that increases the policy limit by a specified percentage, commonly 25% to 50%, for repair or replacement when costs exceed the stated limit. Extended replacement cost provides a cushion above the policy limit but caps the additional amount. It offers partial protection against underinsurance or cost increases. Modified replacement cost. A settlement approach that pays replacement cost but allows substitution of materials or methods to reduce costs while maintaining similar functionality and appearance. Modified replacement cost permits practical alternatives to exact replacement. This balances complete restoration with cost management. Cash settlement. Payment of a claim in money rather than through repair or replacement of damaged property. Cash settlements give the insured freedom to decide how to use the proceeds. The insured receives the payment and handles restoration independently. Repair or replace option. The insurer's right under some policies to choose whether to pay for loss in cash, repair the property, or replace it with similar property. This option gives the insurer flexibility in claim settlement. If exercised, the insurer must fully restore the insured's interest. Actual repair or replacement. A requirement in some replacement cost policies that property must actually be repaired or replaced for the insured to receive full replacement cost payment. Until actual repair or replacement occurs, payment is limited to actual cash value. This ensures replacement cost coverage is used for its intended purpose. Betterment: an improvement in the condition, quality, or value of property compared to its condition before loss. When repairs result in betterment, the insured may be required to pay for the improvement beyond restoring the original condition. Insurance covers restoration, not upgrades, though replacement cost coverage may result in some betterment. Loss assessment coverage: insurance that pays the insured's share of assessments charged by a condominium or homeowners association for property damage to common areas. Loss assessment coverage protects unit owners from having to pay their portion of large claims affecting shared property. This coverage supplements the association's master policy. Ordinance or law increased limit: additional insurance specifically purchased to cover the extra costs imposed by enforcement of building ordinances or laws. This increased limit supplements standard coverage limits to address code compliance costs. The additional limit applies specifically to ordinance or law exposures. Spoilage coverage: insurance for loss of property due to change in temperature or contamination, typically covering food, pharmaceuticals, or other perishable goods. Spoilage coverage pays when refrigerated property spoils due to equipment breakdown, power outage, or other covered causes. This specialized coverage addresses time-sensitive and temperature-sensitive property. Utility services coverage: insurance for losses caused by interruption of utility services to the insured premises from causes occurring off the premises. Utility services coverage extends protection beyond the insured location to include damage caused by water, power, gas, or communication service failures originating elsewhere. Standard property policies typically exclude these indirect losses. Newly acquired or constructed property coverage: automatic insurance extension for property purchased or buildings constructed during the policy period. This coverage provides automatic protection for a specified time and up to a stated limit, preventing gaps while the insured arranges to increase coverage. Reporting requirements apply to maintain ongoing coverage. Personal effects coverage: insurance for personal belongings of the insured or others while at the insured's location or in the insured's care. Personal effects coverage typically applies to items like clothing, luggage, or personal property of employees, customers, or guests. Coverage is often limited and subject to sublimits. Outdoor property coverage: insurance for property located outside of buildings, such as fences, landscaping, signs, or outdoor equipment. Outdoor property coverage typically has special limits and may cover only specified perils rather than open perils. Certain types of outdoor property may be excluded entirely from standard policies. Fine arts coverage: specialized insurance for paintings, sculptures, antiques, collectibles, and other artistic property. Fine arts coverage typically provides broader protection than standard property policies and may use agreed value or scheduled coverage. This coverage addresses the unique valuation and handling needs of art. Manuscript coverage: custom insurance specifically designed for unique or hard-to-insure property or exposures. Manuscript coverage features policy language tailored to specific situations rather than using standard forms. It provides flexibility for unusual risks requiring specialized terms. Difference in conditions, DIC. A policy that fills gaps in standard property coverage by insuring against perils excluded from underlying policies, typically on an all-risk basis. DIC policies commonly cover flood, earthquake, and other catastrophic perils excluded from standard coverage. They provide comprehensive backup protection. All other perils coverage, a section of property insurance that provides open peril coverage for causes of loss not otherwise specifically addressed. This coverage responds to any peril not excluded and not covered under other specific sections of the policy. It serves as catch-all protection. Perils of the sea. specific ocean-related causes of loss covered under marine insurance, including heavy weather, stranding, sinking, collision, and other maritime perils. Perils of the sea are fortuitous events unique to water navigation. This coverage is fundamental to ocean marine insurance. Comprehensive coverage. In auto insurance, coverage for physical damage to the insured vehicle from causes other than collision, such as theft, vandalism, fire, or weather. Despite the name, comprehensive coverage is actually named peril coverage in most policies. The term distinguishes this coverage from collision coverage. Collision coverage. Insurance for physical damage to the insured vehicle resulting from impact with another vehicle or object, or from vehicle overturn. Collision coverage applies regardless of fault. It is typically written with a deductible and pays up to the actual cash value of the vehicle. Specified causes of loss. A coverage form listing specific covered perils, typically including fire, lightning, explosion, windstorm, hail, smoke, aircraft, vehicles, riot, vandalism, sprinkler leakage, sinkhole collapse, and volcanic action. This is a named peril form commonly used in commercial property insurance. It provides broader coverage than basic form, but narrower than special form. Broad causes of loss. A coverage form that includes all perils in the specified causes of loss form, plus additional perils such as falling objects, weight of snow or ice, and water damage from certain sources. This form represents middle-tier coverage between specified causes and special causes of loss. It is less commonly used than the other two forms. Special causes of loss. A coverage form providing open peril coverage subject to policy exclusions. The special causes of loss form covers all direct physical loss except perils specifically excluded. This is the broadest standard commercial property coverage form. Basic causes of loss. The most limited named peril form, typically covering fire, lightning, explosion, windstorm, hail, smoke, aircraft, vehicles, riot, civil commotion, vandalism, sprinkler leakage, sinkhole collapse, and volcanic action. Basic causes of loss provides fundamental coverage at the lowest cost. It is the starting point for property coverage. Direct damage coverage. Insurance for physical loss or damage to the insured's own property from covered perils. Direct damage coverage protects the insured's property interests. This is the primary coverage provided by property insurance policies. Indirect damage coverage. Insurance for consequential losses that result from physical damage, such as business income loss or extra expenses. Indirect damage coverage addresses financial impacts beyond the physical property damage. It requires an underlying direct physical loss to trigger coverage. Time element coverage. Insurance for losses that accumulate over time following a covered property damage event, such as business interruption or rental value. Time element coverage measures loss by duration rather than specific dollar amounts of property damage. The longer operations are interrupted, the greater the loss. Non-time element coverage. Property insurance for losses measured by specific amounts rather than duration, such as direct property damage. Non-time element coverage pays for concrete, measurable losses like destroyed buildings or stolen equipment. Payment is based on the value of damaged property, not the time to recover. Term life insurance. Life insurance providing coverage for a specified time period, the term, such as 10, 20, or 30 years, that pays a death benefit only if the insured dies during the term. Term life insurance has no cash value and is the most affordable type of life insurance. Coverage ends when the term expires unless renewed or converted. Permanent life insurance. Life insurance designed to provide coverage for the insured's entire lifetime as long as premiums are paid, with both a death benefit and cash value accumulation. Permanent life insurance includes whole life, universal life, and variable life policies. It costs more than term insurance, but builds cash value. Whole life insurance. A type of permanent life insurance with level premiums, guaranteed death benefit, and guaranteed cash value accumulation. Whole life insurance provides lifelong coverage with predictable costs and values. Dividends may be paid if it's a participating policy. Universal life insurance, a flexible permanent life insurance policy allowing adjustable premiums and death benefits with cash value earning interest based on current rates. Universal life insurance provides transparency with separate mortality charges and interest credits. Policyholders can adjust coverage within limits. Variable life insurance. Permanent life insurance where cash value is invested in separate accounts similar to mutual funds, with investment risk borne by the policyholder. Variable life insurance offers investment growth potential, but values fluctuate with market performance. Death benefits and cash values are not guaranteed. Variable universal life insurance, a combination of universal life and variable life insurance offering flexible premiums, adjustable death benefits, and investment choices through separate accounts. Variable universal life insurance provides maximum flexibility, but highest risk. Both premiums and investments can be adjusted. Indexed universal life insurance. Universal life insurance where cash value growth is linked to a stock market index like the S&P 500, typically with a guaranteed minimum interest rate and a cap on maximum returns. Indexed universal life insurance offers market participation with downside protection. Returns are credited based on index performance. Level term insurance. Term life insurance with a death benefit that remains constant throughout the policy term. Level term is the most common term insurance structure. Premiums may be level or increase at policy anniversary. Decreasing term insurance. Term life insurance, where the death benefit decreases over time according to a predetermined schedule while premiums remain level. Decreasing term insurance is often used to cover mortgages or other debts that decrease over time. It is less expensive than level term. Increasing term insurance. Term life insurance, where the death benefit increases over time, often to keep pace with inflation. Increasing term insurance protects against erosion of purchasing power. Premiums typically increase as the death benefit grows. Renewable term insurance. Term life insurance that can be renewed at the end of the term without providing evidence of insurability. Renewable term insurance allows continuation of coverage, but premiums increase at each renewal based on attained age. Renewability periods are limited, often to age 70 or 80. Convertible term insurance. Term life insurance that can be exchanged for permanent insurance without evidence of insurability. Convertible term insurance allows upgrading to whole life or universal life. Conversion must occur within specified timeframes and results in higher premiums. Return of premium term insurance. Term life insurance that returns all premiums paid if the insured survives the policy term. Return of premium term costs significantly more than standard term, but eliminates the use it or lose it feature. No return occurs if the policy lapses before term end. Group term life insurance. Term life insurance provided by employers or associations covering multiple individuals under one master policy. Group term life insurance typically doesn't require medical underwriting and may be provided at low or no cost to employees. Coverage often equals 1 or 2 times annual salary. Supplemental life insurance. Additional life insurance coverage offered through an employer beyond the basic group life insurance amount. Supplemental life insurance allows employees to purchase extra coverage, often requiring evidence of insurability above guaranteed issue amounts. Premiums may be paid entirely by employees. Voluntary life insurance. Life insurance offered through an employer that employees can choose to purchase with premiums paid entirely through payroll deduction. Voluntary life insurance is optional coverage at group rates. It may cover employees, spouses, and dependents. Dependent life insurance. Life insurance coverage on family members, spouse and children of the primary insured, typically offered as a rider or through group plans. Dependent life insurance provides smaller death benefits for dependents. It's often included with employee group coverage or available as an option. Credit life insurance. Life insurance that pays off a borrower's debt if they die before the loan is repaid. Credit life insurance is typically sold with mortgages, auto loans, or credit cards. The lender is the beneficiary, and coverage decreases as the loan is paid down. Mortgage life insurance, a type of decreasing term life insurance designed to pay off a mortgage if the insured dies. Mortgage life insurance decreases as the mortgage balance decreases. The death benefit typically goes to the mortgage lender, or can be structured to go to beneficiaries. Final expense insurance, small whole life insurance policies, typically $5,000 to $25,000, designed to cover funeral and burial costs. Final expense insurance usually requires no medical exam and has simplified underwriting. It provides quick access to funds for end-of-life expenses. Burial insurance, another term for final expense insurance, specifically emphasizing coverage for funeral and burial costs. Burial insurance may be offered by funeral homes or insurance companies. It ensures funds are available for final expenses. Simplified issue life insurance, life insurance that requires answering health questions but no medical exam for approval. Simplified issue life insurance has streamlined underwriting, making it faster to obtain. Coverage amounts and age limits are typically restricted. Guaranteed issue life insurance, life insurance that accepts all applicants without medical questions or exams, regardless of health status. Guaranteed issue life insurance typically has lower coverage limits, higher premiums, and graded death benefits. It serves those unable to qualify for traditional coverage. Graded death benefit, a policy feature where the full death benefit is not paid if death occurs within a specified period, typically 2 or 3 years, after policy issue. Graded death benefits pay only return of premium, or a percentage of the face amount for early deaths. They protect insurers from adverse selection in guaranteed issue policies. Modified death benefit, a death benefit structure where full benefits are not paid for certain causes of death during an initial period. Modified death benefits are similar to graded benefits, but may apply only to specific causes like illness, while paying full benefits for accidental death. They manage risk in simplified underwriting. Accidental death and dismemberment, AD&D. Insurance that pays benefits if the insured dies or loses limbs, eyesight, or other body parts due to an accident. A D&D pays the full benefit for death and percentage of the benefit for specified losses. It supplements life insurance, but pays only for accidental causes. Major medical insurance, comprehensive health insurance designed to cover significant healthcare expenses, including hospitalization, surgery, and other major medical costs. Major medical insurance typically has deductibles and coinsurance, but provides broad coverage. It is the foundation of health insurance protection. Comprehensive health insurance, health insurance providing broad coverage for many types of medical services, including preventive care, hospitalization, surgery, and prescription drugs. Comprehensive health insurance covers essential health benefits under the Affordable Care Act. It provides complete protection against healthcare costs. Catastrophic health insurance, high-deductible health insurance designed to protect against very high medical costs while keeping premiums low. Catastrophic health insurance covers essential health benefits after the deductible is met. It's available only to those under 30 or with hardship exemptions. High-deductible health plan, HDHP. A health insurance plan with higher deductibles and lower premiums than traditional plans, often paired with health savings accounts. HDHPs must meet IRS-defined minimum deductible and maximum out-of-pocket limits. They encourage cost-conscious healthcare decisions. Hospital indemnity insurance, supplemental insurance that pays a fixed dollar amount for each day of hospitalization, regardless of actual costs. Hospital indemnity insurance provides cash benefits directly to the insured to cover expenses not paid by major medical insurance. Benefits can be used for any purpose. Critical illness. Insurance that pays a lump sum benefit upon diagnosis of specified serious illnesses such as cancer, heart attack, or stroke. Critical illness insurance provides cash to cover medical expenses, lost income, or any other needs during serious illness. The benefit is paid regardless of actual medical costs. Specified disease insurance. Insurance that covers expenses related to a particular disease, such as cancer or heart disease. Specified disease insurance supplements major medical coverage for defined conditions. It pays benefits only for the named disease. Cancer insurance. A type of specified disease insurance covering expenses related to cancer diagnosis and treatment. Cancer insurance pays benefits for cancer-related costs that may not be fully covered by major medical insurance. It provides additional financial support during cancer treatment. Disability income insurance. Insurance that replaces a portion of income when the insured is unable to work due to illness or injury. Disability income insurance typically pays 50 to 70% of pre-disability earnings during the benefit period. It protects against income loss from disability. Short-term disability insurance. Disability insurance providing income replacement for temporary disabilities, typically lasting from a few weeks to 1 year. Short-term disability insurance has short elimination periods, often 7 to 14 days, and limited benefit periods. It covers brief absences from work. Long-term disability insurance. Disability insurance providing income replacement for extended disabilities lasting more than 1 year or until retirement age. Long-term disability insurance has longer elimination periods, often 90 to 180 days, but extended benefit periods. It protects against prolonged inability to work. Own occupation disability. Disability coverage that pays benefits if the insured cannot perform the duties of their specific occupation, even if they could work in another capacity. Own occupation disability provides the most comprehensive protection, especially for specialized professionals. It is more expensive than other definitions. Any occupation disability. Disability coverage that pays benefits only if the insured cannot perform the duties of any occupation for which they are reasonably qualified by education, training, or experience. Any occupation disability is more restrictive and less expensive than own occupation coverage. It is harder to qualify for benefits. Residual disability. Disability coverage that pays partial benefits when the insured can work but suffers income loss due to reduced hours or duties. Residual disability provides proportional benefits based on income loss percentage. It encourages return to work while still providing support. Partial disability. Disability coverage paying reduced benefits when the insured can perform some but not all duties of their occupation. Partial disability typically follows a period of total disability. Benefits are less than total disability benefits. Total disability. The inability to perform the substantial and material duties of one's occupation, own occupation, or any occupation, depending on the policy definition. Total disability is the primary benefit trigger in disability insurance. It must meet policy-specific criteria. Presumptive disability. Certain severe conditions that automatically qualify as total disability, regardless of whether the insured can actually work, such as loss of sight, hearing, speech, or 2 limbs. Presumptive disability provisions guarantee benefits for catastrophic losses. They eliminate the need to prove inability to work. Long-term care insurance. Insurance covering the cost of long-term care services, such as nursing home care, assisted living, or home health care, when the insured cannot perform activities of daily living. Long-term care insurance addresses extended care needs not covered by health insurance or Medicare. It protects against catastrophic long-term care costs. Nursing home coverage. Long-term care insurance benefits for care provided in skilled nursing facilities. Nursing home coverage typically provides the maximum daily benefit amount. It addresses the most expensive long-term care setting. Home health care coverage. Long-term care insurance benefits for care provided in the insured's home by healthcare professionals or aides. Home health care coverage typically pays a percentage of the nursing home daily benefit. It allows care in preferred settings. Adult day care coverage. Long-term care insurance benefits for supervision and activities provided at adult daycare centers. Adult daycare coverage supports caregivers who work while providing daytime care for insureds. Benefits are typically a percentage of the daily benefit amount. Respite care coverage. Long-term care insurance benefits providing temporary relief for family caregivers by paying for substitute care. Respite care coverage allows family caregivers to rest or attend to other matters. It's typically limited to a certain number of days per year. Alternate plan of care. A long-term care insurance provision allowing payment for services not specifically listed in the policy if they are more cost-effective or appropriate than covered services. Alternate plans of care provide flexibility to meet individual needs. Insurers must approve the alternative arrangement. Coordination of benefits in long-term care. Provisions determining how long-term care insurance works with other coverage sources like Medicare, Medicaid, or other insurance. Coordination of benefits prevents duplicate payment and may reduce benefits when other sources pay. It ensures appropriate use of all available coverage. Partnership long-term care policy. Long-term care insurance certified under state partnership programs that allows policyholders to protect assets equal to benefits paid from Medicaid estate recovery. Partnership policies must meet specific requirements and provide inflation protection. They offer Medicaid asset protection. Nursing facility only policy. Long-term care insurance covering only care provided in nursing homes, excluding home care and other settings. Nursing facility only policies are less expensive, but provide narrower coverage. They address only institutional care. Comprehensive long-term care policy. Long-term care insurance covering care in all settings including nursing homes, assisted living, home care, and adult daycare. Comprehensive policies provide the broadest coverage and greatest flexibility. They are more expensive, but most versatile. Dental insurance. Coverage for dental care expenses including preventive services, basic procedures, and major services. Dental insurance typically has separate deductibles, coinsurance, and annual maximums from medical insurance. It may be offered through employers or purchased individually. Vision insurance. Coverage for eye care services and eyewear, including eye exams, glasses, and contact lenses. Vision insurance typically provides coverage for routine eye care rather than medical eye conditions. It often has low annual maximums and copayments for services. Medicare Part A. Hospital insurance under Medicare, covering inpatient hospital care, skilled nursing facility care, hospice, and home health services. Medicare Part A is premium-free for most beneficiaries with sufficient work history. It has deductibles and coinsurance. Medicare Part B. Medical insurance under Medicare covering physician services, outpatient care, preventive services, and durable medical equipment. Medicare Part B requires monthly premiums based on income. It has an annual deductible and 20% coinsurance. Medicare Part C. Medicare Advantage plans offered by private insurers as an alternative to original Medicare, combining Part A, Part B, and usually Part D with additional benefits. Medicare Part C plans operate like HMOs or PPOs with networks. They often include dental, vision, and other extra benefits. Medicare Part D. Prescription drug coverage under Medicare provided through private insurance plans. Medicare Part D is optional, but recommended to avoid late enrollment penalties. Plans have formularies, deductibles, and coverage phases, including the donut hole. Medigap. Supplemental insurance sold by private companies to help pay costs not covered by original Medicare, such as deductibles, coinsurance, and copayments. Medigap policies are standardized and identified by letters, Plan A, B, C, etc. They work only with original Medicare, not Medicare Advantage. Medicare Supplement Insurance. Another term for Medigap, emphasizing that these policies supplement original Medicare coverage. Medicare Supplement Insurance fills gaps in Medicare. It requires separate premiums beyond Medicare Part B premiums. Medicaid. A joint federal and state program providing health coverage for low-income individuals and families, including children, pregnant women, elderly, and disabled persons. Medicaid eligibility and benefits vary by state. It also covers long-term care for qualified individuals. Children's Health Insurance Program, CHIP. A program providing low-cost health coverage for children and families that earn too much to qualify for Medicaid but cannot afford private insurance. CHIP is administered by states following federal guidelines. Coverage and eligibility vary by state. TRICARE. The healthcare program for uniformed service members, retirees, and their families, offering several plan options. TRICARE is the Department of Defense's health insurance program. It supplements care at military treatment facilities. Veterans Affairs, VA, health benefits. Healthcare services provided to eligible military veterans through the Department of Veterans Affairs. VA health benefits are based on service-connected disabilities and other factors. They are provided through VA medical centers and clinics. COBRA coverage. Continuation health coverage available to employees and dependents who lose group coverage due to qualifying events, as required by the Consolidated Omnibus Budget Reconciliation Act. COBRA allows temporary continuation of coverage by paying the full premium plus a small administrative fee. It typically lasts 18 or 36 months, depending on the qualifying event. Conversion coverage. The right to convert group insurance to individual coverage when leaving the group, typically without evidence of insurability. Conversion coverage ensures continuity when group coverage ends. The individual policy may have different benefits and higher premiums. Limited benefit plan. Health insurance with significant restrictions on coverage, such as caps on specific services, exclusions for major conditions, or low overall limits. Limited benefit plans are less expensive, but provide inadequate protection against major medical expenses. They don't meet Affordable Care Act standards for minimum essential coverage. Mini-Med Plan. A type of limited benefit plan providing minimal health coverage with low annual or lifetime maximums. Mini-Med plans were common before the Affordable Care Act, but don't meet current coverage requirements. They offer limited protection against healthcare costs. Short-term health insurance. Temporary health coverage designed to fill brief gaps in coverage, typically lasting less than 12 months. Short-term health insurance doesn't cover pre-existing conditions or essential health benefits. It's not ACA compliant and provides limited protection. Fixed indemnity health insurance. Insurance that pays a predetermined amount for specific services or conditions regardless of actual costs. Fixed indemnity health insurance pays set benefits directly to the insured. It supplements major medical coverage but doesn't satisfy individual mandate requirements. Gap coverage. Supplemental insurance designed to pay expenses not covered by primary health insurance, such as deductibles and copayments. Gap coverage fills financial gaps in major medical insurance. Hospital indemnity and critical illness policies are types of gap coverage. Supplemental health insurance. Additional insurance purchased to complement major medical coverage by paying costs not covered by the primary policy. Supplemental health insurance includes hospital indemnity, critical illness, accident, and specified disease policies. It provides extra financial protection. Premium calculation. The process of determining the amount an insured must pay for insurance coverage based on rating factors, exposure measures, and underwriting considerations. Premium calculation applies rate formulas to specific risk characteristics to arrive at the final premium. The calculation considers coverage types, limits, deductibles, and individual risk factors. Rating. The process of calculating insurance premiums using established formulas, statistics, and risk factors. Rating applies mathematical methods to determine appropriate charges for coverage based on expected losses and expenses. Rates must be adequate, not excessive, and not unfairly discriminatory. Rate. The cost of insurance per unit of exposure, such as per $100 of coverage, per vehicle, or per $1,000 of payroll. The rate is multiplied by the number of exposure units to determine the base premium. Rates are developed using actuarial analysis of loss data and are typically filed with and approved by insurance regulators. Manual rate. The standard rate published in rating manuals for a particular class of risk before individual risk modifications are applied. Manual rates provide starting points based on broad classifications. These base rates are then adjusted for specific risk characteristics. Base rate. The foundational rate used as a starting point in premium calculation before applying modifiers, credits, or debits. The base rate reflects the standard charge for a particular type and class of coverage. Individual risk factors then modify this base to arrive at the final premium. Class rate. A rate that applies to all risks within a defined classification or category. Class rates group similar risks together and charge all members of the class the same base rate. Individual variations within the class may lead to modifications, but the starting rate is uniform. Composite rate. A single blended rate that applies to all exposures for a risk, regardless of individual classifications within that risk. Composite rates simplify premium calculation by combining multiple classifications into one rate. This approach is often used for convenience in packaging coverage. Experience rating. A rating method that adjusts premiums based on the insured's own loss history and claims experience. Experience rating rewards insureds with good loss records through lower premiums and penalizes those with poor records. The insured's past experience is considered predictive of future losses. Experience modification factor, MOD. A multiplier applied to standard premiums based on an insured's loss experience compared to similar risks. An experience mod above 1.0 increases premiums due to worse-than-average losses, while a mod below 1.0 decreases premiums for better-than-average experience. This factor makes the insured's actual losses directly affect their premium. Merit rating. A rating adjustment based on individual risk characteristics, loss control efforts, or favorable features that reduce loss potential. Merit rating rewards insureds who demonstrate lower risk through premium credits. This recognizes positive risk attributes beyond just loss history. Schedule rating. A rating system that allows underwriters to adjust premiums up or down based on specific risk characteristics using a standardized schedule of credits and debits. Schedule rating evaluates factors like management quality, employee training, safety programs, and premises conditions. Each factor has a permitted range of adjustment. Judgment rating. A rating method where underwriters use their professional judgment and experience to set premiums for unique or hard-to-classify risks. Judgment rating is used when insufficient statistical data exists or when risks have unusual characteristics. The underwriter's expertise determines the appropriate rate. Retrospective rating. A rating plan where the final premium is determined after the policy period ends based on the insured's actual losses during that period. Retrospective rating adjusts premiums to reflect actual loss experience, subject to minimum and maximum limits. The insured essentially shares in their own losses and gains. Minimum premium. The lowest premium amount the insured will pay under a retrospective rating plan, regardless of how favorable the loss experience is. The minimum premium protects the insurer's need to cover fixed costs and maintain a minimum return. It sets a floor on the retrospective premium adjustment. Maximum premium. The highest premium amount the insured will pay under a retrospective rating plan, regardless of how unfavorable the loss experience is. The maximum premium caps the insured's financial exposure and provides certainty about worst-case premium costs. It limits the upward adjustment in retrospective plans. Standard premium. The premium that would be charged using standard manual rates without experience rating, schedule rating, or other individual modifications. Standard premium serves as the basis for calculating experience modification factors and retrospective adjustments. It represents the unmodified charge for the risk class. Auditable premium. Premium that is subject to adjustment based on an audit of actual exposures after the policy period ends. Auditable premiums use estimated exposures initially, then adjust based on actual payroll, sales, or other exposure measures. The final premium reflects what actually occurred during the policy period. Audit, an examination of the insured's records after the policy period to determine the actual exposure basis and calculate final premium. Audits verify reported information and identify changes in exposures that affect premium. Physical audits examine business records, while phone or mail audits gather information remotely. Premium audit, the specific process of reviewing an insured's financial and operational records to determine correct final premium based on actual exposures. Premium audits examine payroll records, sales receipts, inventory, square footage, or other exposure measures depending on the type of coverage. Additional premium may be owed or refunds due based on audit findings. Additional premium, money owed by the insured to the insurer when the actual premium, often determined by audit, exceeds the estimated premium paid at policy inception. Additional premium results from increased exposures, coverage changes, or audit findings. The insured must pay this amount to satisfy the policy obligation. Return premium, money owed by the insurer to the insured when estimated premium paid exceeds the actual earned premium, often due to cancellation, reduced exposures, or audit findings. Return premium represents overpayment that must be refunded to the policyholder. It may result from mid-term policy changes or final audit adjustments. Earned premium, the portion of premium that corresponds to insurance coverage already provided. Premium is earned as time passes during the policy period or as exposure units are used. Earned premium represents the insurer's compensation for risk assumed and cannot be refunded if the policy is canceled. Unearned premium reserve, the liability on an insurer's balance sheet representing premium collected but not yet earned because coverage extends into the future. The unearned premium reserve ensures the insurer has funds to return if policies are canceled or to cover future claims. This reserve represents the insurer's obligation to provide future coverage. Written premium, the total premium for all policies issued by an insurer during a specified period, regardless of the policy effective dates or coverage periods. Written premium is a key measure of an insurer's business volume. It represents new and renewal policies written during the measurement period. Direct written premium, premium written directly by an insurer on policies it issues, excluding reinsurance assumed from other insurers. Direct written premium measures the insurer's own production from its policyholders. This metric excludes reinsurance transactions that can distort volume measurements. Net written premium, premium written by an insurer minus premiums ceded to reinsurers. Net written premium represents the premium the insurer retains after reinsurance. This is the premium for risk the insurer keeps rather than transferring to reinsurers. Deposit premium, an initial premium payment made at policy inception based on estimated exposures, subject to adjustment. Deposit premiums are used when final premium depends on variables that won't be known until later, such as actual payroll or sales. The deposit provides initial payment, while recognizing final premium will be determined by audit. Estimated premium, a provisional premium calculated using the insured's estimates of exposure units for the policy period. Estimated premium is charged initially for policies subject to audit, with final premium determined after actual exposures are known. Estimates should be as accurate as possible to avoid large adjustments. Advance premium, premium paid before coverage begins to secure insurance protection. Advance premium ensures the insurer receives payment up front before assuming risk. Most insurance requires advance payment of at least the initial premium installment. Flat premium, a fixed premium amount that does not vary based on exposures or experience during the policy period. Flat premiums provide certainty about cost and simplify administration. They are used when exposure units are relatively stable or when risks are too small to justify variable rating. Installment premium, premium paid in multiple periodic payments throughout the policy period rather than as a single lump sum. Installment premiums make coverage more affordable by spreading payments over time, typically monthly or quarterly. The insurer may charge fees or interest for this payment option. Minimum earned premium. The smallest amount of premium an insurer will retain if a policy is cancelled, regardless of how short the coverage period was. Minimum earned premiums compensate the insurer for issuance costs and the risk assumed. They are typically expressed as a percentage of the annual premium or a flat dollar amount. Short rate premium. The premium retained by an insurer when the insured cancels the policy before expiration, calculated using a short rate table that includes a penalty. Short rate calculations reduce the return premium below the pro rata amount to compensate the insurer for administrative costs and disruption. The penalty discourages mid-term cancellation by insureds. Pro rata premium. Premium calculated proportionally based on the actual time coverage was in force. Pro rata calculations divide annual premium by 365 days and multiply by the number of days covered. This method is used when insurers cancel policies or when calculating earned premium without penalty. Premium finance. A lending arrangement where a third party lends money to the insured to pay insurance premiums, with the insured repaying the loan with interest. Premium finance allows insureds to obtain coverage while spreading payments over time. The finance company typically holds the policy as collateral. Finance charge. Interest and fees charged by a premium finance company for lending money to pay insurance premiums. Finance charges increase the total cost of insurance when premiums are financed. These charges are regulated and must be disclosed to borrowers. Premium to surplus ratio. A financial measure comparing an insurer's net written premium to its policyholder's surplus, indicating the volume of business relative to capital. A ratio above 3:1 may indicate the insurer is writing too much business for its capital base. This ratio helps assess whether an insurer has adequate capital to support its volume. Exposure unit. A measure of the insured risk used as the basis for premium calculation, such as per vehicle, per $100 of property value, per $1,000 of payroll, or per square foot. Exposure units quantify the amount of risk insured. Premium is calculated by multiplying the rate by the number of exposure units. Exposure base. The measure used to determine the number of exposure units, such as payroll, sales, area, or number of items. The exposure base must accurately reflect the risk so premium aligns with loss potential. Different types of insurance use different exposure bases. Payroll. The total compensation paid to employees used as an exposure base for workers' compensation and some liability insurance. Payroll correlates with exposure since more employees and higher wages generally indicate greater operations and risk. Premium is calculated by applying rates to each $100 of payroll by classification. Sales. The total revenue from goods or services sold, used as an exposure base for some liability and crime insurance. Sales reflect the volume of business activity and associated exposure. Premium rates are applied per $1,000 or other unit of sales. Square footage. The area of a building or premises measured in square feet, used as an exposure base for some property and liability insurance. Square footage correlates with the amount of property exposed to loss and activity level. Rates are applied per 100 or 1,000 square feet. Number of units. A count of discrete items insured, such as vehicles, buildings, or employees, used as an exposure base. The number of units directly measures exposure quantity. Premium is calculated by multiplying a rate per unit times the number of units. Increased limits factor. A multiplier applied to base rates to determine premium for higher liability limits. Increased limits factors reflect that doubling the limit does not double expected losses, since most claims fall well below even basic limits. Factors increase less than proportionally to limit increases. Classification. The categorization of a risk into a group with similar characteristics for rating purposes. Classifications group similar exposures together so they can be charged similar rates. Common classifications include business type, construction class, or vehicle use. Class code. A numeric or alphanumeric identifier assigned to a specific risk classification for rating purposes. Class codes standardize how similar risks are identified and rated across the insurance industry. Each code corresponds to a specific type of business, operation, or exposure. Standard Industrial Classification, SIC. A system of numeric codes classifying businesses by industry type, formerly used widely for insurance rating. SIC codes categorize business activities into hierarchical groups. This classification system has largely been replaced by NAICS codes, but some insurers still reference SIC codes. North American Industry Classification System, NAICS. A standardized system of codes classifying businesses by industry, replacing SIC codes and used for insurance rating and underwriting. NAICS provides more detailed and current business classifications. Insurance companies use NAICS codes to identify business types and apply appropriate rates. Tier, a rating category based on risk characteristics, with different tiers receiving different premium levels. Tiered rating groups risks into levels such as preferred, standard, and non-standard. Each tier has its own rate structure reflecting the expected loss experience of that group. Rate Manual, a publication or database containing rates, rules, and classifications for insurance pricing. Rate manuals provide the information underwriters and rating specialists need to calculate premiums. Manuals may be printed books or electronic systems. Rating Bureau, an organization that collects loss data, develops rates, and creates policy forms for use by multiple insurance companies. Rating bureaus provide rating and statistical services to member insurers. ISO, Insurance Services Office, is the largest rating bureau in the United States. Loss cost, the portion of premium intended to cover expected claim payments, excluding insurer expenses, profit, and other loadings. Loss costs represent pure premium based on historical loss data. Insurers add expense loads and profit margins to loss costs to determine full rates. Pure premium, the amount needed to pay expected losses without any addition for expenses or profit. Pure premium equals total expected losses divided by total exposure units. It is the foundation of premium calculation before loadings are added. Expense loading, the amount added to pure premium to cover the insurer's operating expenses, including acquisition costs, administrative expenses, and claims handling. Expense loading ensures premium is sufficient to cover all costs of providing insurance, not just claim payments. Typical expense loads range from 25% to 40% of premium. Acquisition cost, expenses incurred to acquire new business, including agent commissions, marketing costs, and underwriting expenses. Acquisition costs are higher for new policies than renewals. These costs are built into the expense loading portion of premium. Underwriting expense, costs associated with evaluating risks, issuing policies, and managing the underwriting function. Underwriting expenses include salaries of underwriting staff, inspection costs, and administrative overhead. These expenses are recovered through the expense portion of premium. Loss adjustment expense, LAE. Costs incurred by the insurer to investigate, defend, and settle claims beyond the actual claim payments. LAE includes adjuster salaries, legal fees, expert witnesses, and investigation costs. These expenses are tracked separately from loss payments but must be funded by premium. Allocated loss adjustment expense, ALAE. Loss adjustment expenses that can be directly assigned to specific claims, such as defense attorney fees or expert witness costs for a particular case. ALAE is tracked by individual claim. These expenses are directly attributable to settling specific losses. Unallocated loss adjustment expense, ULAE. Loss adjustment expenses that cannot be assigned to specific claims, such as claims department overhead or general adjuster salaries. ULAE represents the general cost of maintaining claims operations. These expenses are allocated across all claims collectively. Combined ratio, a key insurance profitability measure calculated as the sum of the loss ratio and expense ratio. A combined ratio below 100% indicates underwriting profit, while above 100% indicates underwriting loss. This ratio measures the insurer's total cost of providing coverage relative to premium earned. Loss ratio, the percentage of premium consumed by claim payments, calculated as incurred losses divided by earned premium. Loss ratio measures how much premium revenue is paid out in claims. A 60% loss ratio means 60 cents of every premium dollar goes to pay claims. Expense ratio, the percentage of premium consumed by operating expenses, calculated as underwriting expenses divided by written premium. Expense ratio measures the insurer's efficiency in operating the business. Lower expense ratios indicate more efficient operations. Underwriting profit, the profit or loss from insurance operations alone, excluding investment income, calculated as earned premium minus incurred losses and expenses. Underwriting profit is positive when the combined ratio is below 100%. Many insurers operate at an underwriting loss, but profit overall through investment income. Underwriting gain, another term for underwriting profit, emphasizing positive results from insurance operations. Underwriting gain occurs when premium collected exceeds losses and expenses paid. This represents profit from the insurance transaction itself. Underwriting loss, a negative result when losses and expenses exceed earned premium in insurance operations. Underwriting losses are common in competitive markets or after catastrophes. Insurers may sustain underwriting losses while relying on investment income for overall profitability. Investment income, earnings generated from investing premium collected before claims are paid, including interest, dividends, and capital gains. Investment income is a significant source of insurer profitability. The time lag between collecting premium and paying claims allows insurers to invest and earn returns. Float, the premium funds held by an insurer between collection and payment of claims, which can be invested to generate income. Float represents interest-free use of money. The longer the period between premium collection and claim payment, the more valuable the float. Incurred losses, the total of all claim payments made plus reserves established for unpaid claims during a specified period. Incurred losses represent the insurer's total liability for claims from a period, including both paid and expected future payments. This is a key measure of claim activity. Paid losses, the actual dollar amount paid out for claims during a specified period. Paid losses represent cash that has left the insurer to settle claims. This differs from incurred losses, which also include reserves for claims not yet paid. Retention, the amount of risk or loss that the insured keeps and does not transfer to the insurer. Retention can take the form of deductibles, self-insured retentions, or uninsured exposures. Higher retention reduces premium by shifting more risk to the insured. Self-insured retention, SIR, a specified dollar amount of loss that the insured must pay before the insurance policy begins to cover the claim. Unlike a deductible, the insurer has no obligation to pay the SIR amount, and the insured handles claims within the SIR. SIRs are common in commercial liability policies. Deductible amount, the specific dollar value the insured must pay out of pocket for each covered loss before insurance coverage applies. The deductible reduces premium by eliminating small claims and reducing insurer exposure. Higher deductibles result in lower premiums. Per occurrence deductible, a deductible that applies separately to each individual loss event or occurrence. Each time a covered loss occurs, the insured pays the deductible before insurance responds. Multiple losses in a policy period each trigger separate deductibles. Annual deductible, a deductible that applies on a cumulative basis for all losses during the policy year. Once total losses reach the annual deductible amount, the insurer covers subsequent losses in full. Annual deductibles benefit insureds with multiple small losses. Aggregate deductible, a total deductible amount applied to all losses combined during the policy period. The insured pays all losses until the aggregate deductible is satisfied, after which the insurer covers subsequent losses. This shifts more risk to the insured than per-occurrence deductibles for multiple losses. Percentage deductible. A deductible expressed as a percentage of the insured value or loss amount rather than a flat dollar amount. Percentage deductibles are common for catastrophe perils like earthquakes or hurricanes. A 5% deductible on a $200,000 building means the insured pays the first $10,000 of any loss. Flat deductible. A fixed dollar amount deductible that applies regardless of the size of the loss or value of insured property. Flat deductibles are simpler to understand and apply than percentage deductibles. The insured knows exactly how much they will pay for any loss. Disappearing deductible. A deductible that reduces or disappears entirely as the size of the loss increases. Disappearing deductibles use a formula where the deductible decreases proportionally as losses grow larger. At a certain loss level, the deductible disappears, and the insurer pays the full loss. Franchise deductible. A deductible where if the loss exceeds the deductible amount, the entire loss is paid with no deduction. If the loss is less than the franchise amount, nothing is paid. This is an all-or-nothing deductible used primarily in ocean marine insurance. Waiting period. A time period after coverage begins during which no benefits are payable. Waiting periods are common in business interruption insurance, where a certain number of hours or days must pass before coverage begins. This eliminates claims for very brief interruptions. Elimination period. Another term for waiting period, indicating a period that must be eliminated or pass before benefits begin. Elimination periods reduce premium by removing coverage for short-term losses. Longer elimination periods result in lower premiums. Time deductible. A deductible expressed in hours or days rather than dollars, common in business interruption insurance. The insured absorbs loss for the specified time period before coverage begins. A 72-hour time deductible means the first 3 days of business interruption are not covered. Coinsurance percentage. The percentage of property value to which the insured must carry insurance to avoid a coinsurance penalty. Common coinsurance percentages are 80%, 90%, or 100%. The insured must insure property to at least this percentage of its actual value at the time of loss. Amount of insurance carried. The actual limit of insurance purchased by the insured on property subject to coinsurance. This is compared to the required amount, coinsurance percentage times property value, to determine if a coinsurance penalty applies. If the amount carried is less than required, the insured becomes a co-insurer. Amount of insurance required. The minimum amount of insurance the insured should carry under the coinsurance clause, calculated as the coinsurance percentage multiplied by the property value at the time of loss. If the insured carries less than this required amount, a coinsurance penalty reduces claim payment. This requirement encourages adequate insurance to value. Coinsurance formula. The mathematical calculation used to determine claim payment when coinsurance applies. Amount of insurance carried divided by amount of insurance required times loss amount equals payment, subject to policy limit. This formula proportionally reduces payment when the insured is underinsured. The insured shares in the loss due to inadequate coverage. Coinsurance deficiency. The shortfall when the amount of insurance carried is less than the amount required by the coinsurance clause. A coinsurance deficiency triggers a penalty that reduces claim payment. The greater the deficiency, the larger the penalty. Co-payment. A fixed dollar amount the insured pays for covered services or losses, separate from deductibles. Co-payments are common in health insurance, but less common in property and casualty insurance. Each service or claim may require a separate co-payment. Out-of-pocket maximum. The maximum total amount the insured must pay during a policy period through deductibles, co-payments, and coinsurance. Once the out-of-pocket maximum is reached, the insurer pays 100% of additional covered expenses. This caps the insured's financial exposure. Stop-loss limit. A threshold above which an insurer or reinsurer begins covering losses, or below which the insured's retention stops accumulating. Stop-loss provisions cap the insured's or ceding company's exposure to losses. Once the stop-loss limit is reached, additional losses are fully covered. Policy limit aggregate. The total maximum amount the insurer will pay for all claims combined during the policy period. Once the aggregate limit is exhausted, no further coverage exists regardless of additional losses. Aggregate limits cap the insurer's total exposure under the policy. Per claim limit. The maximum amount payable for any single claim, regardless of the number of claimants or amount of damages. The per claim limit caps payment for individual claims. Multiple claims each have their own per claim limit available. Sublimit. A limitation within the overall policy limit that restricts coverage for specific types of property, perils, or losses. Sublimits cap payment for categories that need limited coverage. They operate within and cannot exceed the overall policy limit. Coverage limit. The maximum amount an insurance policy will pay for covered losses, which may be expressed per occurrence, per person, per policy period, or for specific types of coverage. Coverage limits define the insurer's maximum financial obligation. The insured is responsible for losses exceeding applicable limits. Limit of liability. Another term for coverage limit, specifying the maximum amount the insurer will pay under the policy. The limit of liability caps the insurer's exposure. Multiple limits may apply depending on the type of loss and policy structure. Each occurrence limit. The maximum amount payable for all damages arising from a single occurrence or event. The each occurrence limit applies per event, regardless of the number of injured parties or types of damages. It represents the most the insurer will pay for any one incident. Products completed operations. Aggregate. A separate aggregate limit, applying specifically to bodily injury and property damage, included in the product's completed operations hazard. This aggregate applies independently from the general aggregate limit. It provides a dedicated pool of coverage for products and completed work exposures. General aggregate limit. The maximum amount an insurer will pay for all covered claims during the policy period, except those subject to separate aggregates like products completed operations. The general aggregate applies to most liability claims. It is distinct from per occurrence limits. Attachment point. The loss level at which excess insurance or reinsurance begins to provide coverage. The attachment point is the threshold that must be exceeded before higher layer coverage responds. It equals the exhaustion point of underlying coverage. Corridor. A gap or retention between layers of insurance coverage where the insured bears loss. Corridors require the insured to pay amounts above one layer's limit before the next layer attaches. They create deductible-like retentions between coverage layers. Layer. A segment of insurance coverage between specified limits, particularly in excess insurance or reinsurance. Insurance programs may have multiple layers stacked vertically, each providing additional coverage above the layer below. Each layer has an attachment point and limit. First, dollar coverage. Insurance that pays from the first dollar of loss without any deductible or retention. First dollar coverage provides immediate payment when a covered loss occurs. It is the most comprehensive approach, but also the most expensive. Ultimate net loss. The total amount the insured is obligated to pay for claims, including all expenses, after recovery from other insurance or reinsurance. Ultimate net loss represents the insured's bottom line liability. It is used in reinsurance to define what losses are covered. Loss reserve. An estimate of the amount an insurer will ultimately pay for reported claims that have not yet been settled. Loss reserves represent the insurer's liability for known claims. Reserves are adjusted as more information becomes available about claim values. Case reserve. A loss reserve established for a specific claim based on the adjuster's evaluation of that individual case. Case reserves estimate what a particular claim will cost to settle. They are adjusted as the claim develops. IBNR reserve. Incurred but not reported reserve, an estimate of the liability for losses that have occurred but have not yet been reported to the insurer. IBNR reserves account for losses the insurer will eventually pay but doesn't yet know about. These reserves are calculated using statistical methods and historical data. Bulk reserve. An aggregate reserve for a group of claims rather than reserves set for individual cases. Bulk reserves estimate total liability for categories of claims. They are used when individual case reserving is impractical. Outstanding loss reserve. The total of all reserves for claims reported but not yet fully paid. Outstanding reserves represent the insurer's estimate of what will be paid on known claims. This appears as a liability on the insurer's balance sheet. Salvage value. The value of damaged property that the insurer can recover through sale after paying a total loss claim. Salvage reduces the insurer's net loss. The insurer typically takes ownership of salvage when paying full value for totally damaged property. Subrogation recovery. Money recovered by an insurer from responsible third parties after paying a claim to its insured. Subrogation recoveries offset losses and improve the insurer's loss ratio. The insurer steps into the insured's shoes to pursue recovery from liable parties. Salvage and subrogation. The combined recoveries an insurer receives from salvage sales and subrogation collections. These recoveries reduce net incurred losses. They are tracked separately from premium income. Loss development. The change in loss estimates over time as claims mature and more information becomes available. Loss development reflects that initial reserves often differ from ultimate paid amounts. Development factors predict how current reserves will change before claims are closed. Loss development factor. A multiplier applied to current loss estimates to project ultimate losses based on historical patterns of how claims develop. Loss development factors recognize that current reserves will increase or decrease before final settlement. These factors are derived from historical data. Ultimate loss. The total amount that will be paid for a claim or group of claims when all payments are complete. Ultimate loss is the final settled amount, as opposed to estimates or reserves. Projecting ultimate losses is essential for pricing and reserving. Frequency. The number of claims or losses occurring during a specified period, typically expressed per exposure unit. Frequency measures how often losses happen. It is one of two key components of expected losses, along with severity. Severity. The average cost per claim or loss. Severity measures how large losses are when they occur. Together with frequency, severity determines total loss costs. Expected loss. The anticipated amount of losses based on frequency and severity predictions. Expected loss equals frequency times severity. Insurers use expected loss to price coverage and establish reserves. Loss trend. The rate at which losses are increasing or decreasing over time due to inflation, changes in legal climate, or other factors. Loss trend must be considered in pricing to ensure future claims can be paid from current premiums. Trends are expressed as annual percentage changes. Trend factor. A multiplier applied to historical losses to project future loss costs. Trend factors adjust past data for inflation, social inflation, and other changes affecting claim costs. They ensure rates reflect current and expected future loss levels. Credibility. The statistical reliability of data used in rating, with more data being more credible. Credibility determines how much weight to give an insured's own experience versus class experience. Large insureds with extensive loss history have high credibility. Credibility factor. A percentage applied to determine how much weight to assign an insured's experience versus class average in rating. A credibility factor of 0.5 means the insured's experience counts 50% and class average 50%. Higher credibility factors give more weight to individual experience. Large loss loading. An additional charge added to premiums to account for the potential of catastrophic or unusually large claims. Large loss loading recognizes that severe claims have disproportionate impact. This loading protects insurers from shock losses. Catastrophe loading. Premium added to cover the insurer's exposure to catastrophic events like hurricanes, earthquakes, or widespread disasters. Catastrophe loading reflects low-frequency but high-severity events. Models predict catastrophe costs which are spread across all insureds in exposed areas. Risk load, an amount added to expected losses to account for uncertainty and variance in outcomes. Risk loading compensates the insurer for volatility and potential adverse deviation from expected results. It provides a margin for statistical uncertainty. Profit and contingencies loading, the portion of premium intended to provide profit to the insurer and a cushion for contingencies. This loading ensures the insurer earns a return on capital invested and has margins for unexpected events. It typically ranges from 2% to 10% of premium. Target loss ratio, the percentage of premium an insurer expects to pay out in losses, used as a goal in pricing. If an insurer targets a 60% loss ratio, rates are set expecting 60 cents of each dollar to pay claims. The remaining 40% covers expenses and profit. Permissible loss ratio, the maximum loss ratio an insurer can sustain while covering expenses and earning a profit at current rates. If actual loss ratios exceed the permissible loss ratio, rates must increase. This measure helps determine when rate changes are needed. Break-even point, the premium level at which an insurer neither profits nor loses money on insurance operations. At the break-even point, premium exactly equals losses plus expenses. This represents the minimum premium needed to cover costs. Minimum rate, the lowest rate an insurer can charge while meeting regulatory requirements and covering expected costs. Minimum rates prevent destructive competition that could threaten insurer solvency. Regulators may establish minimum rates, or insurers may set their own floors. Rate adequacy, the extent to which premium rates are sufficient to cover expected losses, expenses, and provide a reasonable profit. Adequate rates ensure insurer solvency and ability to pay claims. Regulators review rates for adequacy. Rate competitiveness, the relationship between an insurer's rates and market rates, affecting the insurer's ability to attract and retain business. Competitive rates are priced to win business while remaining adequate. Balancing competitiveness with adequacy is a key challenge. Indicated rate change, the percentage increase or decrease in rates suggested by actuarial analysis to achieve target profitability. Indicated rate changes are based on loss trends, expense changes, and profit goals. Actual rate changes may differ from indications due to competitive or regulatory factors. Rate filing, the submission of proposed rates and supporting documentation to insurance regulators for review and approval. Rate filings must demonstrate that rates are adequate, not excessive, and not unfairly discriminatory. The approval process varies by state. Rate approval, the regulatory authorization allowing an insurer to use proposed rates. Some states require prior approval before using new rates, while others allow file and use or use and file. Rate approval ensures rates meet regulatory standards. Rate deviation, the percentage by which an insurer's rates differ from filed bureau rates or previous rates. Rate deviations allow insurers to compete while using standard base rates. They may be uniform deviations or vary by coverage or territory. Expense constant, a flat dollar amount added to policies to cover minimum costs of issuing coverage, regardless of premium size. Expense constants ensure small policies bear their share of fixed costs. They prevent small premium policies from being underpriced relative to issuance costs. Policy fee, a separate charge added to the premium to cover administrative costs of issuing and servicing the policy. Policy fees are typically flat amounts and may not be refundable if the policy is canceled. They compensate for expenses not covered by percentage-based charges. Service charge, a fee for specific services provided, such as policy changes, payment processing, or certificate issuance. Service charges allow insurers to recover costs for elective services. They are separately stated from premium. Installment fee, a charge assessed when premiums are paid in installments rather than in full at inception. Installment fees cover the administrative cost and carrying charges of allowing payment over time. They make the installment option pay for itself. Cancellation fee, A charge imposed when a policy is canceled before its expiration date to cover administrative costs of the cancellation. Cancellation fees may be retained even when unearned premium is refunded. They discourage frequent policy changes. Premium waiver. A policy feature that eliminates the requirement to pay premiums under specified circumstances, such as during disability. Premium waivers keep policies in force without payment when the insured cannot afford premiums due to qualifying conditions. Coverage continues as if premiums were being paid. Level premium funding. A premium payment method where the same amount is paid throughout the life of the policy, with early premiums exceeding the cost of insurance to build reserves for later years. Level premium funding allows permanent life insurance to remain affordable in older ages. It creates the cash value component. Attained age premium. A premium rate based on the insured's current age rather than issue age. Attained age premiums increase as the insured gets older. They are common in renewable term insurance and some Medicare supplement policies. Issue age premium. A premium rate based on the insured's age when the policy was first issued, remaining constant thereafter. Issue age premiums are common in permanent life insurance and some Medicare supplement policies. They don't increase with age. Community rating. A premium setting method where all individuals in a geographic area pay the same rate regardless of age, health status, or other individual characteristics. Community rating spreads costs across the entire community. It was required for small group and individual plans under the Affordable Care Act before age-based adjustments were allowed. Adjusted community rating. A modified community rating method allowing premium variation based on limited factors such as age, tobacco use, geographic location, and family size. Adjusted community rating is required for ACA-compliant individual and small group plans. Health status cannot be a rating factor. Experience rating in health insurance. Setting premiums for group health insurance based on the group's actual claims history and utilization. Experience rating rewards groups with favorable claims experience through lower premiums. Larger groups typically receive experience rating, while small groups receive community rates. Age banding. The practice of grouping ages into ranges for premium rating purposes rather than rating each age individually. Age banding simplifies rating while still reflecting age-related cost differences. Bands may span single years or multiple years. Tobacco rating. The premium surcharge applied to tobacco users in health insurance, which can be up to 50% higher than non-tobacco user rates under the Affordable Care Act. Tobacco rating reflects increased health risks and costs associated with tobacco use. Cessation programs may eliminate the surcharge. Family tier rating. A premium structure in health insurance where rates differ based on coverage tier, such as employee only, employee plus spouse, employee plus child, (ren), or family. Family tier rating reflects the number of covered individuals. It simplifies administration compared to per-person pricing. Composite rate. A single blended premium rate for all employees in a group regardless of age, family status, or other factors. Composite rates simplify administration and ensure equal employer contributions. They are common in small group health insurance. Age-rated premium. A premium that varies based on the insured's age, with older individuals paying more than younger individuals. Age-rated premiums reflect the higher healthcare costs of older people. Individual health and Medicare supplement plans typically use age rating. Guaranteed premium. A premium amount that cannot be changed during a specified period or policy term. Guaranteed premiums provide cost certainty. They are common in non-cancelable disability policies and some life insurance. Adjustable premium. A premium that can be changed by the insurer, typically for an entire class of insureds rather than individual policyholders. Adjustable premiums allow insurers to respond to changing costs and experience. Universal life insurance policies have adjustable premium flexibility. Net amount at risk. The difference between the death benefit and the cash value in a permanent life insurance policy, representing the pure insurance amount. The net amount at risk is what the insurer must pay beyond the accumulated cash value. Mortality charges are based on this amount. Mortality table. A statistical chart showing death rates by age and sex used to calculate life insurance premiums and reserves. Mortality tables predict how many people in each age group will die each year. They are the foundation of life insurance pricing. Morbidity table. A statistical chart showing rates of sickness, disability, and recovery by age used to price health and disability insurance. Morbidity tables predict how many people will become disabled and for how long. They guide disability insurance pricing. Loading. The amount added to the pure cost of insurance, mortality and morbidity costs, to cover insurer expenses, profit, and contingencies. Loading ensures premiums are sufficient for all costs beyond paying claims. It includes acquisition costs, administrative expenses, and profit margins. Policy loan interest. Interest charged on money borrowed from a life insurance policy's cash value. Policy loan interest is typically lower than commercial loan rates and is added to the loan balance if not paid. Unpaid loans with interest reduce the death benefit. Loan provision. The policy feature allowing policyholders to borrow against the cash value of permanent life insurance. Loan provisions specify terms, interest rates, and repayment options. Loans are available without credit checks or approval processes. Automatic premium loan provision. A policy feature that automatically borrows from cash value to pay overdue premiums and prevent lapse. Automatic premium loan provisions protect against unintentional lapse. The borrowed amount plus interest must eventually be repaid. Dividend accumulation. A dividend option where policy dividends are left with the insurance company to accumulate at interest. Dividend accumulations increase the policy's total value and earn additional interest. They can be withdrawn at any time. Vanishing premium. A situation where accumulated dividends and cash value are sufficient to pay future premiums, eliminating the need for out-of-pocket premium payments. Vanishing premium is not guaranteed and depends on continued favorable dividend performance. Actual results may differ from projections. Overfunded policy. A life insurance policy where premiums paid exceed the amount needed to keep the policy in force, creating excess cash value. Overfunded policies build cash value more quickly. They may trigger modified endowment contract tax treatment if overfunded too quickly. Underfunded policy. A life insurance policy where premiums paid are insufficient to maintain coverage to the desired age, risking policy lapse. Underfunded policies require increased premiums or reduced death benefits to remain in force. This is a risk particularly in universal life policies. Policy illustration. A projection showing how a life insurance policy is expected to perform under various assumed scenarios, including premiums, death benefits, cash values, and dividends. Policy illustrations must include guaranteed and non-guaranteed values. They are required disclosure documents in life insurance sales. Guaranteed values, policy benefits and values that are contractually promised and cannot be reduced, such as guaranteed cash value, guaranteed death benefit, or guaranteed premiums. Guaranteed values provide certainty. They represent the minimum the policy will deliver. Non-guaranteed elements. Policy components that may vary based on actual experience, such as dividends, interest credits above minimums, or current cost of insurance charges. Non-guaranteed elements can improve policy performance, but are not assured. Illustrations must distinguish them from guaranteed values. Current assumptions. The interest rates, mortality charges, and expense charges currently being applied to a universal life or variable life policy. Current assumptions may be more favorable than guaranteed maximums. They affect current cash value growth and policy performance. Surrender charge. A fee deducted from cash value when a permanent life insurance policy is surrendered, typically highest in early policy years and declining over time. Surrender charges help insurers recover acquisition costs when policies terminate early. They may disappear after 10 to 20 years. Surrender charge schedule. A table showing the surrender charge percentages or amounts that apply in each policy year. Surrender charge schedules decline over time, eventually reaching zero. They are disclosed in policy illustrations and contracts. Net cash surrender value. The amount available to the policyholder upon policy surrender, equal to the gross cash value minus surrender charges and outstanding policy loans. Net cash surrender value is the actual amount the policyholder receives. It may be significantly less than gross cash value in early years. Gross cash value. The total cash value accumulated in a permanent life insurance policy before any deductions for surrender charges or policy loans. Gross cash value appears in policy statements and illustrations. Deductions reduce the amount actually available. Account value. The current value of the cash component in a universal life or variable life insurance policy, equal to premiums paid plus interest or investment gains, minus charges and withdrawals. Account value is similar to cash value, but used specifically in flexible premium policies. It may differ from surrender value due to surrender charges. Separate account. Investment accounts in variable life insurance and variable annuities where policyholders can allocate funds among various investment options. Separate accounts function like mutual funds with different risk and return profiles. Investment risk is borne by the policyholder. Fixed account. The guaranteed interest account option in variable or indexed universal life insurance, where funds earn a declared interest rate without market risk. Fixed accounts provide stability and principal protection. Returns are lower but guaranteed. Death benefit option. The choice in universal life insurance between a level death benefit, option A, or an increasing death benefit, option B, equal to the face amount plus cash value. Death benefit options affect mortality charges and policy performance. Option A has lower cost but fixed benefits. Level death benefit. A death benefit structure where the total amount paid remains constant, with cash value reducing the net amount at risk. Level death benefits, option A, result in lower mortality charges as cash value grows. The death benefit doesn't increase with cash value accumulation. Increasing death benefit. A death benefit structure where the total amount paid equals the face amount plus the accumulated cash value. Increasing death benefits, option B, maintain a constant net amount at risk and higher mortality charges. Total death benefits grow as cash value accumulates. Corridor test. An IRS requirement that the death benefit of a life insurance policy must maintain a minimum percentage relationship to cash value to retain tax-favored treatment. The corridor test ensures policies remain primarily insurance rather than investments. Ratios decrease with age. Modified endowment contract, MEC. A life insurance policy that fails the 7-pay test and loses some tax advantages, making withdrawals and loans subject to income tax and potential penalties. MECs occur when policies are overfunded too quickly. Death benefits remain tax-free, but living benefits are taxed. 7-pay test. An IRS test determining if cumulative premiums paid in the first 7 policy years exceed limits based on level annual premiums needed to pay up the policy, used to identify modified endowment contracts. Failing the 7-pay test creates MEC status. It prevents excessive tax-favored cash accumulation. Cost of living adjustment, COLA, benefit. A rider or feature automatically increasing benefit amounts periodically based on inflation indices or fixed percentages. COLA benefits protect purchasing power over time. They are common in disability and long-term care insurance. Benefit indexing. Automatic increases in insurance benefits tied to inflation measures or scheduled percentage increases. Benefit indexing maintains real value of coverage over time. It prevents erosion due to inflation. Income replacement ratio. The percentage of pre-disability or pre-retirement income that an insurance policy replaces, typically 50 to 70% in disability insurance. Income replacement ratios balance adequacy with affordability and work incentives. Higher ratios cost more. Maximum monthly benefit. The highest monthly benefit amount available under a disability insurance policy, often subject to limits based on income. Maximum monthly benefits prevent overinsurance and maintain work incentives. They may have dollar caps regardless of income. Benefit formula. The calculation method used to determine insurance benefit amounts, such as percentage of pre-disability income or fixed daily amounts. Benefit formulas vary by policy type and determine payouts. They may include caps and adjustment factors. Indemnity basis. A benefit payment method that reimburses actual expenses incurred up to policy limits. Indemnity basis insurance pays for actual costs. Major medical insurance traditionally used indemnity payment. Service basis. A benefit payment method where the insurer pays providers directly for covered services rather than reimbursing the insured. Service basis insurance simplifies claim payment. HMOs and other managed care plans use service basis payment. Usual, customary, and reasonable, UCR. The maximum amount an insurance plan will pay for a covered service based on what providers typically charge in the area. UCR charges represent the prevailing rates in a geographic area. Amounts above UCR become patient responsibility. Allowed amount. The maximum payment an insurance plan will make for a covered service, which may be based on negotiated rates, fee schedules, or UCR charges. Allowed amounts determine cost-sharing calculations. Providers may bill patients for charges above allowed amounts unless prohibited. Balance billing. The practice of providers billing patients for the difference between their charges and what insurance pays. Balance billing can result in significant out-of-pocket costs when out-of-network providers are used. Some states and programs prohibit balance billing. Surprise billing. Unexpected balance billing that occurs when patients receive care from out-of-network providers without their knowledge or consent, often during emergencies or at in-network facilities. Surprise billing protections limit patient liability in these situations. Federal law now restricts surprise billing. Out-of-pocket cost. Money the insured must pay for healthcare services beyond premiums, including deductibles, co-payments, coinsurance, and non-covered services. Out-of-pocket costs are the patient's share of expenses. Plans limit maximum annual out-of-pocket costs. Out-of-pocket maximum. The most an insured will pay in cost sharing, deductibles, co-payments, coinsurance, during a policy year, after which the plan pays 100% of covered expenses. Out-of-pocket maximums protect against catastrophic costs. Premiums don't count toward this limit. Out-of-pocket limit. Another term for out-of-pocket maximum representing the cap on cost sharing for covered services. Out-of-pocket limits vary by plan and may differ for in-network versus out-of-network care. Essential health benefits must count toward the limit. Embedded deductible. A family deductible structure where each family member has an individual deductible that, when met, triggers coverage for that person, even if the family deductible isn't met. Embedded deductibles protect individuals in families from bearing excessive costs. Once the family deductible is met, all members have coverage. Non-embedded deductible. A family deductible structure requiring the full family deductible to be met before anyone receives coverage beyond individual limits. Non-embedded deductibles require aggregate family spending before benefits begin. One person's costs can satisfy the entire family deductible. Annual deductible. The amount the insured must pay each policy year before insurance benefits begin. Annual deductibles reset at each policy renewal. They encourage cost consciousness and reduce premium costs. Calendar year deductible. A deductible that resets on January 1st each year, regardless of the policy effective date. Calendar year deductibles align with tax years and simplify administration. They are common in employer-sponsored plans. Co-payment, copay. A fixed dollar amount the insured pays for a covered service at the time of service, such as $25 for a doctor visit or $10 for a prescription. Copayments represent predictable cost sharing. They don't count toward deductibles, but do count toward out-of-pocket maximums. Coinsurance. The percentage of covered costs the insured pays after meeting the deductible, such as 20% of allowed charges. Coinsurance represents shared responsibility for costs. It continues until the out-of-pocket maximum is reached. Coinsurance percentage. The specific percentage of costs the insured must pay under coinsurance provisions. Coinsurance percentages typically range from 10% to 50%. Common splits are 80, 20, or 70, 30, plan/patient. Percentage participation. Another term for coinsurance, indicating the percentage split of costs between the insurer and insured. Percentage participation defines cost sharing after deductibles. It represents the insured's portion of covered expenses. Stop-loss amount. The point at which coinsurance ends and the insurer pays 100% of covered expenses, effectively the same as the out-of-pocket maximum. Stop-loss amounts cap the insured's cost sharing. They provide protection against catastrophic expenses. Maximum out-of-pocket. The highest total amount of cost sharing, deductible plus coinsurance plus copayments, the insured pays in a year for covered services. Maximum out-of-pocket protects against unlimited expense. It is capped by law for ACA-compliant plans. Annual out-of-pocket limit. The yearly cap on cost-sharing expenses for covered services under a health plan. Annual out-of-pocket limits reset each policy year. They may differ for individuals versus families. Family out-of-pocket maximum. The total cost-sharing limit for all family members combined under a family health plan. Family out-of-pocket maximums are higher than individual limits. Once reached, all family members have full coverage. Benefit cap. A maximum limit on specific benefits, such as a cap on physical therapy visits or a dollar limit on dental services. Benefit caps restrict coverage for particular services. They may be annual or lifetime limits. Service limit. A restriction on the number of times a specific service is covered per year or per lifetime. Service limits control utilization and costs. Common examples include limits on therapy visits or chiropractic treatments. Visit limit. A cap on the number of provider visits covered for specific services per policy period. Visit limits are common for therapy services, chiropractic care, and mental health services. They restrict frequency of covered care. Internal limit. A coverage restriction within a policy that caps benefits for specific services below the overall policy limit. Internal limits create sublimits for certain benefits. Dental, vision, and therapy services often have internal limits. Lifetime reserve days. A limited number of additional hospital days covered by Medicare Part A beyond the standard benefit period, available once in a lifetime. Lifetime reserve days provide 60 extra days of coverage. Once used, they're not replenished. Spell of illness. A Medicare term for a benefit period beginning with hospitalization and ending when the beneficiary has been out of hospitals and skilled nursing facilities for 60 consecutive days. Spells of illness determine when new deductibles apply. Each spell resets benefit days. Coverage gap. The period in Medicare. Part D prescription drug coverage, the donut hole, where beneficiaries pay higher percentages of drug costs after initial coverage ends but before catastrophic coverage begins. Coverage gaps create cost-sharing spikes. The donut hole has been gradually closing under recent reforms. Donut hole. The informal name for the Medicare Part D coverage gap where beneficiaries face higher out-of-pocket costs for prescriptions. The donut hole occurs after initial coverage limits are reached. Legislation has reduced this gap over time. Catastrophic coverage. The phase of Medicare. Part D or other insurance where the plan pays nearly all costs after the beneficiary reaches a high out-of-pocket threshold. Catastrophic coverage protects against extremely high drug costs. Cost sharing becomes minimal. True out-of-pocket costs, TROOP. actual money spent by the Medicare Part D beneficiary, or on their behalf, that counts toward reaching catastrophic coverage. TROOP includes deductibles, coinsurance, and copayments, but excludes premiums. Reaching the TROOP threshold triggers catastrophic coverage. Income-related monthly adjustment amount, IRMAA. An additional premium charged to higher-income Medicare beneficiaries for Part B and Part D coverage. IRMAA surcharges are based on tax return income from 2 years prior. They increase premiums for wealthier beneficiaries. Late enrollment penalty. A permanent premium increase for enrolling in Medicare, Part B or Part D after the initial enrollment period without creditable coverage. Late enrollment penalties continue for life. They equal a percentage of the base premium for each year of delay. Creditable coverage. Prescription drug coverage that is at least as good as standard Medicare Part D coverage, which prevents late enrollment penalties if maintained continuously. Creditable coverage includes many employer and union plans. Proof must be provided to avoid penalties. First notice of loss, FNOL. The initial report to the insurance company that a covered loss has occurred, triggering the claims process. FNOL provides basic information about when, where, and how the loss occurred and may be made by phone, online, or in writing. Prompt first notice is typically a policy condition and allows the insurer to begin investigation immediately. Loss report. The formal notification and documentation of a loss submitted to the insurer. Loss reports contain details about the incident, damages, injuries, and circumstances surrounding the loss. Complete and accurate loss reports facilitate efficient claims handling. Claim report. Another term for loss report, emphasizing the formal claim being made for benefits or compensation. Claim reports document the insured's demand for payment under the policy. They initiate the insurer's obligation to investigate and respond. Proof of loss. A formal, often sworn statement documenting the details of a loss and the amount being claimed. Proof of loss is typically required by policy conditions and must be submitted within a specified time frame. It provides the insurer with detailed information needed to evaluate the claim. Sworn statement. A statement made under oath attesting to the truth of the information provided. Sworn statements may be required as part of proof of loss or during claim investigations. Making false statements under oath can void coverage and result in criminal penalties. Examination under oath, EUO. A formal proceeding where the insured or claimant answers questions under oath about a loss or claim. The insurer has the right to conduct an EUO as a policy condition. Testimony is recorded and can be used in coverage determinations or litigation. Recorded statement. A statement given by the insured, claimant, or witness that is audio or video recorded for claim investigation purposes. Recorded statements preserve testimony and can be reviewed later. They are less formal than examinations under oath, but still serve as important evidence. Written statement. A statement provided in writing describing the circumstances, damages, or other aspects of a claim. Written statements may be handwritten, typed, or emailed and become part of the claim file. They document what parties knew and said at specific times. Claim investigation. The process of gathering facts, evidence, and documentation to evaluate coverage and determine the cause and extent of a loss. Claim investigations may include inspecting damaged property, interviewing witnesses, reviewing records, and consulting experts. Thorough investigation ensures accurate claim handling. Scene inspection. An examination of the location where a loss occurred to assess damages, determine causation, and gather evidence. Scene inspections allow adjusters to see firsthand the extent of damage and circumstances of the loss. Photos and notes document findings. Property inspection. An examination of damaged property to assess the extent of loss, determine repair costs, and verify coverage. Property inspections involve measuring, photographing, and documenting damage. Adjusters may bring contractors or appraisers to evaluate repair or replacement needs. Damage assessment. The evaluation of the extent and cost of property damage resulting from a covered loss. Damage assessments determine what repairs are needed and what they will cost. Accurate assessments ensure proper claim settlements. Cause of loss determination. The investigation process to identify what peril caused the damage and whether it is covered under the policy. Determining cause of loss is essential for coverage decisions. Multiple potential causes may need to be analyzed. Coverage determination. The insurer's decision about whether a claim is covered under the policy based on investigation findings. Coverage determinations analyze whether the loss falls within the policy's grant of coverage and is not excluded. This decision precedes any payment. Coverage position. The insurer's stated position on whether and to what extent coverage applies to a claim. The coverage position may be communicated through reservation of rights letters or coverage denial letters. It establishes the insurer's stance on the claim. Reservation of rights. A written notice from the insurer to the insured stating that the company is investigating or defending a claim but reserves the right to deny coverage later if investigation reveals non-coverage. Reservation of rights letters protect the insurer from waiving coverage defenses while the claim is evaluated. They allow claims handling to proceed without prejudicing coverage issues. Reservation of rights letter. The formal written communication providing notice that the insurer reserves its right to deny coverage. These letters specify the policy provisions or factual issues that may preclude coverage. They must be issued promptly when coverage questions arise. Non-waiver agreement. A signed agreement between the insurer and insured stating that the insurer's investigation or defense of a claim does not waive any coverage defenses. Non-waiver agreements serve the same purpose as reservation of rights letters, but require the insured's signature. They protect both parties' rights during claim handling. Coverage denial. The insurer's decision that a claim is not covered under the policy and will not be paid. Coverage denials must be communicated in writing with specific policy provisions and factual bases cited. Denials may be appealed or challenged through litigation. Denial letter. The formal written communication informing the insured or claimant that a claim has been denied and explaining the reasons. Denial letters must clearly state the policy provisions, exclusions, or conditions that preclude coverage. They typically inform recipients of appeal or dispute resolution options. Claim denial. Another term for coverage denial, indicating that payment will not be made for a claimed loss. Claim denials may be based on lack of coverage, policy exclusions, failure to meet conditions, or factual disputes about the loss. Partial denial. A decision that some but not all of a claim is covered, resulting in payment of only the covered portion. Partial denials occur when some damages are covered while others are excluded, or when coverage limits are insufficient. The insurer pays the covered amount and denies the rest. Full denial. A decision that none of a claim is covered, resulting in no payment. Full denials completely reject the claim based on coverage, exclusions, or other policy provisions. No benefits are paid under a full denial. Claim acceptance. The insurer's decision that a claim is covered under the policy and will be paid subject to applicable limits and conditions. Claim acceptance may be communicated formally or may be implied through payment or settlement offers. It establishes the insurer's responsibility to pay. Coverage letter. A formal written communication confirming that coverage applies to a claim. Coverage letters may detail the extent of coverage, applicable limits, and any conditions affecting payment. They provide certainty about the insurer's obligations. Claim settlement. The final resolution of a claim through payment, agreement, or other disposition. Settlements may occur through negotiation, appraisal, mediation, or litigation. They resolve the insurer's obligations and release further liability. Settlement agreement. A contract between the insurer and claimant agreeing to resolve a claim for a specified amount or terms. Settlement agreements typically include releases preventing further claims. They must be voluntary and based on adequate consideration. Release. a legal document in which the claimant gives up the right to pursue further claims in exchange for settlement payment. Releases protect insurers from additional demands after claims are settled. They must be knowing and voluntary to be enforceable. General release. A broad release that discharges all claims and liabilities between parties, not limited to the specific claim being settled. General releases bar any future claims arising from the incident. They provide comprehensive protection, but must be carefully worded. Limited release. A release that applies only to specific claims or parties, preserving the right to pursue other claims. Limited releases allow partial settlements while keeping other claims alive. They are common when multiple parties are involved. Settlement check. The payment issued by an insurer to resolve a claim. Settlement checks typically require endorsement by all loss payees. Cashing or depositing a settlement check may constitute acceptance of the settlement terms. Settlement draft. A negotiable instrument similar to a check issued to pay a claim settlement. Settlement drafts may be made payable to multiple parties whose endorsements are required. They serve as the mechanism for transferring settlement funds. Payment authorization. The insurer's internal approval to issue payment for a claim. Payment authorizations go through review processes to ensure proper authority levels approve settlements. They trigger the actual payment process. Claim payment. The money paid by the insurer to settle a claim, whether partial or final. Claim payments resolve the insurer's obligations under the policy for covered losses. They may be made in lump sums or installments. Lump sum settlement. A one-time payment of the entire claim amount, fully resolving the insurer's obligation. Lump sum settlements provide immediate, complete payment and finality. They are contrasted with structured settlements or installment payments. Structured settlement. An arrangement where claim proceeds are paid over time through periodic payments rather than a single lump sum. Structured settlements are common in bodily injury claims to provide long-term income. They may use annuities to guarantee future payments. Periodic payment. Regular installment payments made over time as part of a structured settlement or ongoing claim. Periodic payments may be monthly, annual, or on other schedules. They spread compensation over extended periods. Advance payment. A partial claim payment made before final settlement to provide immediate funds to the insured. Advance payments help insureds meet urgent needs while the claim is being evaluated. They are deducted from final settlement amounts. Partial payment. A claim payment that does not fully settle the claim, with additional amounts potentially due. Partial payments may be made as damages are determined or repairs progress. They do not release the insurer from further obligations. Final payment. The last payment made to completely settle and close a claim. Final payments resolve all outstanding obligations and typically require releases. No further payments are due after final payment. Claim closure. The administrative process of finalizing and closing a claim file after settlement or denial. Claim closure indicates all obligations are fulfilled and no further action is anticipated. Closed claims may be reopened if new information emerges within statutory periods. Reopened claim. A previously closed claim that is opened again due to new information, additional damages, or other developments. Claims may be reopened when latent injuries appear or when payment was insufficient. Time limits may restrict when claims can be reopened. Supplemental payment. An additional payment made after initial settlement when additional damages or expenses are discovered. Supplemental payments address costs not included in original settlements. They require the claim to be reopened or the settlement to allow for additional payments. Salvage. The damaged property or remaining value that the insurer can recover after paying a claim. Salvage includes property the insurer takes ownership of after total loss payments. Salvage value reduces the insurer's net loss. Salvage rights. The insurer's entitlement to take ownership of damaged property after paying a total loss claim. Salvage rights allow insurers to sell or dispose of damaged property to offset claim costs. The insured typically transfers ownership when receiving full payment. Salvage value. The monetary worth of damaged property that can be recovered through sale or use. Salvage value is deducted from total loss calculations when the insured retains the property. It represents the residual value after damage. Salvage sale. The disposition of damaged property by selling it to recover some of the claim payment. Salvage sales may be to salvage buyers, at auction, or through other channels. Proceeds reduce the insurer's net incurred loss. Abandon property. The insured's relinquishment of damaged property to the insurer in exchange for payment of the full insured value. Abandonment transfers ownership and all rights to the insurer. Not all policies allow abandonment. Abandonment. The act of giving up ownership and rights to property, typically in exchange for total loss payment from the insurer. Abandonment must be accepted by the insurer and is subject to policy terms. It transfers all property rights, including salvage. Subrogation. The insurer's right to recover from third parties responsible for a loss after paying the insured's claim. Subrogation allows the insurer to step into the insured's shoes and pursue the liable party. It prevents the insured from recovering twice and holds responsible parties accountable. Subrogation rights. The legal entitlement of an insurer to pursue recovery from responsible third parties after paying a claim. Subrogation rights arise automatically upon payment in most jurisdictions. Policy conditions typically require insureds to preserve these rights. Subrogation recovery. Money collected by an insurer from responsible third parties through exercise of subrogation rights. Subrogation recoveries offset claim payments and improve loss ratios. Recoveries may be shared with the insured if the settlement didn't make them whole. Subrogation action. A lawsuit or claim brought by an insurer against a third party to recover amounts paid to the insured. Subrogation actions enforce the insurer's rights after claim payment. They are typically brought in the insured's name for the insurer's benefit. Right of recovery. The insurer's legal entitlement to collect money from responsible parties who caused a loss. Rights of recovery include subrogation, contribution, and salvage. They help insurers offset claim costs. Assignment of rights. The transfer of the insured's legal rights against third parties to the insurer. Assignment may occur by policy provision, by operation of law, or by separate agreement. It enables the insurer to pursue recovery. Loan receipt. A document signed by the insured acknowledging that claim payment is a loan repayable from any recovery from third parties. Loan receipts preserve subrogation rights in states where payment might otherwise bar recovery. They are less common under modern subrogation doctrines. Equitable subrogation. The common law right of an insurer to recover from responsible third parties based on fairness principles. Equitable subrogation arises by operation of law when the insurer pays a loss. It exists independent of contractual provisions. Conventional subrogation. Subrogation rights created by the terms of the insurance contract rather than by law. Conventional subrogation is based on policy language granting the insurer recovery rights. It may be broader than equitable subrogation. Made whole doctrine. A legal principle requiring the insurer to wait to exercise subrogation until the insured has been fully compensated for all losses. Under the made whole doctrine, the insured's recovery takes priority over the insurer's subrogation. Not all states recognize this doctrine. Common fund doctrine. A principle requiring insurers to share in the costs of recovery when benefiting from the insured's efforts to collect from third parties. Under this doctrine, subrogation recoveries are reduced by pro rata litigation costs. It ensures fair allocation of recovery expenses. Subrogation waiver. An agreement by the insurer to give up subrogation rights against specific parties. Subrogation waivers are often required by contracts and must be agreed to before a loss occurs. They prevent the insurer from pursuing designated parties. Pre-loss waiver. A waiver of subrogation agreed to before any loss occurs, typically through a policy endorsement. Pre-loss waivers are effective in most states and are commonly required in leases and contracts. They must be specifically granted by endorsement or policy provision. Post-loss waiver. An attempt by the insured to waive the insurer's subrogation rights after a loss has occurred. Post-loss waivers are generally ineffective without the insurer's consent because the insurer's rights have already vested. They may impair the insured's claim. Impairment of subrogation. Actions by the insured that damage or eliminate the insurer's ability to recover from third parties. Impairment of subrogation may include releasing liable parties, settling claims, or failing to preserve evidence. Such impairment can reduce or void coverage. Contribution. The right of an insurer that has paid more than its fair share of a loss to collect from other insurers covering the same loss. Contribution distributes loss among multiple insurers according to their respective obligations. It prevents one insurer from bearing the full burden. Contribution by limits. A method of distributing loss among multiple insurers based on their policy limits. Each insurer pays a proportion equal to its limits divided by total limits of all applicable policies. This is a common approach to apportioning shared losses. Pro rata contribution. Sharing of loss among insurers in proportion to their respective policy limits or other measure. Pro rata contribution ensures equitable distribution based on each insurer's exposure. Each pays its proportional share. Claims made against. A phrase describing liability, claims filed against the insured by third parties. Claims made against the insured trigger the insurer's duty to defend and indemnify under liability policies. They represent demands for compensation. Suit against. Legal actions filed against the insured by third parties seeking damages. Suits trigger the insurer's defense obligations under liability policies. The insurer must defend covered suits even if allegations are groundless. Demand letter. A written communication from a claimant or their attorney demanding payment for alleged damages. Demand letters often precede lawsuits and may constitute claims under claims-made policies. They put insurers on notice of potential claims. Settlement demand. A specific offer from a claimant to settle a claim for a stated amount. Settlement demands create deadlines and pressure to resolve claims. Insurers must evaluate them and respond appropriately to protect insureds. Settlement negotiation. The process of discussing and working toward resolution of a claim through compromise. Settlement negotiations involve offers, counter-offers, and exchange of information. Most claims are resolved through negotiation rather than litigation. Settlement offer. A proposal to resolve a claim for a specific amount or terms. Settlement offers may come from either the insurer or the claimant. They start negotiation processes aimed at resolving claims without litigation. Counteroffer. A response to a settlement offer that proposes different terms or amounts. Counteroffers reject the original offer while keeping negotiations alive. They move parties toward potential agreement. Settlement conference. A meeting between parties to discuss and attempt to resolve a claim. Settlement conferences may be informal or court-ordered. They provide opportunities for face-to-face negotiation. Mediation. A voluntary dispute resolution process where a neutral third party helps the insurer and claimant negotiate a settlement. Mediators facilitate discussion but do not impose decisions. Mediation is less formal and expensive than litigation. Mediator. A neutral person who facilitates settlement discussions between disputing parties. Mediators help parties communicate, understand positions, and explore solutions. They do not decide outcomes, but guide the process. Arbitration. A dispute resolution process where a neutral arbitrator hears evidence and renders a binding or non-binding decision. Arbitration is more formal than mediation, but less formal than court trials. Many policies include arbitration provisions for coverage or valuation disputes. Appraisal. A policy-provided process for resolving disputes about the amount of loss without addressing coverage issues. Appraisal involves each party selecting an appraiser and the two appraisers selecting an umpire. The process determines loss value, not whether coverage exists. Appraisal award. The decision issued by appraisers or an umpire determining the value of a loss. Appraisal awards are binding on the amount of loss, but do not address coverage. They resolve valuation disputes. Umpire decision. The ruling made by an umpire when appraisers cannot agree on the loss amount. Umpire decisions break deadlocks and are binding on valuation. The umpire considers both appraisers' evaluations. Disputed claim. A claim where the insurer and claimant disagree about coverage, liability, or the amount owed. Disputed claims may require alternative dispute resolution or litigation. They are more complex and time-consuming than agreed claims. Claims litigation. Lawsuits involving insurance claims, either coverage disputes between insurers and insureds or liability claims against insureds. Claims litigation is costly and time-consuming. Many claims are settled to avoid litigation. Bad faith claim. An allegation that an insurer failed to act reasonably and in good faith in handling a claim. Bad faith claims may result in damages beyond policy limits, including punitive damages. Insurers have duties to investigate promptly, communicate clearly, and settle reasonably. Excess judgment. A judgment against the insured that exceeds the insurance policy limits. Excess judgments leave the insured personally liable for amounts above coverage. They may result from failure to settle within limits or inadequate coverage. Judgment in excess of policy limits. A court award against the insured greater than the available insurance coverage. The insured is personally responsible for the excess amount. These judgments may trigger bad faith claims if the insurer had opportunities to settle within limits. Duty to settle. The insurer's obligation to make reasonable settlement decisions that protect the insured's interests. Insurers must consider settlement opportunities and cannot refuse reasonable settlements within policy limits to protect their own interests. Breach may result in bad faith liability. Reasonable settlement. A claim resolution that a prudent person in the insured's position would accept. Insurers must evaluate settlements from the insured's perspective, not just their own. Rejecting reasonable settlements may constitute bad faith. Settlement within limits. Resolution of a claim for an amount at or below the policy limits. Settlements within limits fully protect the insured from personal liability. Insurers have duties to pursue such settlements when reasonable. Duty to defend. The insurer's obligation under liability policies to provide legal defense for covered claims or suits against the insured. The duty to defend is broader than the duty to indemnify and applies even to groundless or false allegations if they potentially fall within coverage. Defense duties continue until the claim is resolved. Defense costs. Expenses incurred in defending against liability claims, including attorney fees, court costs, expert witnesses, and investigation expenses. Defense costs are typically paid in addition to policy limits in liability insurance. They can be substantial, especially in complex litigation. Defense counsel. Attorneys retained by the insurer to represent and defend the insured in liability claims or lawsuits. Defense counsel owes duties to both the insurer, who pays, and the insured, whom they represent. Conflicts may arise when coverage and liability interests diverge. Independent counsel. An attorney selected and paid by the insured rather than the insurer when conflicts of interest exist. Independent counsel may be required when the insurer has reserved rights or when coverage defenses conflict with liability defenses. Some states require insurers to pay for independent counsel in conflict situations. Cumas counsel. Independent counsel selected by the insured when conflicts of interest exist with insurer-appointed defense counsel, named after the California case establishing this right. Cumas counsel protects the insured's interests when the insurer's coverage position creates conflicts. The insurer typically must pay reasonable fees. Conflict of interest. A situation where the insurer's interests in denying coverage conflict with the insured's interest in being defended and indemnified. Conflicts arise when the same facts affect both coverage and liability, creating divided loyalties for defense counsel. They may require independent counsel or special handling. Reservation of liability. A notice that while the insurer is defending a claim, it reserves the right to later deny indemnity coverage. Reservation of liability is similar to reservation of rights, but focuses specifically on the duty to indemnify rather than defend. It protects the insurer while allowing defense to proceed. Consent to settle clause. A policy provision requiring the insurer to obtain the insured's consent before settling a claim. Consent to settle clauses protect insureds from settlements that might harm their reputation or business. The insured cannot unreasonably withhold consent. Hammer clause. A provision limiting the insurer's liability if the insured refuses to consent to a reasonable settlement. Hammer clauses may cap the insurer's obligation at the settlement amount if the insured rejects it and subsequent judgments are higher. They pressure insureds to accept reasonable settlements. Cooperation clause violation. Breach of the policy condition requiring the insured to cooperate with claim investigation and defense. Cooperation clause violations may include refusing to attend depositions, failing to provide information, or not assisting with defense. Material violations can void coverage. Supplementary payments. Additional amounts the insurer pays beyond policy limits, typically including defense costs, certain court costs, interest, and other specified expenses. Supplementary payments are defined in liability policies and extend the insurer's obligations. They do not reduce available limits. Prejudgment interest. Interest that accrues on a claim or judgment from the date of loss or demand until judgment is entered. Prejudgment interest compensates claimants for delay in receiving compensation. Whether it is covered and whether it reduces limits varies by policy and jurisdiction. Post-judgment interest. Interest that accrues on a judgment after it is entered until it is paid. Post-judgment interest is typically set by statute. Coverage for post-judgment interest varies by policy type and jurisdiction. Declaratory judgment action. A lawsuit seeking a court declaration of the party's rights and obligations under an insurance policy. Declaratory judgment actions resolve coverage disputes without waiting for underlying liability to be determined. They provide certainty about coverage before significant defense costs are incurred. Coverage opinion. A legal analysis provided by an attorney regarding whether coverage exists for a particular claim. Coverage opinions evaluate policy language, exclusions, and relevant law. They guide insurers in claims handling decisions. Claims handling guidelines. Internal standards and procedures insurers use to manage claims consistently and properly. Claims handling guidelines ensure regulatory compliance, fair treatment, and efficient processing. They cover timeframes, documentation, authority levels, and best practices. Prompt claims handling. The requirement that insurers investigate and respond to claims within reasonable timeframes, often specified by statute. Prompt handling protects insureds from unnecessary delay and financial hardship. Many states impose specific time limits for various claims actions. Claims best practices. Industry standards for professional, ethical, and efficient claim handling. Best practices include thorough investigation, clear communication, fair evaluation, and timely resolution. They exceed minimum regulatory requirements. Unfair claims practices. Improper claim handling behaviors prohibited by state insurance regulations, such as misrepresenting policy provisions, failing to investigate properly, or delaying unreasonably. Unfair practices may result in regulatory penalties, bad faith claims, or license suspension. States define specific prohibited practices. Claims file. The complete documentation of a claim including reports, correspondence, photographs, estimates, payments, and notes. Claims files must be complete and accurate as they may be reviewed in audits or litigation. They provide the record of all claims activities. Claims documentation. The records, evidence, and written materials supporting claim decisions and actions. Proper documentation protects both the insurer and insured by creating a clear record. It demonstrates reasonable and thorough handling. Claims diary. A chronological record of activities, contacts, and decisions in a claim file. Claims diaries track what was done, when, and by whom. They ensure follow-up and provide audit trails. Claims notes. Written observations, summaries, and decisions recorded by adjusters and other claims personnel. Claims notes document conversations, findings, and thought processes. They are important evidence of handling quality. Supplemental claim. An additional claim or request for payment related to an original claim, typically for newly discovered damages or expenses. Supplemental claims may arise when initial estimates prove inadequate or latent damage appears. They require reopening the original claim. Claim form. A standardized document submitted to an insurance company requesting payment for covered services, losses, or benefits. Claim forms require specific information about the insured, provider, diagnosis, services rendered, and charges. Common forms include CMS 1500 for medical claims and UB04 for hospital claims. CMS 1500. The standard claim form used by physicians and suppliers to bill Medicare, Medicaid, and most private insurance for professional services. CMS 1500 forms contain patient demographics, diagnosis codes, procedure codes, and charges. They are submitted electronically or on paper. UB04. The uniform billing form used by hospitals, skilled nursing facilities, and other institutional providers to submit claims. UB04 forms, also called CMS 1450, contain facility information, revenue codes, and detailed charge information. They are used for inpatient and outpatient facility billing. Claimant. The person making a claim for benefits under an insurance policy, who may be the insured, a beneficiary, or a healthcare provider. Claimants have rights to appeal denied claims and receive explanations of benefit determinations. They bear responsibility for providing accurate claim information. Attending Physician's Statement, APS. A detailed medical report from the insured's treating physician provided to the insurance company for underwriting or claims purposes. APS documents contain medical history, diagnoses, treatments, prognosis, and functional abilities. Insurers use them to evaluate applications and disability claims. Medical records request. A formal authorization allowing insurers to obtain medical records from healthcare providers for underwriting or claims evaluation. Medical records requests must comply with HIPAA privacy regulations. Applicants and claimants typically sign authorization forms. Authorization for release of information. A signed document permitting disclosure of protected health information to insurance companies or other parties. Authorization for release is required by HIPAA before medical information can be shared. It specifies what information is released and to whom. HIPAA authorization. Written permission complying with Health Insurance Portability and Accountability Act requirements for releasing protected health information. HIPAA authorizations must specify the information disclosed, recipients, purpose, expiration, and patient rights. They are required for most insurance-related disclosures. Timely filing. The requirement that claims be submitted to insurers within specified timeframes, typically 90 days to 1 year from the date of service. Timely filing provisions are contractual deadlines protecting insurers from stale claims. Late claims may be denied. Timely filing limit. The specific deadline by which claims must be submitted to avoid denial. Timely filing limits vary by insurer and contract. They are strictly enforced to ensure prompt claims processing. Claim submission deadline. The date by which a claim must be received by the insurer for consideration. Claim submission deadlines are policy conditions. Missing deadlines may result in forfeiture of benefits. Electronic claim submission. The process of filing insurance claims electronically through clearinghouses or direct connections to insurers. Electronic claim submission is faster, more efficient, and less error-prone than paper filing. It is the standard for most healthcare claims. Clean claim. A claim submitted with all necessary information, proper codes, and supporting documentation that can be processed without additional information requests. Clean claims are paid more quickly. They meet all insurer requirements for processing. Dirty claim. A claim missing information, containing errors, or requiring additional documentation before it can be processed. Dirty claims delay payment and may be denied. They require correction and resubmission. Claim adjudication. The process of reviewing, evaluating, and determining payment for a submitted claim based on policy terms and medical necessity. Claim adjudication involves verifying eligibility, checking coverage, applying benefits, and calculating payment. Results are communicated through explanation of benefits. Claim penned. A temporary hold on claim processing while the insurer requests additional information or documentation. Claim pens delay payment until needed information is received. Common reasons include missing documentation or coordination of benefits questions. Pended claim. A claim placed on hold pending receipt of additional information, clarification, or investigation. Pended claims remain in limbo until resolved. Insurers must communicate penned reasons and requirements. Claim edit. An automated system check that flags claims for potential errors, missing information, or policy violations before payment. Claim edits identify issues requiring human review or correction. They improve claim accuracy and prevent improper payments. Claim scrubbing. The process of reviewing claims for errors, omissions, or inconsistencies before submission to insurers. Claim scrubbing reduces denials and speeds payment. It may be done manually or through software. Pre-adjudication review. Evaluation of claims before final payment determination to verify accuracy, appropriateness, and compliance with policy terms. Pre-adjudication review catches errors and prevents improper payments. It may include medical review and fraud screening. Post-adjudication review. Examination of paid claims after processing to identify overpayments, patterns of improper billing, or fraud. Post-adjudication review supports recovery efforts and identifies systemic issues. It improves future claim processing. Claim audit. A detailed examination of claims to verify accuracy, appropriateness, and compliance with policy terms and regulations. Claim audits may be conducted by insurers, employers, or independent firms. They identify overpayments and improper practices. Medical bill review. The process of examining healthcare bills for accuracy, appropriate coding, and reasonable charges. Medical bill review identifies billing errors, duplicate charges, and excessive fees. It reduces claim costs. Claim repricing. The process of adjusting provider charges to contracted or reasonable amounts before payment. Claim repricing applies negotiated discounts and fee schedules. It reduces payments to appropriate levels. Usual and customary review. Evaluation of charges against prevailing rates in the geographic area to determine reasonable payment amounts. Usual and customary review identifies excessive charges. It protects against inflated billing. Benefit verification. The process of confirming that services are covered under the policy, that the insured is eligible, and that benefits are available. Benefit verification occurs before or during claim processing. It prevents payment for non-covered services. Eligibility verification. Confirmation that an individual has active insurance coverage and is eligible for benefits on the date of service. Eligibility verification checks coverage status, effective dates, and termination dates. It prevents claims for non-covered individuals. Coverage verification. The process of confirming that specific services or treatments are covered under the policy terms. Coverage verification reviews policy provisions, exclusions, and limitations. It determines if benefits apply to requested services. Claim processing time. The period from claim receipt to payment or denial decision, often regulated by state prompt payment laws. Claim processing times vary by claim complexity and completeness. Insurers must meet specified timeframes. Claim turnaround time. The average time required to process claims from submission to final disposition. Claim turnaround time measures insurer efficiency. Shorter turnaround times improve provider and patient satisfaction. Claim lag time. The delay between when services are provided and when claims are submitted or paid. Claim lag time affects financial reporting and reserve calculations. It varies by provider type and claim complexity. Incurred but not reported, IBNR claims. Healthcare services that have been provided but for which claims have not yet been submitted to the insurer. IBNR represents a liability that insurers must estimate and reserve for. It is significant in financial reporting. Claim backlog. The accumulation of unprocessed claims awaiting adjudication. Claim backlogs delay payment and frustrate providers. They may result from staffing issues, system problems, or claim volume spikes. Claim status inquiry. A request for information about the current status of a submitted claim. Claim status inquiries can be made by phone, online, or through electronic systems. They provide updates on processing progress. Claim tracking. The monitoring of claims from submission through final disposition. Claim tracking systems allow providers and patients to check claim progress. They improve transparency and communication. Remittance advice. A document sent with claim payment explaining what was paid, what adjustments were made, and what the patient owes. Remittance advice details payment calculations and denial reasons. It accompanies electronic funds, transfers, or checks. Electronic remittance advice, ERA. An electronic version of remittance advice transmitted to providers showing claim payment details. ERAs facilitate automated posting and reconciliation. They are faster and more efficient than paper documents. Claim resubmission. The process of filing a claim again after it was denied, correcting errors, or providing additional information. Claim resubmissions must address the reasons for initial denial. Timely filing limits may apply. Corrected claim. A claim resubmitted with corrections to errors in the original submission. Corrected claims replace previously submitted claims. They must be clearly identified as corrections. Claim reconsideration. A request for the insurer to review a claim decision again, typically after a denial or partial payment. Claim reconsideration is an informal review before formal appeal. It may result in claim reversal. Claim appeal. A formal request to review and reverse a denied claim or adverse benefit determination through the insurer's appeal process. Claim appeals have specified timeframes and procedural requirements. Multiple appeal levels may be available. First-level appeal. The initial appeal review conducted by the insurer after a claim denial or adverse determination. First-level appeals typically involve different reviewers than the initial decision-makers. They must be completed within regulatory timeframes. Second-level appeal. A subsequent appeal review if the first-level appeal is denied, often involving senior reviewers or medical directors. Second-level appeals provide additional review opportunities. They may be the final internal appeal. External review. An independent review of denied claims by an entity outside the insurance company when internal appeals are exhausted. External review is binding on the insurer in most cases. It provides impartial evaluation of disputed claims. Independent Review Organization, IRO. An external organization that conducts independent reviews of denied claims or adverse benefit determinations. IROs are accredited entities with no financial ties to insurers. They provide objective claim evaluations. Grievance. A formal complaint about insurance company actions, quality of care, or claim handling rather than payment amounts. Grievances address service issues distinct from claim appeals. They have separate resolution processes. Complaint resolution. The process of addressing and resolving formal complaints about insurer conduct, service, or claim handling. Complaint resolution involves investigation and response. State insurance departments oversee complaint processes. Claim overpayment. Payment made by an insurer in excess of the correct benefit amount due to error, duplicate payment, or other mistake. Claim overpayments must be recovered through refund requests or offsets. They represent insurer losses. Overpayment recovery. The process of recouping claim overpayments from providers or insureds through refund requests or payment offsets. Overpayment recovery must follow contractual and legal procedures. Disputes may arise over repayment obligations. Refund request. A demand from an insurer for return of overpaid claim amounts. Refund requests specify the overpayment amount, reason, and deadline for repayment. Failure to refund may result in offsets or legal action. Payment offset. The deduction of overpayment amounts from future claim payments to recover previous overpayments. Payment offsets allow gradual recovery without demanding immediate refunds. They must comply with contractual terms. Claim underpayment. Payment of less than the correct benefit amount due to calculation error, incorrect benefit application, or other mistake. Claim underpayments shortchange providers or insureds. They should be corrected when identified. Coordination of benefits claim. A claim involving multiple insurance policies requiring determination of which insurer pays primary and which pays secondary. COB claims require additional processing to coordinate benefits properly. Total payments cannot exceed 100% of allowed charges. Primary claim. The claim submitted to the insurance plan responsible for paying first when multiple coverage exists. Primary claims are processed based solely on that plan's benefits. Remaining amounts may be submitted to secondary insurance. Secondary claim. The claim submitted to the insurance plan that pays after the primary plan when multiple coverage exists. Secondary claims require information about primary payment. The secondary insurer pays some or all of the remaining balance. Medicare Secondary Payer, MSP. Situations where Medicare is not the primary payer because other coverage exists, such as employer group health plans or liability insurance. MSP rules determine payment order when Medicare beneficiaries have other insurance. Primary payers must be billed first. Medicare Primary Claim. A claim where Medicare is the primary payer and pays first before any supplemental coverage. Medicare primary claims are processed based on Medicare rules. Medigap or other supplements pay remaining amounts. Medigap Claim. A claim submitted to a Medicare supplement insurance policy for costs not covered by Medicare, such as deductibles and coinsurance. Medigap claims are automatically filed when providers accept assignment. They cover Medicare cost sharing. Assignment of benefits. Authorization by the insured allowing the insurance company to pay benefits directly to the health care provider. Assignment of benefits facilitates direct payment and reduces out-of-pocket costs. It is common in managed care and Medicare. Accept assignment, a provider's agreement to accept the insurer's allowed amount as payment in full, not billing patients for amounts above that. Providers who accept assignment receive direct payment from insurers. Patients are protected from balance billing. Non-assignment claim. A claim where the provider does not accept the insurer's payment as payment in full and may bill the patient for additional amounts. Non-assignment allows balance billing within legal limits. It is less common in participating provider networks. Death claim. A claim for life insurance benefits filed after the insured's death. Death claims require submission of a death certificate and claim forms. Insurers investigate to verify death and confirm coverage was in force. Death certificate. An official document certifying a person's death, required to process life insurance claims. Death certificates show cause and manner of death. They are issued by state vital records offices. Claimant's statement. A document completed by a life insurance beneficiary providing information about the insured's death and relationship to the beneficiary. Claimant's statements include details needed to verify the claim. They may require notarization. Attending physician's statement for death claim. A medical report from the physician who treated the deceased, providing details about cause of death and medical history. Attending physician statements verify death circumstances for life insurance claims. They help identify contestability or exclusion issues. Beneficiary Claim Form. A document completed by life insurance beneficiaries to claim death benefits. Beneficiary claim forms request identification, relationship verification, and payment instructions. They must be properly executed to process claims. Proof of death. Documentation establishing that the insured has died, typically including a certified death certificate. Proof of death is required for all life insurance claims. It must be official and verified. Claim investigation. The insurer's examination of a claim to verify its validity, coverage, applicability, and proper payment amount. Claim investigations may involve medical records review, provider interviews, or independent examinations. They ensure accurate claim handling. Contestable claim. A life insurance claim filed during the contestability period, typically the first 2 years, when the insurer can investigate application statements for material misrepresentation. Contestable claims receive heightened scrutiny. Coverage can be voided for misrepresentation during this period. Incontestable claim. A life insurance claim filed after the contestability period expires when the insurer generally cannot deny coverage based on application misstatements. Incontestable claims receive standard processing. The insurer's ability to challenge coverage is limited. Disability claim. A claim for benefits under a disability insurance policy based on the insured's inability to work due to illness or injury. Disability claims require medical evidence of impairment and functional limitations. They are evaluated against policy disability definitions. Own occupation claim. A disability claim where benefits are paid because the insured cannot perform their specific occupation, even if they could work elsewhere. Own occupation claims are evaluated against the insured's actual job duties. They provide broader coverage than any occupation claims. Any occupation claim. A disability claim where benefits are paid only if the insured cannot perform any occupation they're reasonably qualified for. Any occupation claims require more severe impairment than own occupation claims. They are harder to qualify for. Residual disability claim. A claim for partial disability benefits based on income loss from working reduced hours or in a lower-paying capacity. Residual disability claims pay proportional benefits based on earnings loss percentage. They support return-to-work efforts. Total disability claim. A claim for full disability benefits based on complete inability to work. Total disability claims require meeting the policy's total disability definition. They pay the full monthly benefit amount. Recurrent disability. A disability claim for the same or related condition as a previous disability after a period of recovery and return to work. Recurrent disabilities may be treated as continuations of prior disabilities or new disabilities depending on timing. This affects elimination period application. Continuation of disability. Treatment of a recurrent disability as a continuation of the prior disability without requiring a new elimination period. Continuation requires the recurrence to happen within a specified time frame. It provides immediate benefit resumption. New disability. Treatment of a recurrent disability as a separate new disability requiring a new elimination period. New disabilities occur after sufficient time has passed since recovery from the prior disability. They restart the elimination period. Elimination period credit. Recognition of time already served toward an elimination period if disability recurs within a specified time frame. Elimination period credits prevent duplicative waiting periods. They may fully or partially satisfy new elimination periods. Long-term care claim. A claim for benefits under a long-term care insurance policy based on inability to perform activities of daily living or cognitive impairment. Long-term care claims require assessment by healthcare professionals. They trigger when benefit criteria are met. Benefit eligibility assessment. Evaluation to determine if the insured meets the policy's benefit triggers for long-term care or disability claims. Benefit eligibility assessments examine functional abilities and medical conditions. They determine when claims should be approved. Plan of care. A documented strategy for providing long-term care services developed by healthcare professionals for individuals receiving benefits. Plans of care specify services, providers, frequency, and goals. Insurers may require them before authorizing benefits. Care coordinator evaluation. An assessment by a care coordinator to determine appropriate long-term care services and benefit eligibility. Care coordinator evaluations examine functional status, safety, and care needs. They guide benefit decisions and care planning. Cognitive assessment. Evaluation of mental function to determine if cognitive impairment exists sufficient to trigger long-term care benefits. Cognitive assessments use standardized tests and clinical judgment. Significant impairment qualifies for benefits even without ADL limitations. Functional assessment. Evaluation of ability to perform activities of daily living used to determine long-term care benefit eligibility. Functional assessments measure independence in bathing, dressing, toileting, transferring, continence, and eating. Inability to perform specified numbers of ADLs triggers benefits. Claim review. Periodic reassessment of ongoing disability or long-term care claims to verify continued eligibility for benefits. Claim reviews ensure claimants still meet benefit criteria. They may result in benefit continuation, modification, or termination. Risk management. The systematic process of identifying, analyzing, evaluating, and treating risk exposures to minimize the adverse effects of losses on an organization or individual. Risk management involves both reducing the likelihood and severity of losses and financing potential losses through insurance or other means. It encompasses loss prevention, loss reduction, risk transfer, and risk retention strategies. Enterprise Risk Management, ERM. A comprehensive approach to managing all risks facing an organization in an integrated, holistic manner. ERM considers strategic, operational, financial, and hazard risks collectively rather than in silos. It aligns risk management with organizational objectives and treats risk as a portfolio. Risk. The uncertainty concerning loss or the possibility that an adverse outcome will occur. Risk represents potential for harm, damage, or financial loss. In insurance, risk is the uncertainty of loss that is transferred from the insured to the insurer. Pure risk. A risk that involves only the possibility of loss or no loss, with no opportunity for gain. Pure risks are insurable because they involve only downside potential. Examples include fire, theft, liability, and death. Speculative risk. A risk that involves the possibility of loss, no loss, or gain. Speculative risks are generally not insurable because they include opportunities for profit. Examples include business investments, gambling, and stock market participation. Exposure. The state of being subject to the possibility of loss, or a measure of the extent to which an organization or individual faces potential loss. Exposure quantifies the amount at risk and may be measured in dollars of property value, number of units, or other metrics. Higher exposures generally lead to higher premiums. Loss exposure. A condition or situation that presents the possibility of loss, whether or not a loss actually occurs. Loss exposures represent the risks an organization faces and may be categorized as property, liability, personnel, or net income exposures. Identifying loss exposures is the first step in risk management. Property exposure. The possibility of loss to physical assets owned, leased, or used by an organization or individual. Property exposures include buildings, equipment, inventory, and personal possessions. These exposures can result from numerous perils. Liability exposure. The possibility of being held legally responsible for injuries or damages to others. Liability exposures arise from premises, ownership, operations, products, completed work, and professional services. They can result in substantial financial losses, including judgments, settlements, and defense costs. Personnel exposure. The possibility of financial loss resulting from death, disability, retirement, or loss of key employees. Personnel exposures affect both the individual employee and the employer. They include human capital risks, net income exposure, the possibility of reduction in earnings or profits due to loss events. Net income exposures result from business interruption, extra expenses, or loss of market position. They represent indirect financial impacts of losses. Maximum possible loss, MPL. The worst loss that could possibly happen to an organization under the most severe circumstances, assuming all protection systems fail. MPL represents the total value at risk with no mitigation. It is a theoretical worst-case scenario. Maximum probable loss, PML. The worst loss that is likely to occur considering realistic conditions and functioning loss control measures. PML is less than MPL because it assumes some protection systems will work. It represents a more realistic worst-case assessment. Maximum foreseeable loss, MFL. The largest loss that can reasonably be expected to occur, taking into account normal safeguards and response capabilities. MFL is similar to PML and represents a credible worst-case scenario. It is used in risk assessment and insurance placement. Expected loss. The average loss anticipated over time based on frequency and severity. Expected loss equals the probability of loss multiplied by the average severity. It represents the central tendency of loss distribution. Probable maximum loss. Another term for maximum probable loss, representing the worst reasonably expected loss considering functioning safeguards. Probable maximum loss excludes catastrophic scenarios where all protections fail. It guides coverage and retention decisions. Peril. A cause of loss or the specific event that results in damage or injury. Perils include fire, windstorm, theft, collision, and explosion. Insurance policies either name covered perils or cover all perils except those excluded. Hazard. A condition that creates or increases the likelihood or severity of a loss from a given peril. Hazards make losses more likely or more severe, but are not the direct cause of loss. They are categorized as physical, moral, morale, or legal hazards. Physical hazard. A tangible condition or characteristic of property, persons, or operations that increases the likelihood or severity of loss. Physical hazards include factors like defective wiring, icy sidewalks, flammable materials, or structural weaknesses. They are often controllable through risk management. Moral hazard. The tendency for individuals to take greater risks or act less carefully because they have insurance protection. Moral hazard also refers to dishonesty or character flaws that increase the likelihood of fraudulent claims. It represents the risk that insurance itself changes behavior. Morale hazard. Carelessness or indifference to loss that arises from having insurance coverage. Morale hazard differs from moral hazard in that it involves negligence rather than dishonesty. Insured parties may be less diligent in preventing losses because insurance will pay. Legal hazard. Conditions in the legal, regulatory, or judicial environment that increase the frequency or severity of losses. Legal hazards include trends toward higher jury awards, expanded liability theories, or new regulations. They affect claim costs and liability exposures. Loss. The unintended reduction in economic value resulting from a peril. Losses can be direct or indirect, total or partial, and measured in financial terms. They are the adverse events that insurance and risk management aim to address. Direct loss. Physical damage or destruction of property caused immediately by a covered peril. Direct losses are the primary damage from the insured event, such as fire damage to a building. They are typically easier to measure than indirect losses. Indirect loss. Consequential losses that result from direct physical damage, such as lost income, extra expenses, or loss of use. Indirect losses occur as a secondary result of the direct loss. They often require special coverage beyond basic property insurance. Consequential loss. Another term for indirect loss, emphasizing that the loss is a consequence of the primary damage. Consequential losses include business interruption, rental income loss, and contingent losses. They extend beyond immediate physical damage. Total loss. Complete destruction of property or damage so severe that repair costs equal or exceed the property's value. Total losses result in payment of the full insured value rather than repair costs. The property is typically not repaired. Partial loss. Damage where the property is not completely destroyed and repair costs are less than total value. Partial losses are repaired rather than replaced. The insurer pays for restoration to pre-loss condition. Catastrophic loss. An extremely severe loss event affecting many insureds simultaneously and causing extraordinary damage. Catastrophic losses result from hurricanes, earthquakes, tornadoes, or other widespread disasters. They can threaten insurer solvency. Fortuitous loss. A loss that occurs by accident or chance rather than being intended or expected by the insured. Fortuity is essential for insurance coverage. Losses must be unexpected and unintended. Deliberate losses are not insurable. Frequency. The number of losses or loss events occurring within a specified time period. Frequency measures how often losses happen. It is one of two key components, along with severity, in analyzing risk. Severity. The size or dollar amount of individual losses when they occur. Severity measures how large losses are. Together with frequency, it determines total loss costs. Loss prevention. Risk management activities aimed at reducing or eliminating the likelihood that a loss will occur. Loss prevention focuses on preventing losses before they happen through measures like fire prevention systems, safety training, or security. It reduces frequency. Loss reduction. Risk management measures designed to reduce the severity of losses when they do occur. Loss reduction accepts that some losses will happen, but aims to minimize their impact through measures like sprinkler systems or emergency response plans. It reduces severity. Loss control. The combination of loss prevention and loss reduction activities. Loss control encompasses all efforts to reduce both the frequency and severity of losses. It is a fundamental risk management technique. Risk control. Techniques used to reduce or eliminate risk exposures through avoidance, loss prevention, loss reduction, separation, or duplication. Risk control modifies the risk itself rather than financing potential losses. It represents the physical side of risk management. Risk financing. Methods of funding potential losses, including retention, transfer through insurance, and alternative risk transfer mechanisms. Risk financing determines how losses will be paid when they occur. It represents the financial side of risk management. Risk avoidance. Eliminating a risk exposure entirely by not engaging in the activity that creates the risk. Risk avoidance is the most complete form of risk control, but may also eliminate opportunities. Examples include not manufacturing a dangerous product or not entering a risky market. Risk reduction. Activities that decrease either the frequency or severity of potential losses from a risk exposure. Risk reduction modifies risks to make them more manageable through loss control measures. It is synonymous with loss prevention and reduction. Risk transfer. Shifting the financial burden of potential losses to another party, most commonly through insurance contracts. Risk transfer moves the financial consequences of risk from one party to another. Insurance is the primary risk transfer mechanism, but contracts may also transfer risk. Risk retention. The decision to bear the financial consequences of potential losses rather than transferring them. Risk retention may be conscious and deliberate or unconscious through failure to identify risks. It means the organization or individual will fund losses from their own resources. Planned retention. A deliberate decision to retain specified risks after careful analysis of the exposure and financial capacity. Planned retention is a conscious risk management strategy. Organizations retain risks they can afford, and that make financial sense to retain. Unplanned retention. Bearing risks unknowingly due to failure to identify exposures or inadequate insurance coverage. Unplanned retention occurs by default rather than design. It represents gaps in the risk management program. Active retention. A conscious decision to retain a risk with full awareness of the exposure and potential financial impact. Active retention involves setting aside funds or making other preparations to handle retained losses. It is a deliberate risk financing strategy. Passive retention. Retaining risk without awareness or preparation, often due to failure to recognize the exposure. Passive retention is unintentional and may result in financial hardship. It reflects inadequate risk assessment. Self-insurance. A formal risk retention program where an organization sets aside funds systematically to pay for its own losses rather than transferring them to an insurer. Self-insurance involves dedicated funding, often in a separate account or fund, and typically requires regulatory approval. It differs from simple retention by including formal funding mechanisms. Self-insured retention, SIR. A specified dollar amount of loss that the insured retains and pays before insurance coverage applies. SIRs are similar to deductibles, but the insurer has no obligation to pay the SIR amount, and the insured typically handles claims within the SIR. They are common in commercial liability programs. Deductible program. A risk retention approach using deductibles to have the insured retain smaller losses while transferring larger losses to an insurer. Deductible programs reduce premium costs by eliminating insurer involvement in small claims. They combine retention and transfer. Captive insurance company. An insurance company established and owned by a parent organization to insure the risks of that organization and its affiliates. Captives allow organizations to retain risk in a formal insurance structure, access reinsurance markets, and gain potential tax and regulatory advantages. They are a sophisticated alternative risk transfer mechanism. Pure captive. A captive insurance company that insures only the risks of its parent organization and affiliated companies. Pure captives do not insure unrelated third parties. They are the most common type of captive. Association captive. A captive insurance company owned by members of an industry association or trade group to insure risks of member organizations. Association captives pool risks among similar entities. They provide access to captive benefits for organizations too small to form individual captives. Group captive. A captive insurance company owned by multiple unrelated organizations that come together to share risks and insurance costs. Group captives create risk-sharing pools among diverse companies. Participants share in underwriting results. Rent a captive. An arrangement where an organization rents capacity in an existing captive insurance company rather than forming its own. Rent a captive provides captive benefits without the capital and management requirements of owning a captive. Multiple organizations share the captive structure. Agency captive. A captive insurance company owned by an insurance agency or broker to participate in underwriting results of business it places. Agency captives allow agencies to share in underwriting profits beyond just earning commissions. They align agency and carrier interests. Risk Retention Group, RRG. A type of group captive specifically authorized by federal law for liability insurance, owned by its members who share similar liability exposures. RRGs can be licensed in one state and operate in all states without additional licensing. They were created to address liability insurance availability problems. Purchasing Group. An organization formed to negotiate and purchase insurance for its members, but which does not retain risk itself. Purchasing groups leverage collective buying power, but do not become insurers. They were authorized by the same federal law as RRGs. Fronting arrangement. A structure where a licensed insurer issues policies and assumes legal responsibility, but immediately transfers substantially all the risk to a captive or other entity through reinsurance. Fronting provides licensed paper and regulatory compliance, while allowing risk to flow to the captive. The fronting carrier retains a small percentage of premium for this service. Fronting carrier. the licensed insurance company that issues policies in a fronting arrangement while ceding most risk to a captive or other reinsurer. Fronting carriers provide the legal and regulatory framework for captive programs. They retain minimal risk but provide essential licensing and claims services. Domicile: the jurisdiction or location where a captive insurance company is incorporated and primarily regulated. Common captive domiciles include Vermont, Bermuda, Cayman Islands, and other jurisdictions with captive-friendly laws. Domicile selection affects taxation, regulation, and operational requirements. Alternative risk transfer, ART. Non-traditional methods of financing risk that differ from conventional insurance, including captives, risk retention groups, finite risk programs, and capital markets solutions. ART mechanisms provide flexibility and customization beyond standard insurance. They often involve retaining more risk or accessing different capital sources. Finite risk insurance: a hybrid product combining insurance and financing where premiums and coverage are closely matched and the insurer's risk is limited. Finite risk programs typically involve multi-year terms and investment income considerations. They are used for specific defined risks, where both parties understand expected costs. Risk pooling: the aggregation of similar risks from multiple entities to spread losses across the group. Risk pooling creates larger, more predictable loss experiences through the law of large numbers. Insurance itself is a form of risk pooling. Loss fund: money set aside to pay for retained losses in a self-insurance or deductible program. Loss funds ensure financial resources are available when losses occur. They may be actual segregated accounts or bookkeeping reserves. Claims administration: the management of claims processing, including receiving notices, investigating losses, determining coverage, and paying or denying claims. Claims administration may be handled internally for self-insured programs or outsourced to third-party administrators. Effective administration is crucial for retention programs. Third-party administrator, TPA: a company that provides claims administration, loss control, and other services for self-insured organizations or captive insurance companies. TPAs handle operational aspects without assuming insurance risk. They provide expertise and infrastructure for retention programs. Loss portfolio transfer: the transfer of existing loss reserves and liabilities from a self-insured program or insurer to another carrier for a negotiated price. Loss portfolio transfers close out prior exposures and transfer uncertainty about ultimate costs. They are used in exit strategies or to clean up legacy liabilities. Contractual risk transfer: the use of contracts to shift liability exposure from one party to another, typically through hold harmless or indemnification agreements. Contractual risk transfer moves liability through agreement rather than insurance. It is commonly used in construction and service contracts. Hold harmless agreement: a contract provision where one party agrees not to hold another party responsible for injuries or damages. Hold harmless agreements transfer liability contractually. They must be carefully worded and supported by insurance to be effective. Indemnification agreement: a contract provision where one party agrees to compensate another for specified losses, damages, or liabilities. Indemnification transfers the financial burden of potential claims. The scope and limits must be clearly defined. Additional insured endorsement: a policy modification extending liability coverage to parties beyond the named insured, typically to satisfy contractual requirements. Additional insured status provides insurance protection for transferred liability. It is a key mechanism for supporting contractual risk transfer. Certificate of insurance: a document summarizing insurance coverage provided to third parties to demonstrate that coverage exists. Certificates evidence insurance, but do not transfer coverage or modify policy terms. They are commonly required in contracts. Insurance requirement: contractual provisions specifying what insurance coverage one party must maintain, often including types, limits, and naming requirements. Insurance requirements ensure that parties have financial protection for transferred or shared risks. They are standard in leases, service agreements, and construction contracts. Diversification. Spreading risk across different locations, operations, investments, or business lines to reduce the impact of any single loss. Diversification applies the principle of not putting all eggs in one basket. It reduces correlation among losses. Separation. Keeping exposures physically apart to prevent a single event from causing multiple losses. Separation means distributing assets across different locations so one fire or disaster cannot destroy everything. It is a fundamental risk control technique. Duplication. Maintaining backup systems, alternate locations, or redundant assets to ensure continuity if primary resources are lost. Duplication provides alternatives when losses occur. Examples include backup data systems, spare equipment, and alternative suppliers. Business continuity planning. The process of developing strategies, plans, and procedures to ensure critical business functions can continue during and after a disaster. Business continuity planning addresses how the organization will operate when normal capabilities are disrupted. It combines loss control and contingency planning. Disaster recovery. Specific plans and procedures for restoring operations, systems, and facilities after a catastrophic event. Disaster recovery focuses on getting back to normal after major disruptions. It is a component of business continuity planning. Emergency response plan. Documented procedures for immediate actions to take when specific emergencies occur. Emergency response plans ensure rapid, coordinated reactions to minimize loss severity. They cover fire, medical emergencies, natural disasters, and other events. Contingency planning. Developing backup plans and alternative approaches to use if primary strategies fail or adverse events occur. Contingency planning prepares for what-if scenarios. It ensures the organization is not dependent on single resources or approaches. Crisis management. The process of preparing for and responding to significant adverse events that threaten an organization's operations, reputation, or viability. Crisis management involves both planning and execution during critical situations. It addresses the human and communications aspects of major incidents. Risk assessment. The systematic process of identifying risk exposures and analyzing their frequency and severity potential. Risk assessment combines identification and evaluation to understand the organization's risk profile. It is the foundation for risk management decisions. Risk identification. The process of discovering and documenting potential loss exposures facing an organization or individual. Risk identification uses techniques like checklists, inspections, financial statement analysis, and loss histories. It is the first step in risk management. Risk analysis. The evaluation of identified risks to determine their potential frequency, severity, and financial impact. Risk analysis quantifies or qualifies risks to prioritize them and inform treatment decisions. It may use statistical methods, expert judgment, or modeling. Qualitative risk analysis. Risk evaluation using subjective assessments rather than numerical calculations, often categorizing risks as high, medium, or low. Qualitative analysis relies on judgment and experience. It is useful when data is limited. Quantitative risk analysis. Risk evaluation using numerical methods, statistical analysis, and mathematical models to measure frequency, severity, and expected losses. Quantitative analysis provides specific numerical estimates. It requires adequate data and analytical capabilities. Risk evaluation. The process of comparing analyzed risks against the organization's risk tolerance to determine which require treatment. Risk evaluation prioritizes risks and guides allocation of resources. It determines which risks are acceptable and which require action. Risk tolerance. The level of risk an organization or individual is willing to accept before taking action to reduce or transfer the risk. Risk tolerance varies based on financial capacity, strategic objectives, and culture. It guides retention decisions. Risk appetite. The amount and type of risk an organization is willing to pursue or retain in pursuit of its objectives. Risk appetite is broader than tolerance and reflects strategic risk-taking philosophy. It guides overall risk strategy. Risk criteria. The standards against which risk significance is assessed, including financial impact thresholds, probability levels, or strategic importance. Risk criteria provide the basis for evaluating whether risks are acceptable. They should align with organizational objectives. Risk map. A visual representation plotting risks on a matrix showing likelihood versus impact or other dimensions. Risk maps provide quick understanding of the risk landscape and priorities. They help communicate risk profiles to stakeholders. Risk register. A document listing identified risks along with information about their characteristics, potential impacts, and treatment strategies. Risk registers track all known risks and their management status. They serve as the central repository for risk information. Key Risk Indicator, KRI. A metric used to provide early warning signals of increasing risk exposures or control failures. KRIs are monitored to detect changes in the risk environment. They enable proactive risk management. Risk treatment. The process of selecting and implementing measures to modify risk, including avoidance, reduction, transfer, or retention. Risk treatment applies chosen strategies to address evaluated risks. Multiple treatments may be combined. Risk mitigation. Actions taken to reduce the likelihood or impact of risks through loss control, protective measures, or other interventions. Risk mitigation lessens risk exposures without eliminating them entirely. It is a form of risk control. Risk monitoring. The ongoing process of tracking risk indicators, reviewing treatment effectiveness, and identifying new or changing risks. Risk monitoring ensures risk management remains current and effective. It is a continuous activity. Risk reporting. The communication of risk information to stakeholders, management, and boards through dashboards, reports, and presentations. Risk reporting provides visibility into the risk profile and management activities. It supports informed decision-making. Loss history. The record of past losses experienced by an organization or individual, including dates, causes, and costs. Loss history reveals patterns and trends that inform risk assessment and decision-making. It is used in experience rating and risk analysis. Loss run report. A detailed summary of claims history showing dates, descriptions, payments, and reserves for each loss. Loss run reports are provided by insurers to insureds and used in underwriting. They document claim experience. Experience modifier. A factor applied to insurance premiums based on the insured's loss experience compared to similar risks. Experience modifiers reward good loss experience with lower premiums and penalize poor experience with higher premiums. They create financial incentives for loss control. Safety program. Organized efforts to prevent accidents and injuries through training, procedures, equipment, and management commitment. Safety programs reduce frequency and severity of personnel and liability losses. Effective programs lower costs and improve operations. Safety audit. A systematic examination of workplace safety conditions, practices, and compliance with safety standards. Safety audits identify hazards and deficiencies requiring correction. They ensure safety programs remain effective. Safety training. Education provided to employees and others about hazard recognition, safe practices, and emergency procedures. Safety training develops knowledge and skills to prevent losses. It is a fundamental loss control measure. Inspection. An examination of property, operations, or conditions to identify hazards, assess loss potential, or verify risk information. Inspections provide first-hand observation of risks. They may be conducted by insurers, risk managers, or third parties. Loss control survey. A comprehensive inspection and analysis of operations, facilities, and practices to identify loss exposures and recommend improvements. Loss control surveys provide detailed assessments and specific recommendations. They may be required by insurers or conducted for risk management purposes. Risk Improvement Plan, a documented strategy outlining specific actions, timelines, and responsibilities for reducing identified risk exposures. Risk improvement plans translate recommendations into actionable steps. They ensure hazards are addressed systematically. Engineering controls, physical changes to facilities, equipment, or processes that eliminate or reduce hazards. Engineering controls include machine guards, ventilation systems, and ergonomic designs. They are preferred over administrative controls because they directly eliminate hazards. Administrative controls, policies, procedures, training, and work practices designed to reduce risk through changes in how people work. Administrative controls include safety rules, job rotation, and supervision. They depend on human compliance and are less reliable than engineering controls. Personal protective equipment, PPE, specialized clothing or equipment worn to protect against workplace hazards. PPE includes items like hard hats, safety glasses, gloves, and respirators. It is the last line of defense when other controls are insufficient. Hazard communication, programs to ensure employees know about chemical hazards and protective measures through labels, safety data sheets, and training. Hazard communication is required by regulation and prevents injuries from hazardous materials. It is also called right to know. Root cause analysis, investigation methodology to identify the fundamental reason a loss occurred rather than just immediate causes. Root cause analysis looks beyond symptoms to systemic issues. It prevents recurrence by addressing underlying problems. Corrective action, steps taken to eliminate the cause of a detected nonconformity, deficiency, or loss to prevent recurrence. Corrective actions address root causes identified through investigation. They improve systems to prevent repeated problems. Preventive action, proactive measures taken to eliminate the causes of potential problems before they result in losses. Preventive actions anticipate and forestall issues. They are forward-looking, unlike corrective actions which respond to past events. Near miss, an unplanned event that could have resulted in injury, damage, or loss, but did not due to chance or timely intervention. Near misses provide warning signals and learning opportunities. Investigating them prevents future actual losses. Incident investigation, the process of examining the facts and circumstances of a loss event to determine what happened, why it happened, and how to prevent recurrence. Incident investigations gather evidence while it is fresh. They inform corrective actions and loss control improvements. Mortality risk, the uncertainty regarding when death will occur, which is the fundamental risk transferred in life insurance. Mortality risk varies by age, health status, lifestyle, and other factors. Life insurers pool mortality risk across many insureds to predict and manage death claims. Longevity risk, the risk that individuals will live longer than expected, depleting savings or requiring extended financial support. Longevity risk is the opposite of mortality risk and is the primary concern addressed by annuities. It represents the uncertainty of how long retirement funds must last. Morbidity risk, the uncertainty regarding the incidence, duration, and severity of illness or disability. Morbidity risk is the fundamental risk transferred in health and disability insurance. It varies based on age, occupation, health status, and lifestyle factors. Health risk, the likelihood and potential severity of illness, injury, or medical conditions requiring healthcare services. Health risk encompasses acute conditions, chronic diseases, preventable illnesses, and lifestyle-related health issues. It determines health insurance pricing and underwriting. Adverse selection, the tendency for individuals with higher risk or greater need for insurance to seek coverage more than those with lower risk. Adverse selection threatens insurance pool viability by concentrating high-risk individuals. Underwriting, waiting periods, and risk pooling mechanisms help control it. Anti-selection, another term for adverse selection, emphasizing the selection against the insurer's interests when high-risk individuals disproportionately seek coverage. Anti-selection can destabilize insurance pools, if not managed. Guaranteed issue requirements increase anti-selection risk. Risk pool. A group of individuals whose insurance risks are combined for purposes of calculating premiums and paying claims. Risk pools spread losses across many participants, making costs more predictable. Larger, more diverse pools are more stable. Community rating pool. A risk pool where all members pay the same premium regardless of individual health status or risk factors. Community rating pools spread costs evenly across healthy and sick members. They prevent risk-based pricing discrimination. High-risk pool. A special insurance pool for individuals who cannot obtain coverage in the standard market due to pre-existing conditions or high health risks. High-risk pools were used before the Affordable Care Act to provide coverage to otherwise uninsurable individuals. They required subsidies due to concentrated high costs. Risk segmentation. The division of insurance applicants into separate groups based on risk characteristics for pricing or coverage purposes. Risk segmentation allows more accurate pricing, but can exclude high-risk individuals. Regulations limit segmentation to prevent discrimination. Medical underwriting. The process of evaluating an applicant's health status, medical history, and risk factors to determine insurability and appropriate premiums. Medical underwriting identifies pre-existing conditions, high-risk behaviors, and health indicators. It was limited by the Affordable Care Act for individual and small group health insurance. Underwriting classification. The categorization of applicants into risk classes such as preferred, standard, or substandard based on underwriting evaluation. Underwriting classifications determine premium rates and coverage terms. They reflect expected mortality or morbidity. Preferred risk class. The best underwriting classification for applicants with excellent health, no adverse risk factors, and favorable family history. Preferred risk classes receive the lowest premiums. Multiple preferred tiers may exist. Standard risk class. The normal underwriting classification for applicants with average health and typical risk factors. Standard risk classes receive standard premium rates. They represent the majority of applicants. Substandard risk class. An underwriting classification for applicants with health conditions, risk factors, or adverse history indicating higher than average risk. Substandard risks pay higher premiums through ratings or flat extra charges. Coverage may include exclusions or limitations. Table rating. A method of charging higher premiums to substandard risks using percentage increases above standard rates, typically expressed as tables, A through J or 1 through 10. Table ratings increase premiums by 25% to 250% or more. Each table represents an increment of additional risk. Flat extra premium. An additional fixed dollar amount charged per $1,000 of coverage for substandard risks, typically for temporary or specific risks. Flat extra premiums address elevated risks expected to decrease over time. They may be permanent or temporary. Temporary flat extra. A flat extra premium charged for a limited time period, usually 3 to 10 years, to address risks expected to resolve or diminish. Temporary flat extras apply when conditions like recent surgery or controlled health issues create short-term elevated risk. They expire after the specified period. Permanent flat extra. A flat extra premium charged for the life of the policy due to ongoing elevated risk that won't diminish. Permanent flat extras address continuous risk factors like hazardous occupations or hobbies. They continue as long as the policy is in force. Risk classification. The categorization of insurance applicants or insureds into groups with similar risk characteristics for pricing and underwriting purposes. Risk classification ensures that premiums reflect expected losses for each group. It must balance accuracy with regulatory and fairness requirements. Occupational risk. Hazards and health risks associated with specific jobs or work environments. Occupational risks vary widely from desk jobs to hazardous professions like mining or firefighting. They affect both life and disability insurance, underwriting, and pricing. Avocational risk. Hazards from hobbies. recreational activities, or pursuits outside of work such as skydiving, racing, or mountain climbing. Avocational risks may result in coverage exclusions, premium surcharges, or declined applications. They represent voluntary exposure to danger. Lifestyle risk. Health risks associated with personal behaviors and choices such as smoking, alcohol use, diet, exercise, and stress management. Lifestyle risks are significant predictors of morbidity and mortality. Many are modifiable through behavior change. Behavioral risk factor. Specific behaviors that increase health risks, such as tobacco use, excessive alcohol consumption, poor diet, or lack of exercise. Behavioral risk factors are leading causes of preventable death and disease. Insurance underwriting considers them heavily. Family history. The health conditions and causes of death among an applicant's parents and siblings used to assess genetic and hereditary risk factors. Family history of conditions like heart disease, cancer, or diabetes indicates elevated risk. It influences underwriting decisions. Genetic risk. The likelihood of developing conditions based on inherited genetic factors and family medical history. Genetic risk is increasingly understood through genetic testing, but use in insurance underwriting is restricted by law. Family history serves as a proxy for genetic risk. Pre-existing condition exclusion. A policy provision that excludes coverage for health conditions that existed before coverage began for a specified period. Pre-existing condition exclusions are now prohibited in most health insurance by the Affordable Care Act. They were previously common to prevent adverse selection. Look-back period. The time period before coverage begins during which the insurer examines medical history to identify pre-existing conditions. Look-back periods typically ranged from 6 to 12 months. They determined which conditions were considered pre-existing. Creditable coverage. Previous continuous health insurance coverage that reduces or eliminates pre-existing condition exclusion periods. Creditable coverage provisions ensured people weren't penalized for switching insurance. They're less relevant now that pre-existing condition exclusions are prohibited. Portability protection. Rights allowing individuals to maintain insurance coverage when changing employment or insurance plans without new pre-existing condition exclusions. Portability protection was enhanced by HIPAA and made more comprehensive by the Affordable Care Act. It prevents coverage gaps. Guaranteed renewability. A policy provision requiring the insurer to renew coverage as long as premiums are paid, preventing cancellation due to health changes or claims. Guaranteed renewability protects insureds from losing coverage when they need it most. Premiums can increase for classes, but not individuals. Non-cancelable and guaranteed renewable. The strongest renewal protection, combining guaranteed renewal rights with guaranteed level premiums that cannot increase. Non-cancelable and guaranteed renewable policies provide maximum security. They're common in individual disability insurance. Persistency. The rate at which insurance policies remain in force over time, measured by renewal rates and lapse ratios. Persistency indicates customer satisfaction and product value. Low persistency increases insurer costs and may indicate problems. Lapse rate. The percentage of insurance policies that terminate before their natural end due to non-payment or voluntary cancellation. Lapse rates indicate policy retention and profitability. High lapse rates are costly for insurers and policyholders. Retention rate. The percentage of policies that remain in force from one period to the next, the opposite of lapse rate. Retention rates measure customer loyalty and satisfaction. Higher retention improves profitability. Churning risk. The risk that agents will encourage policyholders to replace existing coverage unnecessarily to generate new commissions. Churning harms consumers through lost benefits, new underwriting, and higher costs. Regulations prohibit churning practices. Replacement risk. The risk to insurers when policyholders exchange existing coverage for new policies, potentially due to better terms or agent misconduct. Replacement risk affects persistency and profitability. Replacement regulations protect consumers from inappropriate exchanges. Selection risk. The risk that individuals choosing to enroll, renew, or retain coverage will be those with higher expected claims costs. Selection risk is related to adverse selection, but includes ongoing selection throughout the policy lifecycle. It affects pricing and pool stability. Risk mitigation strategy. A planned approach to reducing the likelihood or impact of insurance risks through underwriting, policy design, care management, or other interventions. Risk mitigation strategies balance coverage accessibility with financial sustainability. They may include wellness programs, disease management, or utilization controls. Wellness program incentive. Financial rewards or premium discounts offered to encourage healthy behaviors and preventive care participation. Wellness incentives align insured and insurer interests in health promotion. They may reduce long-term claim costs. Health Risk Assessment, HRA. A questionnaire evaluating an individual's health status, behaviors, and risk factors to identify health risks and guide interventions. Health risk assessments support wellness programs and disease management. They personalize health improvement strategies. Biometric screening. Physical measurements of health indicators such as blood pressure, cholesterol, glucose, BMI, and weight. Biometric screenings identify health risks and may be used in wellness programs. Results guide health improvement efforts and may affect incentives. Disease Management Program. Coordinated interventions to improve outcomes and reduce costs for individuals with chronic conditions like diabetes, asthma, or heart disease. Disease management programs provide education, monitoring, and support. They reduce complications and hospitalizations. Population health management. Systematic efforts to improve health outcomes for defined groups through data analysis, care coordination, and targeted interventions. Population health management identifies high-risk individuals and addresses health determinants. It focuses on prevention and chronic disease control. Care management. Coordinated services helping individuals navigate the healthcare system, access appropriate care, and manage health conditions effectively. Care management improves quality, reduces unnecessary utilization, and controls costs. It provides personalized support and advocacy. Case management in healthcare. Intensive coordination and support for individuals with complex medical needs, multiple conditions, or high healthcare utilization. Case management for high-need patients prevents complications and inappropriate care. It reduces costs through efficient resource use. Pre-certification requirement. The mandate to obtain insurer approval before receiving certain services or treatments to confirm medical necessity and coverage. Pre-certification requirements control utilization and costs. Failure to obtain required pre-certification may result in reduced or denied benefits. Step therapy. A utilization management approach requiring patients to try less expensive or preferred treatments before approving coverage for more costly alternatives. Step therapy encourages cost-effective care when clinically appropriate. Patients must fail on initial treatments before accessing alternatives. Formulary management. The process of selecting and organizing covered prescription drugs into tiers with different cost sharing to encourage use of preferred medications. Formulary management balances access, cost, and clinical outcomes. It steers patients toward cost-effective treatments. Generic substitution. The practice of dispensing generic medications in place of brand-name drugs when therapeutically equivalent generics are available. Generic substitution reduces drug costs significantly. It may be automatic or require patient consent, depending on laws. Therapeutic substitution. Replacing a prescribed medication with a different drug in the same therapeutic class that treats the same condition. Therapeutic substitution requires physician approval and considers efficacy and safety. It promotes use of preferred formulary medications. Quantity limit. A restriction on the amount of medication covered per prescription or time period to prevent overuse or diversion. Quantity limits align coverage with typical dosing regimens. Overrides may be available for medical necessity. Drug Utilization Review, DUR. Systematic evaluation of prescription drug use to identify potential problems like drug interactions, duplicate therapy, or inappropriate dosing. Drug utilization reviews protect patient safety and control costs. They occur prospectively, concurrently, or retrospectively. Length of stay management. Efforts to ensure hospital stays are appropriate in duration, neither too short nor unnecessarily long. Length of stay management balances quality care with cost control. It involves utilization review and discharge planning. Readmission prevention. Programs to reduce unnecessary hospital readmissions through discharge planning, follow-up care, medication management, and care coordination. Readmission prevention improves outcomes and reduces costs. Penalties exist for excessive readmissions. Emergency department diversion. Strategies to direct patients with non-urgent conditions to appropriate alternative settings rather than emergency departments. ED diversion reduces inappropriate utilization and costs. It includes nurse lines, urgent care centers, and telehealth. Telehealth utilization. The use of technology-enabled healthcare consultations and monitoring to provide convenient, cost-effective care. Telehealth utilization expanded dramatically during the COVID-19 pandemic. It reduces costs while improving access. Medical necessity determination. The evaluation of whether healthcare services are appropriate, required to diagnose or treat a condition, and consistent with accepted standards of practice. Medical necessity determinations are fundamental to coverage decisions. Services lacking medical necessity are denied. Clinical review criteria. Evidence-based standards used to evaluate the appropriateness and necessity of healthcare services. Clinical review criteria guide utilization management decisions. They ensure consistency and alignment with best practices. Experimental or investigational exclusion. A policy provision excluding coverage for treatments not proven effective or still being studied in clinical trials. Experimental exclusions limit coverage to established treatments. Determinations may be disputed when promising new treatments exist. Mortality and morbidity trends. Patterns and changes over time in death rates and disease incidence that affect insurance risk and pricing. Mortality and morbidity trends are influenced by medical advances, lifestyle changes, and aging populations. They require ongoing monitoring and rate adjustments. Medical inflation. The rate at which healthcare costs increase over time, typically exceeding general inflation. Medical inflation affects premium rates and benefit adequacy. It results from technology advances, utilization increases, and pricing factors. Cost trend. The projected rate of increase in healthcare costs used for premium rate development. Cost trends consider medical inflation, utilization changes, and benefit design. Accurate trend projections are critical for rate adequacy. Utilization trend. Changes in the frequency and intensity of healthcare service use over time. Utilization trends affect costs independent of price inflation. They reflect changing practice patterns, demographics, and health status. Risk adjustment. A methodology for adjusting payments or premiums based on the health risk profile of covered populations to account for differences in expected costs. Risk adjustment ensures fair compensation when insurers cover sicker or healthier populations. It reduces incentives to avoid high-risk individuals. Risk score. A numerical value assigned to individuals or populations indicating expected healthcare costs relative to average based on diagnoses, demographics, and other factors. Risk scores are used in risk adjustment and care management. Higher scores indicate greater expected costs. Hierarchical Condition Category, HCC. A risk adjustment model categorizing diagnoses into groups that predict future healthcare costs used in Medicare Advantage and other programs. HCC models assign risk scores based on coded diagnoses. They adjust payments for population health differences. Case mix. The overall health complexity and acuity of a provider's or insurer's patient population. Case mix affects expected costs and resource needs. Risk adjustment accounts for case mix differences. Underwriting. The process of evaluating insurance applications, assessing risk exposures, and determining whether to accept coverage, at what terms, and at what price. Underwriting balances the insurer's need for profitable business with providing competitive coverage. It is the foundation of sound insurance operations. Underwriting process. The systematic steps taken to review applications, gather information, assess risks, make coverage decisions, and establish terms and pricing. The underwriting process ensures consistent, informed decisions. It includes initial review, investigation, evaluation, decision-making, and documentation. Underwriting guidelines. Written standards and criteria that guide underwriters in making acceptance, pricing, and coverage decisions. Underwriting guidelines ensure consistency, define acceptable risks, and establish authority limits. They translate company risk appetite into operational rules. Underwriting authority. The level of discretion granted to an underwriter to accept risks, modify terms, or approve pricing within specified parameters. Underwriting authority increases with experience and position, allowing more complex or higher-value risks to be bound. It defines decision-making limits. Line underwriter. An underwriter who evaluates and makes decisions on individual applications for a specific line of insurance. Line underwriters work with agents, brokers, and insureds to structure coverage. They are responsible for building and maintaining profitable books of business. Staff underwriter. An underwriter who is an employee of an insurance company rather than an independent contractor. Staff underwriters work from company offices or in the field and handle day-to-day underwriting decisions. They represent the majority of underwriters in the industry. Chief underwriter. The senior underwriting executive responsible for overall underwriting operations, strategy, and profitability. Chief underwriters set underwriting philosophy, approve guidelines, and oversee underwriting results. They report to senior management on underwriting performance. Underwriting management. The leadership and oversight of underwriting operations, including setting strategy, establishing guidelines, training staff, and monitoring results. Underwriting management ensures consistency, profitability, and alignment with company objectives. It balances growth with risk selection. Risk assessment. The comprehensive evaluation of an applicant's potential for loss based on hazards, exposures, loss history, management quality, and other factors. Risk assessment determines whether the risk meets underwriting standards and what premium is appropriate. It combines objective data with underwriter judgment. Risk selection. The process of choosing which applicants to insure based on underwriting evaluation. Risk selection distinguishes between acceptable and unacceptable risks and may involve declining applications, modifying terms, or referring to specialists. It builds a balanced, profitable book of business. Risk classification. The grouping of similar risks into categories for rating purposes based on shared characteristics. Risk classification ensures that similar exposures pay similar premiums. It uses factors like occupation, construction type, territory, or business operations. Preferred risk. An applicant whose characteristics indicate better than average loss potential, qualifying for lower premiums or broader terms. Preferred risks have excellent loss histories, strong management, effective controls, and minimal hazards. Insurers compete aggressively for preferred risks. Standard risk. An applicant whose characteristics represent typical or average loss potential for the class. Standard risks qualify for standard rates and terms without special handling. They form the core of most insurance portfolios. Substandard risk. An applicant whose characteristics indicate higher than average loss potential, requiring higher premiums, restrictive terms, or potentially declining coverage. Substandard risks have factors like poor loss history, significant hazards, or inadequate controls. They require careful evaluation and pricing. Declined risk. An applicant whose risk characteristics are unacceptable under the insurer's underwriting guidelines and for whom coverage is refused. Risks may be declined due to excessive hazards, poor loss history, operations outside appetite, or inadequate information. Declined applicants must seek coverage elsewhere. Submitted risk. An application that has been presented to the underwriter for evaluation but has not yet been accepted or declined. Submitted risks are under review and may require additional information. Not all submissions result in bound coverage. Bound coverage. Insurance that has been accepted by the underwriter and is now in force, creating a binding contract. Bound coverage may occur through formal policy issuance or through binding authority of agents. It establishes enforceable obligations. Binding authority. The power granted to an agent or underwriter to commit the insurer to coverage immediately upon acceptance. Binding authority allows coverage to begin without waiting for Home Office approval. It is carefully controlled and limited. Conditional acceptance. Approval of coverage subject to specified requirements being met, such as making improvements, obtaining additional information, or accepting modified terms. Conditional acceptance indicates willingness to cover the risk if conditions are satisfied. It may have expiration dates. Acceptance. The underwriter's decision to provide coverage for an applicant, establishing the insurance contract. Acceptance may be unconditional or subject to specific terms, exclusions, or pricing. It represents the insurer's agreement to assume the risk. Rejection. The underwriter's decision to decline coverage for an applicant whose risk does not meet underwriting standards. Rejection may be communicated formally or informally and should include reasons. Rejected applicants may seek coverage in different markets. Referral. The submission of an application to a higher authority, specialist underwriter, or different department for evaluation when it exceeds the original underwriter's authority or expertise. Referrals ensure appropriate review of complex or large risks. They may delay decision-making. Underwriting file. The complete documentation of an underwriting decision including the application, supplementary information, inspection reports, loss histories, correspondence, and decision rationale. Underwriting files provide audit trails and support for pricing and terms. They may be reviewed in disputes or litigation. Application review. The initial examination of an insurance application to determine completeness, identify needed information, and assess whether the risk fits the insurer's appetite. Application review is the first step in underwriting and may result in quick acceptance, decline, or requests for more information. Information gathering. The process of collecting data needed to evaluate a risk, including applications, loss runs, financial statements, inspections, and third-party reports. Information gathering ensures underwriters have complete, accurate information for decisions. It may involve multiple sources. Supplementary information. Additional data beyond the basic application that underwriters request to complete risk evaluation. Supplementary information might include detailed loss descriptions, photographs, building plans, safety programs, or specialized reports. It fills gaps in understanding. Inspection report. A document prepared by an inspector or field representative describing property conditions, operations, housekeeping, and loss control measures. Inspection reports provide first-hand observation of risks and verify application information. They identify hazards and improvement needs. Field inspection. An on-site visit to the applicant's premises to observe conditions, verify information, and assess loss exposures. Field inspections allow personal evaluation of risks that cannot be understood from applications alone. They are common for commercial property and liability risks. Desktop underwriting. Risk evaluation conducted remotely using applications, online databases, aerial imagery, and other electronic resources without on-site inspection. Desktop underwriting is more efficient but less thorough than field underwriting. It is suitable for smaller or lower hazard risks. Physical inspection. An on-site examination of property to assess construction, occupancy, protection, and exposure (COPE) factors. Physical inspections document actual conditions versus reported information. They are essential for accurate property underwriting. Loss history review. The analysis of an applicant's past claims to identify patterns, trends, and loss control effectiveness. Loss history review examines frequency, severity, types, and causes of losses. It is one of the most important underwriting tools. Loss run. A detailed listing of claims showing dates of loss, descriptions, paid amounts, reserves, and status for each claim. Loss runs document claim history and are essential underwriting information. They typically cover 3 to 5 years. 5-year loss run. A loss history report covering the most recent 5 years of claims experience. 5-year loss runs provide sufficient history to identify trends while remaining current. They are standard in commercial underwriting. CALU report, comprehensive loss. Underwriting exchange report, a database of personal insurance claims history. CLU reports show claims filed by individuals on properties or vehicles, allowing underwriters to verify loss history. They help prevent misrepresentation. Claims history. The record of all insurance claims filed by an applicant, including dates, types, payments, and circumstances. Claims history reveals loss patterns and management effectiveness. Frequent or severe claims indicate higher risk. Prior loss experience. The applicant's historical claims and losses used to predict future loss potential. Prior loss experience is highly credible for underwriting since past behavior often predicts future results. It heavily influences acceptance and pricing decisions. Loss frequency analysis. Examination of how often losses occur over time to assess the probability of future claims. Loss frequency analysis looks at the number of claims per exposure unit or time period. High frequency indicates control problems. Loss severity analysis. Evaluation of the size of losses when they occur to project potential future claim costs. Loss severity analysis examines average and maximum loss amounts. High-severity losses indicate potential for catastrophic results. Loss trend analysis. The study of how losses are changing over time, identifying increasing or decreasing patterns. Loss trend analysis reveals whether risks are improving or deteriorating. It informs pricing and coverage decisions. Large loss history. A record of the applicant's most significant claims, typically those exceeding a specified threshold. Large loss history receives special attention since a few severe claims can dominate experience. It indicates catastrophic potential. Catastrophic loss exposure. The potential for extremely severe, high-dollar losses that could threaten insurer solvency. Catastrophic exposures require special evaluation and may involve aggregate limits, reinsurance, or pricing adjustments. Examples include earthquake, hurricane, or major product liability. Loss control evaluation. Assessment of the applicant's efforts to prevent and reduce losses through safety programs, training, equipment, and management commitment. Loss control evaluation looks at both physical measures and organizational culture. Effective loss control merits premium credits. Risk characteristics. The specific features and attributes of an applicant that affect loss potential, including operations, construction, location, management, and exposures. Risk characteristics distinguish one risk from another and guide classification and pricing. They are the basis for underwriting decisions. COPI factors. The 4 fundamental property underwriting considerations: construction, occupancy, protection, and exposure. COPI factors determine property loss potential. Construction affects fire resistance, occupancy determines hazards, protection includes fire suppression, and exposure refers to external hazards. Construction class. The categorization of building construction type based on materials and methods, ranging from fire-resistive to frame. Construction class significantly affects fire and catastrophe loss potential. Common classes include fire-resistive, non-combustible, masonry, non-combustible, joisted masonry, and frame. Fire-resistive construction. The highest construction class featuring steel or concrete structural members with fire resistance ratings. Fire-resistive buildings are the least susceptible to fire damage and qualify for lowest property rates. They typically include high-rise office buildings. Frame construction, the most combustible construction class where structural members are wood or other flammable materials. Frame construction presents the highest fire risk and receives the highest property rates. It includes most residential buildings. Occupancy, the use to which a building or premises is put, which determines hazards and loss exposures. Occupancy classification considers fire hazards, liability exposures, and catastrophe potential. Manufacturing occupancies differ greatly from office occupancies. Occupancy type, the specific categorization of how premises are used, such as office, retail, restaurant, manufacturing, or warehouse. Occupancy type is a key rating and underwriting factor. Each type has characteristic hazards and loss patterns. Hazardous occupancy, a use or operation that presents elevated fire, explosion, liability, or other loss potential. Hazardous occupancies require special evaluation and pricing. Examples include chemical manufacturing, explosive storage, or nightclubs. Protection class, a rating of fire protection available to a property based on fire department capabilities, water supply, and distance to fire stations. Protection class ranges from 1, best, to 10, worst, and significantly affects property rates. It is assigned by organizations like ISO, Public Protection Classification, PPC. The ISO rating system that evaluates community fire protection for insurance purposes. PPC considers fire department, water supply, and communications on a 1 to 10 scale. It determines protection class for rating. Sprinkler system, an automatic fire suppression system that discharges water when heat is detected. Sprinkler systems dramatically reduce fire severity and qualify for significant rate credits. They are among the most effective loss control measures. Fire alarm system, detection and notification equipment that alerts occupants and fire departments when fire is detected. Fire alarm systems reduce loss severity through early warning. They provide rate credits when central station monitored. Central station alarm, a fire or burglar alarm system monitored 24/7 by a commercial monitoring center that dispatches response. Central station alarms ensure rapid response and qualify for larger rate credits than local alarms. They must meet specific standards. Burglar alarm system, detection equipment that alerts when unauthorized entry occurs. Burglar alarm systems reduce theft losses and may be required for certain occupancies. Central station monitoring provides the greatest credit. Exposure, external factors that could cause or increase losses to the subject property, including adjacent buildings, nearby hazards, or environmental conditions. Exposure analysis considers what could affect the property from outside. Examples include proximity to brush, flood zones, or neighboring hazardous operations. External exposure, hazards originating outside the insured property that could cause damage, such as adjacent buildings, wildfires, or flooding. External exposures are beyond the insured's control, but must be evaluated. They may preclude coverage or require special terms. Adjacent occupancy, the use of neighboring properties that could expose the subject property to fire or other perils. Adjacent occupancy affects exposure evaluation, particularly for fire spread. Hazardous neighbors increase rates. Brush exposure, the fire hazard from proximity to wildland vegetation that could spread fire to structures. Brush exposure is a major concern in wildfire-prone areas and may result in coverage restrictions. It has caused catastrophic insured losses. Wildfire exposure, the risk of loss from wildfires in areas where urban development meets wildland areas. Wildfire exposure has increased dramatically and affects insurability in many western states. Insurers carefully evaluate and restrict coverage in high-risk areas. Flood zone, designated areas mapped by FEMA based on flood probability, ranging from minimal risk to high-risk special flood hazard areas. Flood zone determination affects underwriting, pricing, and whether separate flood insurance is required. Properties in high-risk zones face restrictions. Earthquake zone. Geographic areas classified by seismic activity and earthquake probability. Earthquake zones affect property underwriting and whether earthquake coverage is available or excluded. High-risk zones may require separate coverage or have restricted availability. Hurricane territory. Coastal areas subject to hurricane exposure, typically defined as within certain distances of coastlines. Hurricane territories face restricted coverage, higher deductibles, and special underwriting. Catastrophe modeling evaluates hurricane risk. Tornado alley. The central United States region with elevated tornado frequency and severity. Tornado alley designation affects catastrophe exposure evaluation. While tornadoes are not typically excluded, concentration of risks requires management. Rating territory. A geographic area within which insurance rates are uniform based on similar loss characteristics. Rating territories reflect differences in loss costs by location due to factors like crime, weather, courts, and repair costs. Each territory has its own rates. Geographic risk assessment. Evaluation of how location affects loss potential, considering natural hazards, crime rates, economic factors, legal environment, and infrastructure. Geographic factors significantly influence both frequency and severity. Location is a fundamental underwriting consideration. Territory analysis. The study of loss experience and characteristics by geographic area to establish appropriate rating territories. Territory analysis ensures rates reflect local conditions. It may lead to territory redefinition. Territory code. A numeric or alphanumeric identifier assigned to rating territories for premium calculation purposes. Territory codes link risks to appropriate rate tables. They must be correctly assigned for accurate pricing. Zip code rating. The use of postal zip codes to assign rating territories and apply location-based rates. Zip code rating provides granular geographic pricing. It is commonly used in personal lines insurance. Address verification. The process of confirming that the reported location of insured property or operations is accurate. Address verification ensures proper rating territory assignment and identifies misrepresentation. It may use geocoding and mapping tools. Business classification. The categorization of commercial operations by industry type, activities, and hazards for underwriting and rating purposes. Business classification determines applicable rates and guidelines. It uses systems like NAICS or SIC codes. Class code. A standardized numeric code identifying a specific business classification or type of operation for rating purposes. Class codes link to specific rates reflecting the loss experience of that classification. Correct code assignment is essential for accurate pricing. Classification system. An organized structure of codes and descriptions categorizing risks by type, operations, or exposures. Classification systems standardize risk identification and rating across the industry. Major systems include ISO class codes and NCCI codes. Standard Industrial Classification, SIC code. A 4-digit code identifying business types, formerly used widely for underwriting and rating. SIC codes classified businesses hierarchically by industry. They have been largely replaced by NAICS codes, but some insurers still reference them. North American Industry Classification System, NAICS code. A 6-digit code identifying business types used for statistical and regulatory purposes and adopted by many insurers. NAICS codes provide more detailed business classification than SIC codes. They are used for underwriting and rating. Operations description. A detailed explanation of what the business actually does, how operations are conducted, and what products or services are provided. Operations descriptions clarify business activities beyond class codes. They help underwriters understand actual exposures. Exposure base. The measure used to calculate premium, such as payroll, sales, area, number of units, or other quantifiable factor. The exposure base must correlate with loss potential so premium aligns with risk. Different coverages use different exposure bases. Payroll exposure. The total employee compensation used as the basis for calculating workers' compensation and some liability insurance premiums. Payroll exposure correlates with hours worked and number of employees. It is audited annually for final premium calculation. Sales exposure. Total revenue or sales volume used as an exposure base for products liability, professional liability, and some other coverages. Sales exposure reflects business volume and corresponding liability. It is subject to audit. Area exposure. Square footage of buildings, premises, or operations used as an exposure base. Area exposure is used when loss potential correlates with space occupied. Examples include warehouse space or retail floor area. Vehicle count. The number of vehicles used as the exposure base for commercial auto insurance. Vehicle count may distinguish between types and uses of vehicles. Each vehicle generates separate premium. Number of employees. The count of workers used as an exposure measure for employment practices liability, workers' compensation excess, and other coverages. Employee count reflects organizational size and exposure. Part-time employees may be counted differently than full-time. Units of coverage. Quantifiable measures of exposure such as number of buildings, vehicles, locations, or other discrete items insured. Units of coverage determine how rates are applied. Each unit may carry separate limits. Financial analysis. The review of an applicant's financial statements, credit reports, and fiscal health to assess ability to pay premiums and long-term viability. Financial analysis identifies financially distressed organizations that may present moral hazard. Strong financials indicate stability. Financial statement review. Examination of balance sheets, income statements, and cash flow statements to understand the applicant's financial condition. Financial statement review assesses profitability, liquidity, leverage, and trends. It reveals financial stress or strength. Credit report. A report from a credit bureau providing information about an applicant's credit history, payment patterns, and credit worthiness. Credit reports help assess moral hazard and financial stability. They may be used in underwriting and rating with legal restrictions. Credit score. A numerical rating of creditworthiness based on credit history, used in insurance underwriting and rating. Credit scores correlate with claims frequency in personal insurance. Their use in underwriting is regulated and controversial. Insurance score. A predictive score based on credit information and other factors that correlates with insurance loss potential. Insurance scores are used in personal lines pricing. They must comply with state regulations regarding credit-based insurance scoring. Loss ratio projection. An estimate of the expected ratio of losses to premiums for a risk or book of business. Loss ratio projections inform pricing decisions and profitability expectations. They combine historical data with adjustments for trends and risk characteristics. Expected loss ratio. The anticipated percentage of premium that will be paid out in claims for a particular risk or class. Expected loss ratios guide rate adequacy and are compared to actual results. They reflect the target for profitable underwriting. Target loss ratio. The desired loss ratio an insurer aims to achieve through pricing, typically leaving room for expenses and profit. Target loss ratios vary by line of business and market conditions. They guide rate-level decisions. Break-even analysis. Calculation of the premium or loss ratio at which the insurer neither profits nor loses money. Break-even analysis determines minimum acceptable pricing. It considers investment income as well as underwriting results. Pricing strategy. The approach an insurer takes to setting rates, balancing competitiveness, profitability, growth objectives, and market conditions. Pricing strategy may emphasize market share, profitability, or segment focus. It guides rate levels and flexibility. Competitive pricing. Setting rates to match or beat market rates to win business, balanced against profit needs. Competitive pricing responds to market dynamics but risks inadequate rates. It is most aggressive in soft markets. Adequate pricing, setting rates sufficient to cover expected losses, expenses, and provide reasonable profit. Adequate pricing ensures long-term insurer solvency and ability to pay claims. It is the foundation of responsible underwriting. Rate adequacy testing, actuarial analysis of whether current rates are sufficient to cover expected losses, expenses, and profit targets. Rate adequacy testing compares actual loss experience to pricing assumptions. It identifies needed rate adjustments. Premium adequacy, the sufficiency of premium volume to cover expected claims and expenses for a book of business. Premium adequacy requires both adequate rates and accurate exposure measurement. It ensures sustainable operations. Rate change indication, actuarial calculation of the percentage increase or decrease in rates needed to achieve target profitability. Rate change indications are based on loss trend, expense changes, and profit goals. They guide rate level decisions. Rate level, the overall adequacy of rates for a line of business expressed as the average premium charged relative to what is needed. Rate level is adjusted through general rate increases or decreases. It affects all insureds in the class. Rate modification, adjustments to standard rates based on individual risk characteristics through schedule rating, experience rating, or other means. Rate modifications customize pricing to specific risks. They can increase or decrease premium. Schedule credit, a reduction in premium granted through schedule rating for favorable risk characteristics such as safety programs, management quality, or protective devices. Schedule credits reward loss control and risk quality. They make pricing more competitive for better risks. Schedule debit, an increase in premium charged through schedule rating for unfavorable risk characteristics such as hazards, poor housekeeping, or inadequate controls. Schedule debits penalize negative features and encourage improvement. They properly price higher risks. Experience modification factor, a multiplier applied to manual premiums based on the insured's loss experience compared to the average for their classification. Experience modifications make individual loss history directly affect premium. Factors above 1.0 increase premium, below 1.0 decrease it. Experience mod calculation, the actuarial process of comparing an insured's actual losses to expected losses to derive the experience modification factor. Mod calculations give more weight to frequency than severity and use multi-year experience. They are performed annually by rating bureaus. Expected losses, the claims costs that would be anticipated for a risk of a given class and size based on average experience. Expected losses form the comparison basis for experience rating. Actual losses are measured against expected to determine modifications. Actual losses, the real claims costs incurred by a specific insured during the experience period. Actual losses are compared to expected losses in experience modification calculations. They include both paid claims and reserves. Primary losses, the portion of claims that are given full weight in experience modification calculations, typically the first several $1,000s of each claim. Primary losses emphasize frequency over severity. They reflect losses the insured controls most. Excess losses, the portion of claims above the primary threshold that receives reduced weight in experience modification calculations. Excess losses reduce the impact of very large claims on mods. They recognize that catastrophic losses are less controllable. Credibility weighting, the statistical reliability assigned to an insured's experience based on exposure size, with larger risks receiving more weight. Credibility determines how much the insured's own experience affects their MAUD versus class average. Large risks have high credibility. Ballast, a factor in experience modification calculations that reduces the impact of small differences in loss experience. Ballast stabilizes mods for smaller risks whose limited exposure makes experience less statistically reliable. It prevents excessive fluctuation. D ratio, the ratio in experience modification formulas that determines how much weight is given to the insured's actual experience versus expected experience. D ratio depends on the size of the risk and represents credibility. It ranges from 0 to 1. Premium discount, a reduction in premium for larger risks to reflect economies of scale and reduced expense ratios. Premium discounts increase with policy size and acknowledge that fixed costs are spread over larger premiums. They make large risks more competitive. Minimum premium. The smallest premium an insurer will accept for a policy, regardless of exposure units or rating calculations. Minimum premiums ensure policies cover issuance costs. They prevent very small accounts from being unprofitable. Premium adjustment. Changes to premium during or after the policy period due to audits, exposure corrections, coverage modifications, or other factors. Premium adjustments can result in additional or return premium. They align premium with actual exposures. Audit adjustment. Premium changes resulting from comparison of estimated exposures to actual exposures determined by audit. Audit adjustments settle differences between deposit premium and final earned premium. They may be substantial when exposures differ from estimates. Midterm adjustment. Premium changes made during the policy period for coverage modifications, exposure changes, or newly acquired property. Midterm adjustments keep coverage aligned with current needs. They are calculated on a pro rata or short rate basis. Endorsement premium. Additional or return premium resulting from policy changes made by endorsement. Endorsement premium reflects the cost of coverage modifications. It may be charged or refunded depending on whether coverage is enhanced or reduced. Life insurance underwriting. The process of evaluating applicants for life insurance based on mortality risk factors, including age, health, family history, occupation, lifestyle, and financial circumstances. Life insurance underwriting determines insurability, premium class, and any exclusions or limitations. It protects insurers from adverse selection while enabling coverage for most applicants. Health insurance underwriting. The evaluation of applicants for health insurance based on health status, medical history, and expected healthcare utilization, now prohibited for individual and small group ACA-compliant plans. Health insurance underwriting was used to assess morbidity risk and set premiums. The Affordable Care Act eliminated medical underwriting for most health coverage. Disability insurance underwriting. The assessment of applicants for disability insurance focusing on occupation, health, income, existing coverage, and ability to return to work. Disability insurance underwriting evaluates both likelihood of disability and potential claim duration. It is more complex than life insurance underwriting due to subjective disability definitions. Long-term care underwriting. The evaluation of applicants for long-term care insurance based on current health, cognitive function, functional abilities, and likelihood of needing care. Long-term care underwriting assesses immediate and future care needs. It becomes more stringent at older ages. Simplified underwriting. An abbreviated underwriting process using limited health questions and no medical exam, allowing faster policy issuance with some risk trade-offs. Simplified underwriting typically limits coverage amounts and may impose graded death benefits. It serves applicants wanting convenience over optimal pricing. Accelerated underwriting. A streamlined underwriting process using data analytics, prescription databases, and predictive models to assess risk without traditional exams or attending physician statements. Accelerated underwriting provides fast decisions for qualified applicants. It relies on electronic data sources rather than medical exams. Automated underwriting. The use of computer algorithms and decision rules to evaluate applications and make underwriting decisions without human review. Automated underwriting speeds processing for straightforward cases. Complex or high-risk applications still require manual review. Algorithmic underwriting. Underwriting using sophisticated algorithms and predictive models to assess risk based on multiple data sources. Algorithmic underwriting analyzes patterns across large datasets to predict outcomes. It can identify risks traditional underwriting might miss. Predictive modeling. Statistical techniques using historical data to forecast future outcomes such as mortality, morbidity, or claim likelihood. Predictive modeling enhances underwriting accuracy and efficiency. It identifies correlations between applicant characteristics and insurance outcomes. Data analytics in underwriting. The application of analytical tools and techniques to large datasets for identifying risk patterns and improving underwriting decisions. Data analytics leverages information from medical records, prescription databases, motor vehicle records, and other sources. It supports more accurate and efficient risk assessment. Prescription drug database check. Review of an applicant's prescription history through databases like MIBRX to identify undisclosed conditions or medications. Prescription drug database checks verify application accuracy and identify health risks. They are a key component of accelerated underwriting. Medical Information Bureau, MIB. A member-owned organization maintaining a database of underwriting information shared among life insurance companies to detect fraud and undisclosed conditions. MIB reports contain coded information about medical conditions, hazardous activities, and other underwriting factors. Insurers check MIB during underwriting and report information on accepted applicants. MIB report. Information from the Medical Information Bureau database showing previous insurance applications and underwriting findings. MIB reports alert underwriters to potential undisclosed conditions or discrepancies. They contain codes rather than detailed medical information. Inspection report. A report from an investigative agency providing information about an applicant's lifestyle, reputation, character, finances, and activities. Inspection reports supplement underwriting for larger policies. They verify application information and identify potential risks. Investigative consumer report. A background investigation involving interviews with neighbors, associates, or employers about an applicant's character, reputation, lifestyle, and finances. Investigative consumer reports are subject to Fair Credit Reporting Act requirements. Applicants must be notified when these reports are ordered. Credit-based insurance score. A score derived from credit report information used to predict insurance risk, permitted for life and property insurance in most states, but restricted for health insurance. Credit-based insurance scores correlate with claim likelihood. Their use is controversial and regulated. Motor Vehicle Report, MVR. A driving record report showing traffic violations, accidents, license suspensions, and DUI convictions. Motor vehicle reports are used in life insurance underwriting as indicators of risk-taking behavior. Poor driving records may result in higher premiums or declinations. Financial underwriting. The evaluation of an applicant's income, net worth, and existing insurance to ensure requested coverage amounts are appropriate and not excessive. Financial underwriting prevents overinsurance and potential moral hazard. It verifies insurable interest and economic justification for coverage. Needs analysis. A comprehensive evaluation of an applicant's financial situation to determine appropriate insurance coverage amounts. Needs analysis considers income replacement, debt coverage, education funding, and estate needs. It ensures adequate but not excessive coverage. Human life value. The economic value of an individual's future earnings and contributions used to justify life insurance coverage amounts. Human life value calculations consider age, income, occupation, and years to retirement. They support financial underwriting decisions. Insurable interest verification. Confirmation that the policy owner has a legitimate financial interest in the continued life of the insured. Insurable interest verification prevents wagering on lives and ensures proper insurance purpose. It is required at policy inception. Stranger-originated life insurance, STOLI. Arrangements where investors initiate life insurance on individuals in whom they have no insurable interest, violating insurable interest requirements. STOLI schemes are considered fraudulent and void policies. They circumvent insurable interest laws through deceptive practices. Premium-to-income ratio. The relationship between proposed insurance premiums and the applicant's income, used to assess affordability and appropriateness. Premium-to-income ratios help identify overinsurance or questionable applications. Excessive ratios raise red flags in underwriting. Replacement ratio. The percentage of pre-disability or pre-retirement income that insurance will replace. Replacement ratios in disability insurance typically range from 50 to 70% to maintain work incentives. They guide coverage amount appropriateness. Participation limit. The maximum percentage of income that can be insured under disability policies to prevent overinsurance. Participation limits decrease as income increases. They maintain work incentives by ensuring some income loss from disability. Issue limit. The maximum amount of insurance a company will issue to an individual based on age, income, or other factors without special approval. Issue limits control risk concentration and overinsurance. They vary by product and applicant characteristics. Retention limit. The maximum amount of insurance an insurer will keep on a single life before ceding the excess to reinsurers. Retention limits manage concentration risk. Amounts above retention are transferred to reinsurers. Facultative reinsurance. Reinsurance negotiated individually for specific risks that exceed retention limits or present unusual characteristics. Facultative reinsurance allows insurers to write larger or riskier cases than they could retain. Each risk is underwritten separately by the reinsurer. Automatic reinsurance. A reinsurance agreement where the reinsurer automatically accepts all risks ceded by the insurer within specified parameters. Automatic reinsurance provides efficient capacity for standard risks. It operates under pre-agreed terms without individual negotiation. Reinsurance treaty. A contract between an insurer and reinsurer establishing terms for automatic reinsurance of specified risks. Reinsurance treaties define retention limits, premiums, claims procedures, and covered risks. They provide ongoing reinsurance capacity. Quota share reinsurance. A reinsurance arrangement where the reinsurer accepts a fixed percentage of every risk the insurer writes. Quota share reinsurance provides proportional risk sharing. The reinsurer receives the same percentage of premiums and pays the same percentage of claims. Excess of retention reinsurance. Reinsurance covering amounts above the insurer's retention limit on individual risks. Excess of retention reinsurance allows insurers to write large policies. The insurer keeps amounts up to retention and cedes the excess. Medical exam requirement. The need for a physical examination by a physician or paramedical professional as part of the underwriting process. Medical exam requirements vary by age, coverage amount, and health history. They provide objective health data for risk assessment. Paramedical exam. A simplified medical examination conducted by a trained paramedic or nurse rather than a physician, sufficient for most life insurance applications. Paramedical exams include basic measurements, blood and urine specimens, and health questions. They cost less than full physician exams. Attending physician statement, APS, in underwriting. A detailed medical report obtained from the applicant's personal physician providing comprehensive health history. APS reports are requested when application information raises questions or for larger coverage amounts. They provide in-depth medical information beyond exam findings. Tele-interview. A telephone interview with applicants to gather health history, clarify application responses, and assess lifestyle factors. Tele-interviews are conducted by trained personnel and supplement written applications. They allow for detailed questioning and clarification. Tele-underwriting. Underwriting conducted remotely using phone interviews, electronic records, and digital data rather than in-person exams or meetings. Tele-underwriting became more common during COVID-19. It offers convenience while maintaining underwriting standards. Non-medical limit. The maximum coverage amount an insurer will issue without requiring a medical exam, based on age and other factors. Non-medical limits allow streamlined underwriting for smaller policies. They balance efficiency with risk management. Jumbo limit. The coverage amount threshold above which special underwriting procedures, additional requirements, or senior underwriter approval is needed. Jumbo limits identify high-value cases requiring enhanced scrutiny. They vary by insurer and product. Uninsurable risk. An applicant whose health status, occupation, activities, or other factors present such high risk that no coverage can be offered at any price. Uninsurable risks exceed the insurer's risk tolerance. Declined applicants may seek coverage through guaranteed issue or state pools. Postponement. A temporary declination of an application with an invitation to reapply after a specified period or when conditions improve. Postponements are used when risks are likely to resolve, such as after surgery recovery or treatment completion. They preserve the opportunity for future coverage. Temporary exclusion. An underwriting modification excluding coverage for specific conditions or risks for a limited time period. Temporary exclusions address elevated risks expected to diminish. They may become permanent exclusions or be removed after the exclusion period. Permanent exclusion. A policy modification permanently excluding coverage for specific conditions, body parts, or activities. Permanent exclusions address ongoing elevated risks. The excluded conditions are never covered under the policy. Aviation exclusion. A policy provision or underwriting limitation addressing risks from flying, often excluding coverage for non-commercial pilots or restricting coverage for aviation activities. Aviation exclusions vary from complete exclusions to flat extra charges. They address the elevated mortality risk of flying. War and military service exclusion. A provision excluding or limiting coverage for deaths or disabilities resulting from military service or war. War exclusions protect insurers from catastrophic losses during military conflicts. They may be invoked or modified during wartime. Hazardous activity exclusion. A policy provision excluding coverage for injuries or deaths resulting from specified dangerous activities like skydiving, rock climbing, or racing. Hazardous activity exclusions address avocational risks. Alternative approaches include flat extra premiums or riders. Impairment. A health condition, physical defect, or risk factor that increases mortality or morbidity risk and affects underwriting decisions. Impairments range from minor issues to serious conditions. They are evaluated for severity and impact on life expectancy. Impairment rating. The quantification of additional mortality or morbidity risk associated with a specific health condition. Impairment ratings express excess risk as a percentage or table rating. Multiple impairments are combined to determine overall risk. Debits. Negative underwriting factors that increase risk and premium, such as health conditions, family history, or hazardous occupations. Debits are offset against credits to determine final underwriting classification. Significant debits may result in table ratings or declinations. Credits. Positive underwriting factors that reduce risk and may qualify applicants for preferred rates, such as excellent health, favorable family history, or healthy lifestyle. Credits improve underwriting classification. They may offset minor debits. Build chart. A table showing acceptable height and weight ranges for insurance applicants by gender. Build charts assess obesity and underweight conditions affecting mortality. Weights outside acceptable ranges result in ratings. Body mass index, BMI. A measurement calculated from height and weight used to assess whether individuals are underweight, normal weight, overweight, or obese. BMI is a key underwriting factor as extreme values correlate with increased mortality. Standard BMI ranges receive standard rates. Blood profile. Laboratory test results from blood samples showing cholesterol, glucose, liver and kidney function, and other health indicators. Blood profiles identify undiagnosed conditions and assess severity of known conditions. Abnormal results affect underwriting decisions. Urine analysis. Laboratory testing of urine samples for evidence of kidney disease, diabetes, drug use, and other conditions. Urine analysis complements blood testing in underwriting. It screens for undisclosed health issues and substance abuse. Cotinine test, a laboratory test detecting nicotine use through cotinine, a nicotine metabolite, in blood or urine samples. Cotinine tests verify tobacco use declarations on applications. Positive results when non-tobacco use was declared result in tobacco ratings. Tobacco rating class? A premium classification for tobacco users who pay significantly higher rates than non-tobacco users due to increased mortality risk. Tobacco ratings can be 50 to 200% higher than non-tobacco rates. Some insurers distinguish between cigarettes and other tobacco products. Preferred Plus. The best underwriting classification offering the lowest premiums for applicants with exceptional health, favorable family history, and ideal risk factors. Preferred Plus rates are 15 to 30% below standard rates. Requirements are stringent. Preferred, a favorable underwriting classification for applicants with very good health and minimal risk factors, receiving lower than standard premiums. Preferred rates fall between Preferred Plus and Standard. Multiple preferred tiers may exist. Standard Plus, an underwriting classification slightly better than Standard, but not qualifying for preferred rates. Standard Plus classifications reward good health without meeting preferred criteria. They offer modest premium advantages. Rated, an underwriting classification for substandard risks charged higher than standard premiums through table ratings or flat extras. Rated classifications indicate elevated mortality or morbidity risk. Premium increases vary based on risk severity. Declined, an underwriting decision refusing coverage due to unacceptable risk levels. Declined applicants exceed the insurer's risk tolerance or underwriting guidelines. They may seek coverage elsewhere or through guaranteed issue products. Knockout question. An application question designed to quickly identify uninsurable risks or serious conditions requiring immediate declination. Knockout questions save time by identifying unacceptable risks early. Examples include recent cancer diagnoses or current disability. Underwriter discretion. The judgment and flexibility underwriters have within guidelines to evaluate unique situations and make appropriate decisions. Underwriter discretion allows consideration of individual circumstances beyond rigid rules. Senior underwriters have broader discretion. Underwriting Manual. The comprehensive guide containing an insurer's underwriting philosophy, guidelines, procedures, and decision criteria. Underwriting manuals ensure consistency and provide reference for underwriters. They are regularly updated for medical advances and experience. Insurance law. The body of statutes, regulations, and court decisions governing the business of insurance, insurance contracts, and relationships between insurers, insureds, and claimants. Insurance law varies by state and covers licensing, solvency, rates, policy forms, claims handling, and consumer protection. It is primarily regulated at the state level. Insurance regulation. The governmental oversight and control of the insurance industry to protect consumers, ensure solvency, prevent unfair practices, and maintain market stability. Insurance regulation is primarily a state function in the United States. Regulators approve rates and forms, license companies and agents, and enforce compliance. State Insurance Department. The governmental agency in each state responsible for regulating insurance companies, agents, and practices within that state. State insurance departments review rates and forms, investigate complaints, conduct examinations, and enforce insurance laws. They are headed by insurance commissioners or superintendents. Insurance Commissioner. The elected or appointed official who heads a state's insurance regulatory agency and enforces insurance laws. Insurance commissioners have broad authority over licensing, rates, market conduct, and solvency. They represent state interests in insurance matters. Department of Insurance, DOI. Another term for the state agency regulating insurance, emphasizing its departmental structure within state government. DO is perform the same regulatory functions as insurance departments. The terminology varies by state. National Association of Insurance Commissioners, NAIC. an organization of state insurance regulators that develops model laws, regulations, and standards to promote uniformity across states. The NAIC provides research, education, and coordination, but does not have regulatory authority itself. States adopt NAIC models at their discretion. Model law, a template statute developed by the NAIC for states to consider adopting to create consistency in insurance regulation. Model laws address topics like unfair practices, solvency requirements, and consumer protections. States may adopt them as written or with modifications. Model regulation, a template administrative rule developed by the NAIC for states to implement insurance laws consistently. Model regulations provide detailed guidance on specific regulatory areas. They complement model laws with operational details. Regulatory compliance, adherence to all applicable laws, regulations, and regulatory requirements governing insurance operations. Regulatory compliance involves licensing, filing requirements, consumer protections, claims handling standards, and financial reporting. Non-compliance can result in penalties, fines, or license revocation. Compliance program, organized policies, procedures, and systems to ensure an insurer meets all regulatory requirements. Compliance programs include training, monitoring, auditing, and reporting mechanisms. They prevent violations and demonstrate good faith efforts. Regulatory filing, documents submitted to insurance regulators for approval or information, including rate filings, policy forms, financial statements, and notices. Regulatory filings must meet specific format and content requirements. Timely filing is mandatory. Rate filing, the submission of proposed insurance rates and supporting actuarial justification to regulators for review. Rate filings must demonstrate that rates are adequate, not excessive, and not unfairly discriminatory. The approval process varies by state. Prior approval, a regulatory system requiring insurers to obtain approval from regulators before using new rates or policy forms. Prior approval states prohibit implementation until regulators authorize use. This provides maximum consumer protection but can delay market response. File and use, a regulatory system allowing insurers to implement new rates or forms immediately upon filing with regulators, subject to later review. File and use provides flexibility while maintaining oversight. Regulators can disapprove filings retroactively. Use and file, a regulatory system allowing insurers to implement new rates or forms immediately and file with regulators within a specified period after use. Use and file provides maximum flexibility but less regulatory oversight. It is the least restrictive system. Flex rating, a regulatory system allowing insurers to adjust rates within specified percentage bands without filing, with larger changes requiring approval. Flex rating balances flexibility with oversight by allowing minor adjustments without delay. Percentage bands vary by state and line of business. Form approval, the regulatory process of reviewing and authorizing insurance policy forms for use. Form approval ensures policies comply with law and provide required coverages. Unapproved forms cannot be legally sold. Policy form filing, the submission of insurance policy documents to regulators for approval before use. Policy form filings must include complete policy language, endorsements, and applications. Changes to forms require new filings. Market conduct, the business practices and behavior of insurers in dealing with consumers, agents, and claimants. Market conduct includes sales practices, underwriting, rating, claims handling, and complaint resolution. Regulators monitor conduct to ensure fairness. Market conduct examination, a regulatory investigation of an insurer's business practices to ensure compliance with laws and fair treatment of consumers. Market conduct exams review files, procedures, and practices in areas like underwriting, rating, and claims. Violations result in corrective actions or penalties. Financial examination, a regulatory audit of an insurer's financial condition, records, and solvency to protect policyholders. Financial examinations verify asset values, reserve adequacy, and compliance with financial requirements. They are conducted periodically by state regulators. Solvency regulation. Regulatory oversight ensuring insurers maintain adequate financial resources to pay claims and remain viable. Solvency regulation includes capital requirements, investment restrictions, and reserve standards. It protects policyholders from insurer insolvency. Risk-based capital, RBC. A regulatory standard establishing minimum capital requirements for insurers based on the riskiness of their assets, liabilities, and operations. RBC requirements increase with risk exposure. Falling below RBC thresholds triggers regulatory intervention. Capital adequacy. The sufficiency of an insurer's capital and surplus to support its volume of business and risk exposures. Capital adequacy ensures the insurer can withstand adverse developments. Regulators monitor capital levels closely. Surplus. The excess of an insurer's assets over liabilities, representing the financial cushion available to absorb losses. Surplus is similar to stockholders' equity and measures financial strength. Adequate surplus is essential for solvency. Policyholders' surplus. The specific term for an insurer's surplus that belongs to policyholders as protection against adverse experience. Policyholders' surplus is the safety margin ensuring claim payment ability. It must meet minimum regulatory requirements. Admitted insurer. An insurance company licensed and authorized by a state to sell insurance in that state. Admitted insurers must meet all state requirements and are subject to full regulation. Their policies are backed by state guarantee funds. Authorized insurer. Another term for an admitted insurer, emphasizing regulatory authorization to operate. Authorized insurers can legally sell insurance in the state. The terms admitted and authorized are generally synonymous. Non-admitted insurer. An insurance company not licensed in a state, but which may be allowed to write certain business under surplus lines laws. Non-admitted insurers are not subject to state rate and form regulation. Their policies are not covered by guarantee funds. Surplus lines insurer. A non-admitted insurer authorized to provide coverage for risks that cannot be placed in the admitted market. Surplus lines insurers operate under less regulation and can offer non-standard coverages. They must meet financial standards and are accessed through surplus lines brokers. Eligible surplus lines insurer. A non-admitted insurer that meets specific financial and operational criteria to write surplus lines business in a state. Eligibility requirements ensure financial soundness. Lists of eligible carriers are maintained by states or surplus lines associations. Alien insurer. An insurance company domiciled in a country outside the United States. Alien insurers may operate as admitted, non-admitted, or reinsurers. They are subject to additional regulatory scrutiny due to foreign domicile. Foreign insurer. An insurance company domiciled in a different state than where it is doing business. Foreign insurers must be licensed in each state where they operate. The term distinguishes them from domestic insurers, same state, and alien insurers, foreign country. Domestic insurer. An insurance company domiciled in the state of reference, meaning it is organized under that state's laws. Domestic insurers are subject to the most extensive regulation by their home state. Each insurer is domestic in one state. Domicile. The state or country where an insurance company is legally organized and primarily regulated. Domicile determines which regulator has primary oversight. Many insurers choose domiciles based on regulatory environment. Certificate of authority. The license issued by a state allowing an insurer to transact insurance business in that state. Certificates of authority are required in each state where the insurer operates. They may be revoked for violations or financial impairment. Licensing. The process of obtaining authorization from regulators to operate as an insurer or agent. Licensing ensures minimum qualifications are met. It includes initial applications and ongoing compliance with requirements. Agent license. Authorization from a state for an individual to sell insurance on behalf of insurers. Agent licenses require passing examinations, meeting education requirements, and maintaining continuing education. Different licenses exist for different lines of insurance. Broker license. Authorization from a state for an individual to represent insurance buyers in procuring coverage. Broker licenses have similar requirements to agent licenses, but recognize different representation. Some states do not distinguish between agents and brokers. Continuing education, CE. Ongoing education requirements that licensed agents and brokers must complete to maintain their licenses. CE ensures professionals stay current with laws, products, and practices. Requirements vary by state and license type. Guarantee Fund. A state-operated fund that provides limited protection to policyholders when an insurer becomes insolvent. Guarantee funds pay covered claims and continue policies up to statutory limits. All licensed insurers in a state must participate. Guarantee Association. The organization that administers a state's guarantee fund and handles claims against insolvent insurers. Guarantee associations are funded through assessments on solvent insurers. They protect policyholders from insurer failure. Insolvency. The condition where an insurer lacks sufficient assets to pay all obligations and is unable to continue operations. Insolvency triggers regulatory takeover and potentially guarantee fund involvement. It is the worst outcome for an insurer. Rehabilitation. A regulatory proceeding where a troubled insurer is placed under state control to restore financial health and avoid liquidation. Rehabilitation attempts to preserve the company while protecting policyholders. The insurance commissioner assumes control. Liquidation. The orderly winding down of an insolvent insurer's affairs, selling assets and paying claims and obligations. Liquidation occurs when rehabilitation is unsuccessful or impractical. Policyholders may receive payments from guarantee funds. Receivership. The legal status when a court places an insurer under control of a receiver, typically the insurance commissioner, due to insolvency or hazardous condition. Receivership protects policyholder interests during rehabilitation or liquidation. The receiver has broad powers. Conservation. An early regulatory intervention short of receivership where the regulator takes control to prevent further deterioration of an insurer's condition. Conservation is less formal than receivership and aims to stabilize operations. It may lead to rehabilitation or liquidation. Hazardous financial condition. An insurer's financial state that poses risks to policyholders even if not yet insolvent, triggering regulatory intervention. Hazardous conditions may result from rapid growth, inadequate reserves, or risky investments. Regulators can order corrective actions. Consent order. An agreement between a regulator and an insurer to resolve violations or concerns without formal proceedings. Consent orders typically require corrective actions, impose restrictions, or assess penalties while avoiding litigation. The insurer agrees without admitting violations. Cease and desist order. A regulatory order requiring an insurer or agent to stop specified illegal or harmful practices immediately. Cease and desist orders address ongoing violations that threaten consumers. Failure to comply results in additional penalties. Penalty. A fine or sanction imposed by regulators for violations of insurance laws or regulations. Penalties are intended to punish violations and deter future misconduct. They can be substantial for serious or repeated violations. Fine. A monetary penalty assessed for regulatory violations. Fines are paid to the state and can range from hundreds to millions of dollars depending on severity. They are distinct from restitution paid to harmed consumers. Restitution. Compensation paid to consumers harmed by an insurer's violations or improper practices. Restitution makes victims whole by returning overcharges or paying unpaid claims. It is ordered separately from fines. Unfair trade practices. Business practices prohibited by insurance law because they are deceptive, coercive, or otherwise unfair to consumers. Unfair trade practices include misrepresentation, unfair discrimination, rebating, and improper claims handling. Model laws define specific prohibited acts. Unfair claims practices. Improper claims handling behaviors specifically prohibited by law, such as misrepresenting facts, failing to investigate, or unreasonably delaying settlement. Unfair claims practices harm consumers by denying or reducing legitimate benefits. They subject insurers to penalties and bad faith claims. Twisting. The illegal practice of inducing a policyholder to replace existing insurance with new coverage through misrepresentation or incomplete comparisons. Twisting benefits the agent through new commissions while harming the consumer. It is a serious violation. Churning. The practice of replacing policies frequently to generate commissions without benefit to the policyholder. Churning enriches agents at policyholders' expense. It is prohibited as an unfair trade practice. Rebating. The illegal practice of returning part of the commission or providing other inducements to purchase insurance in states where prohibited. Rebating creates unfair competition and discrimination. Many states prohibit it, while some allow it under controlled conditions. Misrepresentation. Making false or misleading statements about insurance policies, benefits, or terms to induce purchase. Misrepresentation deceives consumers and is an unfair trade practice. It applies to both agents and insurers. Unfair discrimination. Making distinctions in rates, coverage, or terms that are not justified by actuarial or reasonable business considerations. Unfair discrimination treats similarly situated risks differently without justification. Legitimate classification is allowed, but arbitrary discrimination is prohibited. Redlining. The illegal practice of refusing to write insurance or charging higher rates based on geographic area, often correlating with racial or ethnic composition. Redlining denies coverage based on location rather than individual risk. It violates anti-discrimination laws. Protected class. Categories of people who cannot legally be discriminated against in insurance based on characteristics like race, religion, national origin, or other specified factors. Protected class status varies by jurisdiction, but race is universally protected. Insurers must use legitimate risk factors only. Privacy regulations. Laws and rules governing how insurers collect, use, and disclose personal information about applicants and policyholders. Privacy regulations include notice requirements, opt-out rights, and data security standards. GLBA and state laws establish privacy requirements. Gramm-Leach-Bliley Act, GLBA. Federal law requiring financial institutions, including insurers, to protect consumer privacy and notify consumers about information practices. GLBA mandates privacy notices and gives consumers limited rights to opt out of information sharing. State insurance departments enforce GLBA for insurers. Privacy notice. A disclosure required by law informing consumers about what personal information is collected, how it is used, and with whom it is shared. Privacy notices must be provided at application and annually. They give consumers information to make informed decisions. Non-public personal information. Personally identifiable financial information about consumers that is not publicly available. Non-public information is protected by privacy laws. Insurers must safeguard it and limit disclosure. Opt-out right. The consumer's right to prevent an insurer from sharing non-public personal information with certain third parties. Opt-out rights are limited to sharing with non-affiliated parties for marketing. Consumers must be notified of these rights. Data security. Measures to protect personal information from unauthorized access, use, or disclosure. Data security includes physical, electronic, and procedural safeguards. Breaches must be reported to regulators and affected consumers. Cybersecurity requirements. Regulations mandating that insurers implement comprehensive programs to protect information systems and data from cyber threats. Cybersecurity requirements include risk assessment, protective measures, incident response, and oversight. They address growing cyber risks. Bad faith. An insurer's intentional or reckless failure to deal fairly and honestly with policyholders or claimants in violation of implied or explicit duties. Bad faith may involve unreasonably denying claims, failing to investigate, delaying without reason, or refusing reasonable settlements. It can result in damages beyond policy limits, including punitive damages. First-party bad faith. Bad faith by an insurer in handling claims made by its own policyholder for first-party benefits. First-party bad faith involves improper denial or delay of the insured's own claims. It allows the insured to sue for breach of the duty of good faith and fair dealing. Third-party bad faith. Bad faith by an insurer in handling liability claims against its insured made by third parties. Third-party bad faith typically involves failure to settle within policy limits when opportunity exists, exposing the insured to excess judgment. The insured may recover damages for the insurer's bad faith. Implied covenant of good faith and fair dealing. The legal doctrine that every insurance contract includes an implicit obligation that both parties will act honestly and fairly toward each other. The implied covenant requires insurers to prioritize policyholder interests in claims handling. Breach constitutes bad faith. Duty of good faith. The insurer's obligation to act fairly, honestly, and reasonably in handling claims and other policy matters. The duty of good faith requires prioritizing the insured's interests and avoiding conflicts of interest. It exists in every insurance relationship. Duty to defend. The insurer's obligation under liability policies to provide legal defense for the insured against covered claims or suits. The duty to defend is broader than the duty to indemnify and applies to allegations that potentially fall within coverage. It continues until the claim is resolved. Duty to indemnify. The insurer's obligation to pay covered losses, damages, or judgments on behalf of the insured. The duty to indemnify is narrower than the duty to defend and applies only to losses actually covered. It is the core insurance promise. Defense obligation. Another term for the duty to defend, emphasizing that providing defense is mandatory, not discretionary. The defense obligation requires the insurer to hire counsel, pay legal fees, and conduct defense at its expense. Failure to defend may waive coverage defenses. Wrongful failure to settle. An insurer's improper refusal to accept a reasonable settlement offer within policy limits, resulting in excess judgment against the insured. Wrongful failure to settle is a form of bad faith. Insurers must consider the insured's exposure when evaluating settlement opportunities. Excess judgment liability. The insurer's potential liability for judgments exceeding policy limits when the insurer wrongfully failed to settle within limits. Excess judgment liability makes the insurer responsible for amounts beyond coverage due to bad faith. It can result in substantial damages. Stowers demand. A settlement offer within policy limits that places the insurer on notice that rejection will expose the insured to personal liability for excess judgment. Stowers demands, named after a landmark case, create heightened duties for insurers to evaluate settlement. Rejection may constitute bad faith. Time limit demand. A settlement offer that expires after a specified deadline, requiring the insurer to decide quickly whether to accept or risk trial. Time limit demands pressure insurers to act promptly. Unreasonable delay in responding may constitute bad faith. Policy limit demand. A settlement offer for the full amount of available policy limits. Policy limit demands must be carefully evaluated as they may represent the insurer's only opportunity to fully protect the insured. Rejection, when liability is clear, may be bad faith. Reasonable settlement. A settlement that a prudent person in the insured's position would accept considering the likelihood of liability and magnitude of potential judgment. Insurers must evaluate settlement opportunities from the insured's perspective. Refusing reasonable settlements may constitute bad faith. Fiduciary duty. A relationship of trust where one party must act in the best interests of another, which some courts hold applies to insurers toward insureds. Fiduciary duty, when recognized, requires insurers to place the insured's interests ahead of their own. Not all jurisdictions recognize insurers as fiduciaries. Punitive damages. Extra damages awarded to punish wrongdoers and deter future misconduct, which may be imposed against insurers for bad faith. Punitive damages exceed compensatory damages and can be substantial. They require proof of malice, fraud, or reckless indifference. Compensatory damages. Damages awarded to compensate for actual losses and harm suffered, including economic and non-economic losses. Compensatory damages make the victim whole. They are distinct from punitive damages, which punish the wrongdoer. Extra-contractual damages. Damages beyond policy limits awarded against an insurer for wrongful conduct, including bad faith damages, emotional distress, and punitive damages. Extra-contractual damages exceed the insurance contract's limits. They result from the insurer's conduct rather than the underlying claim. Emotional distress damages. Compensation for mental suffering, anxiety, and emotional harm caused by an insurer's bad faith conduct. Emotional distress damages recognize the psychological impact of claim denials or delays. They are a component of bad faith damages. Attorney fees. Legal costs and fees that may be recoverable from an insurer in bad faith cases or when specifically provided by statute or policy. Attorney fee awards shift legal costs to the wrongdoer. Some states allow fee recovery in insurance disputes. Indemnity. The principle that insurance restores the insured to their financial position before a loss without allowing profit. Indemnity means compensation for actual losses suffered. It is the foundation of insurance law preventing unjust enrichment. Indemnification. The act of compensating someone for losses, damages, or liabilities they have incurred. Indemnification makes the party whole. It is the insurer's primary obligation under insurance contracts. Right to indemnity. The insured's entitlement to receive payment for covered losses under the insurance contract. The right to indemnity is the core benefit of insurance. It arises when a covered loss occurs and conditions are met. Hold harmless. An agreement to protect another party from liability or loss, effectively indemnifying them. Hold harmless provisions contractually transfer risk. They are common in service agreements and construction contracts. Contractual indemnity. Indemnification obligations created by contract rather than by insurance policy or law. Contractual indemnity shifts liability through agreement. The scope depends on contract language. Statute of limitations. A law establishing the maximum time period after an event within which legal action must be commenced. Statutes of limitations vary by type of claim and jurisdiction. Claims filed after the limitations period are barred. Limitations period. The specific time frame within which a lawsuit must be filed as established by statute of limitations. Limitations periods begin running from specified trigger dates such as the loss occurrence or discovery. They ensure timely resolution of disputes. Accrual of cause of action. The point in time when the statute of limitations begins running, typically when the claim arises or when the claimant discovers or should have discovered the injury. Accrual determines when the clock starts for filing deadlines. Disputes about accrual can affect whether claims are timely. Discovery rule. A legal doctrine that delays the start of the limitations period until the injured party discovers or reasonably should have discovered the injury or its cause. The discovery rule prevents statutes of limitations from expiring before victims know they have claims. It applies in latent injury cases. Tolling. The temporary suspension or extension of a statute of limitations due to specified circumstances such as minority, disability, or fraudulent concealment. Tolling pauses the limitations clock. It prevents unjust bar of claims due to circumstances beyond control. Statute of repose. An absolute time limit for bringing claims measured from a specific event, like project completion, regardless of when injury occurs or is discovered. Statutes of repose provide final cutoffs for liability and are not subject to discovery rules or tolling. They are common in construction defect cases. Contractual limitations period. A time limit for bringing claims established by insurance contract rather than statute. Contractual limitations may be shorter than statutory periods if allowed by law. They must be clearly stated and may have minimum requirements. Notice requirement. Policy conditions requiring the insured to notify the insurer of losses or potential claims within specified timeframes. Notice requirements ensure prompt reporting, so investigation can begin while evidence is fresh. Late notice may bar coverage if prejudice results. Prejudice: harm to the insurer's position caused by late notice or other failures, such as lost evidence or inability to investigate. Prejudice is often required before late notice bars coverage. The insurer must show actual harm, not just delay. No prejudice rule. The legal doctrine requiring insurers to prove they were harmed by late notice before denying coverage based on notice violations. The no prejudice rule protects insureds from forfeiting coverage for technical notice breaches. Some jurisdictions apply it, others allow denial for breach regardless of prejudice. Waiver: the voluntary, intentional relinquishment of a known right or defense. Waiver may occur when an insurer acts inconsistently with asserting a defense, such as investigating a claim without reserving rights. It results in loss of the right or defense. Estoppel: a legal doctrine preventing a party from asserting a right or defense when their words or actions have led another party to rely to their detriment. Estoppel stops insurers from denying coverage after leading insureds to believe coverage exists. It protects reasonable reliance. Waiver and estoppel: doctrines that prevent insurers from denying coverage or asserting defenses they have waived through conduct or on which insureds have detrimentally relied. Waiver and estoppel protect insureds from unfair surprise. They are frequently raised in coverage disputes. Reasonable expectations doctrine: a principle that insurance policies should be interpreted to provide coverage that a reasonable person in the insured's position would expect. The reasonable expectations doctrine favors insureds when policy language is ambiguous or unexpected. Not all jurisdictions follow this doctrine. Ambiguity: policy language that is unclear or subject to multiple reasonable interpretations. Ambiguity is resolved against the drafter, insurer, under the contra proferentem rule. Clear, unambiguous language is enforced as written. Contra proferentem: the rule that ambiguous insurance policy language is construed against the party who drafted it, typically the insurer. Contra proferentem protects insureds from unclear terms in contracts of adhesion. It encourages clear policy drafting. Contract of adhesion: a contract drafted entirely by one party, the insurer, where the other party, the insured, can only accept or reject the terms without negotiation. Insurance policies are contracts of adhesion. Courts apply special interpretation rules favoring the non-drafting party. Four Corners Rule: the principle that insurance coverage is determined by the language within the four corners of the policy document itself. The Four Corners Rule looks only to the written policy without extrinsic evidence. It emphasizes the written contract as the complete agreement. Entire contract clause: a policy provision stating that the policy and application constitute the entire agreement between the parties. Entire contract clauses prevent claims based on oral promises or representations not in the written policy. They establish the policy as the complete contract. Concealment: the failure to disclose known material facts when applying for insurance with intent to deceive or defraud the insurer. Concealment of material facts can void coverage. It differs from misrepresentation, which involves false statements rather than omissions. Material fact: information that would influence an insurer's decision to provide coverage or determine premium. Material facts must be disclosed truthfully in insurance applications. Misrepresentation of material facts can void the policy. Rescission: the cancellation of an insurance policy retroactively from inception, as if it never existed, due to material misrepresentation or concealment. Rescission returns parties to pre-contract positions with premium refunded. It is an extreme remedy requiring proof of intentional misrepresentation of material facts. Reformation. A court remedy that changes the terms of an insurance policy to reflect the true agreement of the parties when a mutual mistake or fraud occurred. Reformation corrects policy language to match actual intent. It requires clear and convincing evidence. Severability. The principle that if one provision of an insurance policy is invalid or unenforceable, the remainder of the policy remains in effect. Severability prevents entire policies from failing due to isolated invalid provisions. Invalid clauses are severed while the rest stands. Choice of law. Contract provisions or legal rules determining which state's or jurisdiction's law applies to interpret an insurance policy or resolve disputes. Choice of law affects rights and obligations under policies. It is particularly important in multi-state operations. Forum Selection Clause. A contract provision specifying where disputes must be litigated, such as requiring lawsuits in a particular state or county. Forum selection clauses control venue for legal proceedings. They are generally enforceable if reasonable. Arbitration Clause. A policy provision requiring disputes to be resolved through arbitration rather than court litigation. Arbitration clauses specify procedures, rules, and arbitrator selection methods. They are generally enforceable and create binding obligations. Consent to settle clause. A policy provision requiring the insurer to obtain the insured's permission before settling a liability claim. Consent to settle clauses protect the insured's reputation and interests. The insured cannot unreasonably withhold consent. Consent to settle. The insured's agreement allowing the insurer to settle a claim on specified terms. Consent protects insureds from settlements that may harm them despite resolving claims. Insurers must obtain consent when policies require it. Hammer Clause. A provision limiting the insurer's obligation if the insured refuses to consent to settlement, typically capping liability at the settlement amount. Hammer clauses pressure insureds to accept reasonable settlements. They are named for hammering reluctant insureds into settling. Reservation of rights letter. A written notice from an insurer to an insured stating that coverage is being investigated or defense is being provided, but the insurer reserves the right to later deny coverage. Reservation of rights letters protect insurers from waiving coverage defenses while handling claims. They must be sent promptly when coverage questions arise. Coverage disclaimer. A formal denial of coverage communicated by an insurer to the insured stating that a claim is not covered under the policy. Coverage disclaimers must specify the grounds for denial and relevant policy provisions. They must be timely to be effective. Declaratory judgment. A court ruling declaring the rights and obligations of parties under an insurance policy without awarding damages. Declaratory judgment actions resolve coverage disputes before claims are fully adjudicated. They provide certainty about coverage. Duty to investigate. The insurer's obligation to conduct reasonable inquiry into claims to determine coverage and liability. The duty to investigate requires prompt, thorough examination of facts. Inadequate investigation may constitute bad faith. Prompt investigation. The requirement that insurers begin and complete claim investigations within reasonable timeframes. Prompt investigation is mandated by unfair claims practices laws. Unreasonable delay may constitute bad faith or unfair practices. Claims handling standards. Legal and regulatory requirements for how insurers must process claims, including investigation, evaluation, communication, and settlement. Claims handling standards protect consumers from improper practices. They are established by statutes, regulations, and case law. Unfair settlement practices. Specific prohibited behaviors in claim settlement, including misrepresenting facts, failing to acknowledge communications, and not attempting good faith settlements. Unfair settlement practices are defined by state laws. They subject insurers to regulatory action and bad faith claims. Prompt payment laws. statutes requiring insurers to pay undisputed portions of claims within specified timeframes. Prompt payment laws establish deadlines for acknowledging claims, conducting investigations, and issuing payments. Violations may result in interest or penalties. Interest on claims. Additional amounts that may be owed on delayed claim payments, either by statute or contract. Interest on claims compensates for delay in payment. Rates and triggering events vary by jurisdiction. Penalty interest. Enhanced interest rates applied to late claim payments as punishment for unreasonable delay. Penalty interest exceeds standard interest rates and serves to deter delays. It may be imposed under state prompt payment laws. Claims made trigger reporting requirements. Specific notice provisions in claims-made policies requiring prompt reporting of claims and circumstances that may give rise to claims. Reporting requirements are strict conditions in claims-made policies. Failure to report timely may bar coverage even for otherwise covered claims. McCarran-Ferguson Act. Federal law establishing that insurance regulation is primarily a state rather than federal responsibility, and exempting insurance from most federal antitrust laws. McCarran-Ferguson recognizes state primacy in insurance regulation. It allows insurer cooperation in rating and form development. State action doctrine. The principle that insurers acting in compliance with state regulatory requirements are immune from federal antitrust claims. State action immunity protects regulated behavior from antitrust liability. It requires active state supervision. Anti-rebate laws. State statutes prohibiting the return of commissions or other inducements to purchasers of insurance to prevent unfair competition. Anti-rebate laws exist in most states, though some have relaxed restrictions. They aim to prevent discrimination and unfair competition. Controlled business laws. Regulations limiting the amount of insurance an agent can write on themselves, family members, or businesses they control. Controlled business laws prevent conflicts of interest and ensure proper licensing. They vary by state. Replacement regulations. Rules governing when existing insurance can be replaced with new coverage, requiring disclosure and comparison of policies. Replacement regulations protect consumers from losing benefits through improper policy changes. They require signed acknowledgments and notifications. Notice to applicant. Required disclosures that must be provided to insurance applicants regarding policy terms, coverage, or agent compensation. Advertising regulations. Rules governing how insurance can be marketed, prohibiting false, misleading, or deceptive advertising. Advertising regulations apply to all marketing materials and require clear, accurate representations. They protect consumers from misleading promotions. Suitability standards. Requirements that insurance recommendations be appropriate for the customer's needs, financial situation, and objectives. Suitability standards require knowing the customer and recommending appropriate products. They are particularly important in annuity sales. Producer compensation disclosure. Requirements to inform customers about how agents or brokers are compensated for selling insurance. Compensation disclosure promotes transparency about potential conflicts of interest. Requirements vary by state and product type. Health Insurance Portability and Accountability Act, HIPAA. Federal legislation enacted in 1996 to protect health information privacy, ensure portability of health coverage, and prevent discrimination based on health status. HIPAA established privacy rules for protected health information and limited pre-existing condition exclusions. It fundamentally changed health insurance practices and patient privacy protections. Protected Health Information, PHI. Individually identifiable health information held or transmitted by covered entities, protected under HIPAA privacy regulations. PHI includes medical records, billing information, and any data that can identify a patient. Unauthorized disclosure violates federal law. HIPAA Privacy Rule. Federal regulations establishing national standards for protecting patient health information from disclosure without consent. The privacy rule gives patients rights over their health information and sets boundaries on its use. Covered entities must comply with strict privacy requirements. HIPAA Security Rule. Federal regulations requiring administrative, physical, and technical safeguards to protect electronic protected health information. The security rule mandates risk assessments, access controls, encryption, and other protections. It ensures confidentiality, integrity, and availability of electronic health data. Covered entity. Healthcare providers, health plans, and healthcare clearinghouses required to comply with HIPAA privacy and security regulations. Covered entities must protect PHI and ensure business associates also comply. Violations result in penalties. Business associate. A person or entity performing functions or services for a covered entity that involve access to protected health information. Business associates must sign agreements ensuring HIPAA compliance. They include billing companies, IT providers, and consultants. Business Associate Agreement, BAA. A contract between a covered entity and business associate establishing responsibilities for protecting PHI. BAAs specify permitted uses, security requirements, breach notification obligations, and liability. They are required under HIPAA, Patient Protection and Affordable Care Act, ACA. Federal legislation enacted in 2010 that reformed health insurance through guaranteed issue, essential health benefits, subsidies, individual mandates, and marketplace exchanges. The ACA expanded coverage to millions and prohibited pre-existing condition exclusions. It fundamentally restructured health insurance markets. Affordable Care Act, ACA. Common short name for the Patient Protection and Affordable Care Act. The ACA is also known as Obamacare. It represents the most significant health insurance reform since Medicare and Medicaid. Individual mandate. The ACA requirement that individuals maintain minimum essential coverage or pay a tax penalty, intended to ensure broad participation and prevent adverse selection. The individual mandate penalty was reduced to 0 in 2019, but the requirement technically remains. Some states have their own mandates. Employer mandate. The ACA requirement that applicable large employers offer affordable, minimum value health coverage to full-time employees or pay penalties. The employer mandate applies to employers with 50 or more full-time equivalent employees. It ensures employer-sponsored coverage availability. Play or pay penalty. Another term for employer mandate penalties, referring to the choice to play by offering coverage or pay penalties. Play or pay penalties vary based on whether coverage is offered and whether it's affordable and adequate. They enforce employer responsibility provisions. Minimum value standard. The ACA requirement that employer-sponsored health plans cover at least 60% of covered healthcare costs. Minimum value standard ensures plans provide substantial coverage. Plans failing this test may make employees eligible for marketplace subsidies. Affordability standard. The ACA requirement that employee premium contributions for employer-sponsored coverage not exceed a specified percentage of household income, 9.12% in 2023. Affordability determines whether employees can access marketplace subsidies. Unaffordable employer coverage doesn't satisfy individual mandate requirements. Marketplace. The health insurance exchange where individuals and small businesses can compare and purchase ACA-compliant health plans. Marketplaces may be run by states or the federal government. Healthcare.gov. They determine eligibility for subsidies and special enrollment. Health insurance exchange. Another term for marketplace, emphasizing the comparison shopping function of the platform. Exchanges facilitate transparent comparison of health plans. They standardize plan presentation and enrollment processes. State-based marketplace, SBM. A health insurance marketplace operated entirely by a state, rather than the federal government. State-based marketplaces have flexibility in operations while meeting federal standards. They may offer additional features or state-specific options. Federally Facilitated Marketplace, FFM. a health insurance marketplace operated by the federal government, healthcare.gov, for states that chose not to run their own exchanges. The FFM serves multiple states with standardized operations. It is the largest marketplace platform. Healthcare.gov, the federal website serving as the marketplace for states using the federally facilitated marketplace. Healthcare.gov allows individuals to compare plans, determine subsidy eligibility, and enroll in coverage. It launched in 2013 with significant technical problems that were later resolved. Grandfathered plan, a health insurance plan existing when the ACA was enacted, March 23, 2010, that is exempt from certain ACA requirements if it maintains grandfathered status. Grandfathered plans don't have to cover all essential health benefits or follow all ACA rules. They lose grandfathered status if significantly changed. Grandmothered plan, a transitional health insurance plan that doesn't meet all ACA requirements but was allowed to continue under temporary extensions. Grandmothered plans, also called transitional plans, addressed concerns about canceled policies. They have now mostly expired. Employee Retirement Income Security Act, ERISA. Federal law regulating employer-sponsored benefit plans, including health insurance, establishing fiduciary standards, reporting requirements, and appeal rights. ERISA preempts state insurance laws for self-funded plans. It provides federal oversight of employee benefits. ERISA plan, an employee benefit plan subject to ERISA requirements, including most employer-sponsored health, life, and disability coverage. ERISA plans must follow specific disclosure, fiduciary, and appeals procedures. They have federal rather than state oversight. Plan fiduciary, a person or entity with discretionary authority over ERISA plan management, required to act solely in participants' interests. Plan fiduciaries must follow prudent person standards and avoid conflicts of interest. Breaches of fiduciary duty result in personal liability. Summary of Benefits and Coverage, SBC. A standardized ACA-required document explaining health plan benefits, costs, and coverage in plain language with uniform formatting. SBCs must be provided at enrollment, renewal, and upon request. They include coverage examples for common medical situations. Uniform Glossary, a standardized set of health insurance term definitions that must be provided with the summary of benefits and coverage. The Uniform Glossary ensures consumers understand insurance terminology. It is specified by the ACA coverage examples. Standardized scenarios in the summary of benefits and coverage showing how a plan would cover routine and serious medical situations. Coverage examples illustrate costs for having a baby and managing type 2 diabetes. They make plan comparisons easier. Medical Loss Ratio, MLR. The percentage of premium revenues spent on medical claims and quality improvement versus administrative costs and profit. The ACA requires minimum MLRs of 80% for individual/small group plans and 85% for large group plans. Insurers must rebate excess premiums when MLRs fall below thresholds. MLR rebate. Premium refunds insurers must provide when medical loss ratios fall below ACA required thresholds. MLR rebates are calculated annually and paid to policyholders or employers. They return excess premiums to consumers. Administrative costs. Insurer expenses for operations, marketing, salaries, and overhead that are not medical claims or quality improvement. Administrative costs are limited by MLR requirements. Lower administrative costs improve MLR compliance. Rate review. Federal and state oversight of health insurance premium increases to ensure they are justified and reasonable. Rate review requires insurers to explain and justify increases above specified thresholds, typically 10%. It provides transparency and consumer protection. Unreasonable rate increase. A premium increase that exceeds thresholds and lacks adequate justification, subject to regulatory review and potential disapproval. Unreasonable rate increases may be negotiated down or prohibited. The definition varies by state. Mental health parity. The requirement that health insurance plans provide equal coverage for mental health and substance use disorder treatment as for physical health conditions. Mental health parity laws prohibit discriminatory treatment limitations, financial requirements, or network access. The Mental Health Parity and Addiction Equity Act, MHPAEA, established federal standards. Mental Health Parity and Addiction Equity Act, MHPAEA. Federal law requiring group health plans to provide parity between mental health/substance use disorder benefits and medical/surgical benefits. MHPAEA applies to treatment limitations, cost sharing, and coverage restrictions. It ensures equal treatment for behavioral health conditions. Women's Health and Cancer Rights Act, WHCRA. Federal law requiring group health plans covering mastectomy to also cover breast reconstruction and related procedures. WHCRA ensures comprehensive coverage for breast cancer treatment. It includes prostheses and treatment of complications. Newborns and Mothers Health Protection Act. Federal law requiring group health plans to cover minimum hospital stays for childbirth, 48 hours for vaginal delivery, 96 hours for cesarean. The law prevents drive-through deliveries that compromise care. Longer stays must be covered if medically necessary. Consolidated Omnibus Budget Reconciliation Act, COBRA. Federal law requiring employers with 20 or more employees to offer continuation coverage to employees and dependents who lose group health coverage due to qualifying events. COBRA coverage typically lasts 18 or 36 months, depending on the qualifying event. Participants pay the full premium plus administrative fees. Qualifying event. A life event triggering rights to COBRA continuation coverage, such as employment termination, reduction in hours, divorce, or death. Qualifying events must be properly noticed to trigger continuation rights. Different events have different continuation periods. COBRA beneficiary. An individual eligible for continuation coverage under COBRA after experiencing a qualifying event. COBRA beneficiaries include former employees, spouses, and dependent children. They must elect and pay for continuation coverage. COBRA election period. The 60-day period after receiving COBRA notice, during which qualified beneficiaries can choose to elect continuation coverage. The election period begins on the later of the coverage loss date, or notice date. Failure to elect within this period forfeits continuation rights. COBRA premium. The amount charged for continuation coverage, which can be up to 102% of the group rate. 100% of premium plus 2% administrative fee. COBRA premiums are typically higher than active employee contributions since employers don't subsidize COBRA. Disabled individuals may pay 150% of premium. State continuation coverage. State laws requiring continuation coverage for employers too small for federal COBRA, typically fewer than 20 employees. State continuation provisions vary widely in duration and requirements. They fill gaps in federal COBRA coverage. Mini-COBRA. Informal term for state continuation coverage laws applying to smaller employers exempt from federal COBRA. Mini-COBRA laws vary by state in coverage duration and requirements. They extend continuation rights beyond federal mandates. Genetic Information Non-Discrimination Act, GINA. Federal law prohibiting health insurers and employers from discriminating based on genetic information. GINA prevents use of genetic test results, family medical history, or genetic services in coverage or employment decisions. It does not apply to life, disability, or long-term care insurance. Genetic information. Information about an individual's genetic tests, family members' genetic tests, family medical history, or participation in genetic research. Genetic information is protected from discrimination under GINA. Health insurers cannot use it for underwriting or coverage decisions. No Surprises Act. Federal legislation effective 2022 protecting consumers from surprise medical bills for emergency services, and certain non-emergency services at in-network facilities. The No Surprises Act limits patient liability to in-network cost-sharing amounts. It establishes dispute resolution for provider-insurer payment disputes. Balance billing protection. Provisions limiting patients' liability when treated by out-of-network providers in certain circumstances. Balance billing protections prevent providers from billing patients for amounts above in-network cost sharing. The No Surprises Act provides comprehensive protections. Independent Dispute Resolution, IDR. The arbitration process established by the No Surprises Act for resolving payment disputes between insurers and out-of-network providers. IDR allows either party to initiate arbitration when negotiation fails. Arbitrators determine appropriate payment based on specified factors. Qualified Payment Amount, QPA. The median contracted rate for similar services in the geographic area used as the basis for patient cost sharing and provider payment under the No Surprises Act. QPA represents what in-network providers would be paid. It anchors both patient liability and dispute resolution. Rescission. The retroactive cancellation of health insurance coverage, which the ACA prohibits except in cases of fraud or intentional misrepresentation. Rescission protections prevent insurers from canceling coverage when insureds become sick. Legitimate fraud cases still allow rescission. Lifetime limit. A cap on the total amount a health plan will pay over an individual's lifetime, prohibited by the ACA for essential health benefits. Lifetime limits created catastrophic financial risk for seriously ill individuals. Their elimination is a key ACA consumer protection. Annual limit. A cap on the total amount a health plan will pay in a single year, prohibited by the ACA for essential health benefits. Annual limits prevented adequate coverage for serious conditions. Their prohibition ensures comprehensive protection. Rescission notice. Required notification when an insurer intends to rescind coverage, providing reasons and appeal rights. Rescission notices must be provided 30 days in advance. They allow individuals to contest improper cancellations. Michel's Law. Federal law requiring group health plans to continue dependent coverage for seriously ill or injured college students who take medical leaves of absence. Michel's Law prevents coverage loss due to reduced course loads during illness. Students can maintain dependent status during medically necessary leaves. Dependent coverage to age 26. ACA provision requiring health plans offering dependent coverage to extend it to adult children until age 26, regardless of student, marital, or financial status. This provision significantly expanded young adult coverage. It allows adult children to remain on parents' plans. Section 1557. The ACA provision prohibiting discrimination in healthcare and health insurance based on race, color, national origin, sex, age, or disability. Section 1557 extends civil rights protections to healthcare contexts. It ensures equal access regardless of protected characteristics. Discrimination prohibition. Legal requirements that insurers cannot make coverage or benefit decisions based on protected characteristics like race, color, national origin, sex, age, or disability. Discrimination prohibitions ensure equal treatment and access. They are enforced through various federal and state laws. Medicaid expansion. The ACA provision allowing states to expand Medicaid eligibility to all adults with incomes up to 138% of the federal poverty level. Medicaid expansion extended coverage to millions of low-income adults. Not all states adopted expansion. Federal poverty level, FPL. The income measure used to determine eligibility for Medicaid, marketplace subsidies, and other programs. Federal poverty levels are updated annually and vary by household size. They establish income thresholds for assistance programs. Modified Adjusted Gross Income, MAGI. The income calculation method used to determine eligibility for Medicaid and marketplace subsidies. MAGI includes adjusted gross income plus certain excluded foreign income, tax-exempt interest, and non-taxable Social Security benefits. It standardizes income determination across programs. State Insurance Commissioner Authority. The regulatory powers granted to state insurance commissioners to oversee insurers, approve rates and forms, investigate complaints, and enforce laws. Commissioner authority varies by state, but generally includes broad oversight powers. Commissioners protect consumers and ensure market stability. Market conduct regulation. State oversight of insurer business practices, including sales, underwriting, rating, claims handling, and consumer treatment. Market conduct regulation ensures fair dealing and compliance with laws. Violations result in corrective action and penalties. Pattern and practice. Repeated violations or systematic problems in insurer conduct indicating institutional issues rather than isolated errors. Pattern and practice findings lead to more serious regulatory consequences. They demonstrate systemic compliance failures. Consent decree. A legally binding agreement between regulators and insurers resolving violations without litigation, requiring corrective actions and often including penalties. Consent decrees allow resolution while avoiding admissions of wrongdoing. They impose enforceable requirements. Unfair Trade Practice Act. State laws prohibiting deceptive, unfair, or fraudulent insurance practices based on NAIC model legislation. Unfair Trade Practice Acts specify prohibited conduct and enforcement mechanisms. They protect consumers from improper insurer behavior. Replacement notice. A disclosure required when an insurance policy is being replaced, explaining the consequences of replacement and comparing policies. Replacement notices ensure consumers understand what they're giving up and gaining. They prevent inappropriate replacements. Buyer's Guide. An educational document that must be provided to life insurance applicants explaining how policies work and what to consider when purchasing. Buyer's guides help consumers make informed decisions. They are required disclosures in many states. Policy summary. A concise explanation of an insurance policy's key features, benefits, and costs that must be provided to applicants. Policy summaries provide essential information in accessible format. They supplement full policy documents. Suitability requirement. The obligation that insurance sales recommendations be appropriate for the customer's needs, financial situation, and objectives. Suitability requirements are particularly stringent for annuity sales. Agents must document suitability analysis. Senior protection. Enhanced regulatory protections for insurance sales to seniors, including additional disclosures, suitability requirements, and training mandates. Senior protections address vulnerability to inappropriate sales. Many states have specific senior-focused regulations. Free look period in life insurance. The time period, typically 10 to 30 days, after policy delivery during which the owner can cancel for a full refund. Free look periods allow review without commitment. They protect consumers from high-pressure sales. Accelerated benefits, disclosure. Required information about accelerated death benefit options that must be provided to life insurance applicants and policyholders. Accelerated benefits, disclosures explain living benefit options. They ensure awareness of available features. Long-term care partnership program. State programs offering qualified long-term care policies that provide Medicaid asset protection equal to benefits paid. Partnership programs encourage private long-term care insurance purchase. They allow individuals to protect assets while qualifying for Medicaid. Layered coverage. An insurance program structure using multiple policies stacked vertically, each providing coverage above the limits of the layer below. Layered coverage creates tiers of protection with primary coverage at the base and successive excess layers above. This approach provides high total limits while managing cost and spreading risk among insurers. Primary layer. The first level of insurance coverage that responds to losses before any excess or umbrella policies are triggered. The primary layer pays claims from the first dollar up to its policy limit. It forms the foundation of a layered insurance program. Excess layer. Coverage that sits above a primary or underlying policy and pays only after the lower layer's limits are exhausted. Excess layers provide additional capacity beyond primary limits. Multiple excess layers can be stacked to achieve very high total limits. Vertical exhaustion. The requirement that underlying policy limits be completely used up before higher excess layers begin to pay. Vertical exhaustion ensures each layer pays in proper sequence from bottom to top. Lower layers must be exhausted before upper layers respond. Horizontal exhaustion. The requirement that all applicable policies at the same coverage level be exhausted before moving to higher layers. Horizontal exhaustion applies when multiple insurers provide coverage at the same layer. All insurers at one level must pay their shares before the next level attaches. Drop-down coverage, a provision in excess policies allowing them to respond even when underlying coverage is unavailable due to insolvency, exhaustion of aggregate limits, or other specified reasons. Drop-down provisions prevent gaps in coverage. They are particularly valuable when primary insurers fail or limits are depleted. Attachment point. The dollar amount at which an excess or umbrella policy begins to provide coverage, equal to the exhaustion point of underlying insurance. The attachment point defines when the excess layer is triggered. It represents the retention or underlying limits that must be exceeded. Exhaustion point. The limit at which an underlying policy's coverage is completely used up, triggering the next layer of coverage. The exhaustion point of one layer becomes the attachment point of the layer above. It marks the transition between coverage layers. Following form. An excess policy provision that adopts the same terms, conditions, and exclusions as the underlying primary policy. Following form excess coverage provides consistency across layers and simplifies administration. The excess policy follows what the primary policy does. Standalone excess. An excess policy with its own independent terms, conditions, and exclusions rather than following the underlying policy. Standalone excess coverage may be broader or narrower than underlying coverage. It operates independently based on its own policy language. Umbrella policy. A policy providing excess liability coverage above underlying policies and also broader coverage for some claims not covered by underlying insurance. Umbrella policies both increase limits and fill gaps in coverage. They typically require maintained underlying limits as a condition. Umbrella coverage. Liability insurance that sits over underlying policies, providing both higher limits and broader protection. Umbrella coverage responds to claims exceeding underlying limits and may also cover exposures excluded from underlying policies subject to a retained limit. It is essential for comprehensive liability protection. True umbrella. An umbrella policy that provides both excess coverage over underlying policies and standalone coverage for exposures not insured underneath. True umbrellas fill gaps and increase limits. They offer the broadest form of umbrella protection. Excess-only policy. A policy that provides only additional limits above underlying coverage without filling gaps or broadening protection. Excess-only policies are pure excess coverage without the gap-filling feature of true umbrellas. They simply add capacity above other insurance. Self-insured retention, SIR, in umbrella. The amount the insured must pay on claims covered by the umbrella but not by underlying insurance before the umbrella pays. SIRS apply when the umbrella provides coverage for exposures not insured by underlying policies. They function like deductibles for gap coverage. Retained limit. Another term for self-insured retention, representing the amount the insured retains before umbrella coverage applies to claims not covered by underlying insurance. Retained limits apply to the umbrella's gap-filling coverage. Common retained limits range from $10,000 to $25,000. Maintained underlying limits. The minimum amounts of primary insurance the insured must continuously maintain to keep umbrella coverage in force. Maintained underlying limits are specified in the umbrella policy and typically include general liability, auto liability, and employer's liability. Failure to maintain them may void umbrella coverage. Required underlying insurance. The specific types and amounts of primary coverage that must be in place for an umbrella policy to be effective. Required underlying insurance is a condition of umbrella coverage. The umbrella policy schedule lists each required policy and its minimum limits. Scheduled underlying insurance. The list in an umbrella policy identifying each underlying policy, its limits, and the insurer providing it. Scheduled underlying insurance documents what primary coverage exists. Changes to underlying policies should be reported to the umbrella insurer. Aggregate limit. The maximum total amount an insurer will pay for all covered losses during a policy period, regardless of the number of occurrences. Aggregate limits cap the insurer's total exposure under the policy. Once exhausted, no coverage remains even for new, unrelated claims. General aggregate limit. The maximum amount payable for most covered claims during the policy period, excluding those subject to separate aggregates. General aggregate limits apply to the majority of liability claims. They are separate from products completed operations. Aggregates. Products completed operations aggregate. A separate aggregate limit applying specifically to bodily injury and property damage included in the products completed operations hazard. This aggregate is independent from the general aggregate and provides dedicated capacity for products and completed work claims. It does not reduce the general aggregate. Per occurrence limit. The maximum amount payable for all damages arising from a single occurrence or event, regardless of the number of claimants or claims. Per occurrence limits apply to each individual incident. Multiple occurrences in a policy period each have their own per occurrence limit available. Each occurrence limit. Another term for per occurrence limit, emphasizing that the limit applies separately to each distinct occurrence. Each occurrence limit resets for each new incident. It is distinguished from aggregate limits, which apply to all losses combined. Claims made aggregate. An aggregate limit in a claims-made policy that applies to all claims made during the policy period. Claims-made aggregates are based on when claims are reported rather than when incidents occur. They can be exhausted by claims from incidents spanning many years. Annual aggregate. An aggregate limit that applies to the policy year and resets at each renewal. Annual aggregates provide fresh capacity each policy period. They are the standard approach to aggregate limits. Per location aggregate. An aggregate limit that applies separately to each location or premises rather than to all locations combined. Per location aggregates provide dedicated limits for each site. They prevent one location's losses from exhausting coverage for other locations. Per project aggregate. An aggregate limit that applies separately to each project or job rather than to all work combined. Per project aggregates are common in contractors' policies. They ensure adequate limits for each job and prevent cross-project exhaustion. Blanket aggregate. An aggregate limit that applies to all covered property or exposures combined rather than separately to each item or location. Blanket aggregates share a single limit across multiple items. They provide flexibility but can be exhausted by losses at any covered location. Supplementary aggregate. An additional aggregate limit for specific coverages beyond the basic aggregate. Supplementary aggregates may apply to medical payments, personal injury, or other specified coverages. They provide extra capacity for particular exposures. Aggregate deductible. A deductible that applies to the total of all losses during a policy period rather than to each occurrence separately. Aggregate deductibles accumulate loss amounts until the deductible is satisfied, after which the insurer pays subsequent losses. They benefit insureds with multiple small losses. Aggregate excess. Coverage that responds only after aggregate losses for a period exceed a specified threshold. Aggregate excess provides protection against accumulation of losses rather than single large events. It is used in alternative risk programs and reinsurance. Reinstatement of aggregate. A provision allowing the aggregate limit to be restored after it has been reduced or exhausted by claims. Reinstatement may be automatic or require additional premium. It ensures continued coverage after significant losses deplete the aggregate. Automatic reinstatement. A policy feature that automatically restores aggregate limits after they are reduced by losses, typically for an additional premium. Automatic reinstatement ensures coverage continues throughout the policy period. It may be unlimited or limited to a specified number of reinstatements. Non-cumulation clause. A provision preventing multiple policy periods from being aggregated when losses occur over time or when a single occurrence spans policy periods. Non-cumulation clauses limit exposure to one policy limit regardless of how long losses continue. They prevent stacking of limits across renewals. Combined single limit. A liability limit structure providing one total amount for all damages from an occurrence, whether bodily injury, property damage, or both. Combined single limits offer maximum flexibility by allowing the full limit to apply to any combination of covered damages. They are contrasted with split limits. Split limits. A liability limit structure specifying separate amounts for different types of damages, commonly expressed as three numbers. Split limits might show $100,000 per person for bodily injury, $300,000 per occurrence for bodily injury, and $50,000 per occurrence for property damage. Each category has its own cap. Per person limit. The maximum amount payable for bodily injury to any one individual in an occurrence under split limit policies. Per person limits apply to each injured party separately. The per occurrence limit still caps total payment for all persons injured in the same event. Bodily injury limit. The maximum amount payable for bodily injury claims, which may be expressed per person, per occurrence, or as a combined single limit. Bodily injury limits cover medical costs, lost wages, pain and suffering, and other injury-related damages. They are fundamental to liability coverage. Property damage limit. The maximum amount payable for property damage claims, typically expressed per occurrence. Property damage limits cover physical damage to others' property caused by the insured. They are separate from bodily injury limits in split limit policies. Medical payments limit. The maximum amount payable under medical payments coverage, typically expressed per person. Medical payments limits are usually low amounts like $5,000 or $10,000. They provide no-fault coverage for minor injuries. Personal and advertising injury limit. The maximum amount payable for personal and advertising injury claims, typically expressed per person or per occurrence. This limit covers offenses like libel, slander, wrongful eviction, and advertising injuries. It may be part of the general aggregate or have its own aggregate. Fire legal liability limit. The maximum amount payable for fire damage to premises rented to or in the care, custody, or control of the insured. Fire legal liability limits are sublimits within liability policies. They provide exception to the usual care, custody, or control exclusion. Damage to premises. Rented to you limit. A sublimit for physical damage to premises the insured leases, typically applying to fire damage. This limit carves back some coverage from the care, custody, or control exclusion. Common limits are $50,000 to $1 million. Blanket coverage. Insurance providing a single combined limit for multiple items, locations, or types of property rather than separate limits for each. Blanket coverage offers flexibility by allowing the full limit to apply wherever loss occurs. It prevents being overinsured at one location and underinsured at another. Blanket limit. A single total amount of insurance covering multiple properties, locations, or categories without individual limits for each. Blanket limits provide the most flexibility but require careful total value determination. They are common for multi-location property programs. Blanket building coverage. A single limit covering all buildings at multiple locations under one combined amount. Blanket building coverage simplifies insurance for organizations with numerous properties. The total limit can apply to any covered building regardless of location. Blanket contents coverage. A single limit covering business personal property at all locations combined. Blanket contents coverage allows the full limit to apply to contents wherever situated. It provides maximum flexibility for property that moves between locations. Blanket building and contents. A single combined limit covering both buildings and contents at all locations. This provides the most comprehensive blanket coverage. The entire limit is available for any combination of building or contents losses at any location. Scheduled coverage. Insurance that lists specific items individually with separate amounts of insurance for each. Scheduled coverage itemizes property with designated values. It is used for high-value items requiring specific amounts of insurance. Schedule of locations. A list of all premises or sites covered under a policy, typically showing addresses and amounts of insurance at each. Schedules of locations detail where coverage applies. They must be updated as locations are added or removed. Schedule of values. A list showing the insured value of property at each location or for each item. Schedules of values document amounts of insurance and help prevent gaps or overlaps. They are essential for accurate blanket coverage. Scheduled property. Individual items of property specifically listed in a policy with designated amounts of insurance. Scheduled property receives individual attention with agreed values or specific limits. Examples include fine arts, jewelry, or specific equipment. Scheduling endorsement. A policy modification listing specific property items individually with separate coverage amounts. Scheduling endorsements add scheduled coverage to policies. They describe items and state values or limits for each. Unscheduled property. Property covered under general policy provisions without individual itemization, typically subject to sublimits. Unscheduled property receives coverage under category limits rather than specific amounts. Most business personal property is unscheduled. Specific coverage. Insurance with separate designated limits for particular items, locations, or types of property. Specific coverage allocates limits to individual exposures. It contrasts with blanket coverage, which uses combined limits. Specific limit. An amount of insurance designated for a particular item, location, or peril, rather than shared with other property. Specific limits apply only to their designated subject. They cannot be borrowed for losses to other property. Reporting form. A policy requiring the insured to periodically report current property values, with coverage and premium adjusting based on reported values. Reporting forms accommodate fluctuating property values. They are common for inventory and other variable exposures. Values reporting form. Another term for reporting form, emphasizing that actual property values must be reported regularly. Values reporting forms require monthly, quarterly, or other periodic reports. Premium is adjusted to reflect reported values. Provisional premium. An initial premium charged under reporting forms based on estimated maximum values, subject to adjustment. Provisional premiums provide coverage while actual values are determined through reports. They are reconciled against final earned premium. Full reporting clause. A provision penalizing underreporting by limiting recovery to the percentage that reported values bear to actual values. Full reporting clauses encourage accurate reporting by reducing claim payments proportionally if underreporting occurred. They protect insurers from inadequate premium. Reporting period. The interval at which values must be reported under reporting forms, such as monthly or quarterly. Reporting periods are specified in the policy. Timely reports are required to maintain full coverage. Peak season coverage. Increased coverage limits during specified times when property values are higher than normal. Peak season coverage automatically adjusts for seasonal fluctuations like holiday inventory. It prevents underinsurance during peak periods. Peak season endorsement. A policy modification providing automatic limit increases during designated peak periods. Peak season endorsements address predictable value fluctuations. They may increase limits by specified percentages or amounts during peak months. Fluctuating values. Property values that change significantly over time due to seasonal patterns, business cycles, or operational factors. Fluctuating values require flexible insurance mechanisms like reporting forms or peak season coverage. Constant limits risk underinsurance at peaks. Agreed amount clause, a provision suspending coinsurance penalties by establishing an agreed value for property at policy inception. Agreed amount clauses eliminate coinsurance calculations if coverage equals the agreed value. They provide certainty and avoid coinsurance disputes. Agreed value coverage, insurance where the insurer and insured agree on property value up front, and that amount is paid in total loss without depreciation. Agreed value coverage eliminates valuation disputes at claim time. It is common for classic cars, fine arts, and antiques. Stated amount coverage, coverage where a specific value is stated, but payment is limited to the lesser of stated amount or actual loss at time of claim. Stated amount differs from agreed value in that the stated amount is a cap, not a guaranteed payment. Actual cash value or replacement cost may be less. Pair or set clause, a provision addressing how loss is valued when one item of a matched set is damaged or destroyed. Pair or set clauses prevent paying the full value of a set when only one piece is lost. Payment is typically limited to repair, replacement of the damaged piece, or a reasonable proportion of the set's value. Automatic coverage, insurance provisions that extend coverage automatically to newly acquired property, locations, or exposures without immediate notification. Automatic coverage prevents gaps when insureds acquire new property. It typically provides limited time and amounts before reporting is required. Newly acquired property coverage, automatic insurance extension for property purchased or constructed during the policy period. Newly acquired property coverage provides immediate protection with limits and time restrictions. The insured must report new property within specified timeframes to maintain full coverage. Automatic acquisition coverage, another term for coverage that automatically extends to property or locations acquired during the policy period. Automatic acquisition coverage fills the gap between purchase and formal policy amendment. It typically lasts 30 to 90 days with specified limits. Builder's risk coverage, insurance for buildings under construction, covering the structure, materials, and equipment during the building process. Builder's risk coverage is temporary insurance ending when construction completes. It addresses unique exposures of construction projects. Installation floater, coverage for machinery, equipment, or systems while being transported to a location and installed. Installation floaters bridge the gap between shipment and permanent installation. They cover property in transit and during the installation process. Difference in conditions, DIC, coverage. A policy filling gaps in standard property coverage by ensuring perils excluded from basic policies, typically written on an all-risk basis. DIC coverage commonly includes flood, earthquake, and other catastrophic perils. It provides comprehensive backup protection. Wrap-up coverage, a comprehensive insurance program covering all parties involved in a construction project under single policies. Wrap-up coverage consolidates insurance for owners, contractors, and subcontractors. It provides consistent coverage and may reduce total costs. Owner-Controlled Insurance Program, OCIP. A wrap-up insurance program purchased and controlled by the project owner covering all construction parties. OCIPs centralize insurance management and may improve loss control. The owner controls coverage terms and claims. Contractor-Controlled Insurance Program, CCIP. A wrap-up insurance program purchased and controlled by the general contractor covering project parties. CCIPs provide similar benefits to OCIPs but are controlled by the contractor. They centralize coverage for the construction project. Concurrent causation, a situation where two or more independent causes contribute to a loss, with at least one covered and one excluded. Concurrent causation creates coverage disputes about whether the loss should be paid. Some policies contain anti-concurrent causation clauses excluding losses where any cause is excluded. Anti-concurrent causation clause. A provision stating that coverage is excluded if any contributing cause of loss is excluded, even if other causes are covered. Anti-concurrent causation clauses eliminate coverage disputes by making any excluded cause determinative. They are controversial, and their enforceability varies by jurisdiction. Efficient proximate cause doctrine. The legal principle that when multiple causes contribute to a loss, the predominant or primary cause determines coverage. The efficient proximate cause is the moving force that sets events in motion. This doctrine resolves concurrent causation in favor of the dominant cause. Proximate cause. The primary, direct, or predominant cause of a loss, which determines whether coverage applies. Proximate cause is the efficient moving force that produces the loss. It may not be the nearest cause in time, but is the most important cause legally. Contributing cause. A factor that plays a role in producing a loss, but is not the proximate or primary cause. Contributing causes may influence loss severity or occurrence, but are secondary to the proximate cause. Their covered or excluded status may affect payment under anti-concurrent causation provisions. Independent concurrent causes. Two or more causes operating simultaneously to produce a loss without one causing the other. Independent concurrent causes act together, but separately. Coverage analysis must consider whether all must be covered or if any excluded cause bars payment. Dependent concurrent causes. Causes that are related in a sequence where one cause leads to or triggers another. Dependent concurrent causes involve causal chains. Coverage depends on which cause is considered proximate and whether ensuing loss provisions apply. Ensuing loss coverage. Coverage for losses that result as a consequence of an excluded peril when the ensuing damage itself is from a covered cause. Ensuing loss provisions allow coverage for resulting damage even when the initial cause is excluded. For example, fire following earthquake might be covered as an ensuing loss. Resulting loss. Damage that follows from or is caused by a prior event, which may be covered under ensuing loss provisions. Resulting losses are consequential damages flowing from initial causes. Coverage depends on whether the result is itself covered. Chain of causation. The sequence of events linking an initial cause to ultimate damage. Chain of causation analysis determines which event in the sequence is legally responsible for the loss. It affects whether proximate cause or ensuing loss principles apply. Named perils, concurrent causation. Concurrent causation analysis under named perils policies where only specified causes are covered. Under named perils coverage, the covered cause must be a proximate cause of loss. If both a named and unnamed peril contribute, the named peril typically must be dominant for coverage. Open perils, concurrent causation. Concurrent causation analysis under open perils, all risk policies, where all causes are covered unless excluded. Under open perils coverage, the burden is on the insurer to prove an exclusion applies. If both a covered and excluded cause contribute, anti-concurrent causation clauses may determine the outcome. Collapse coverage. Insurance for buildings that fall down or cave in, which is treated specially in most property policies. Collapse coverage typically requires sudden, complete collapse and may only apply to specified causes. It is often limited or excluded and requires special endorsement for full coverage. Earth movement coverage. Insurance for damage caused by earthquakes, landslides, sinkholes, and other earth movement, typically excluded from standard policies. Earth movement coverage must usually be purchased separately as an endorsement or separate policy. It is critical in seismically active areas. Earthquake coverage. Specific insurance for damage caused by earthquakes and related earth movement. Earthquake coverage is typically excluded from standard property policies and must be added by endorsement. It usually includes percentage deductibles and may have sublimits. Flood coverage. Insurance for damage caused by flooding, which is excluded from standard property policies. Flood coverage is primarily available through the National Flood Insurance Program, NFIP, or private flood insurers. It is essential for properties in flood-prone areas. Named storm coverage. Coverage for damage from specifically identified storms, often hurricanes, in coastal areas. Named storm coverage may include special deductibles or limitations. Some policies require storms to be officially named by meteorological authorities for coverage to apply. Windstorm coverage. Insurance for damage caused by wind, which may be subject to special deductibles or sublimits in high-risk areas. Windstorm coverage is typically included in standard property policies, but coastal areas may face restrictions. Hurricane deductibles often apply separately to wind damage. Ordinance or law coverage. Insurance for increased costs resulting from enforcement of building codes when repairing or rebuilding. Ordinance or law coverage addresses costs to meet current codes, demolish undamaged portions when required, and increased construction costs. It is typically excluded and must be added by endorsement. Increased cost of construction coverage. Insurance for additional expenses to comply with building codes or laws when rebuilding. This coverage pays the difference between standard reconstruction and code-compliant construction. It is a component of ordinance or law coverage. Demolition cost coverage. Insurance for the expense of tearing down undamaged portions of a building when required by ordinance after partial damage. Demolition cost coverage applies when codes require complete removal, despite some areas being undamaged. It is part of ordinance or law coverage. Business income coverage. Insurance for lost net income and continuing expenses when business operations are interrupted by covered property damage. Business income coverage replaces profits and ongoing costs during the period of restoration. It is essential for business continuity after losses. Extra expense coverage. Insurance for additional costs incurred to continue operating after a covered loss beyond normal operating expenses. Extra expense coverage pays for costs to minimize business interruption, such as renting temporary space or expediting repairs. It helps maintain operations. Contingent business income coverage. Insurance for income loss resulting from damage to property of suppliers, customers, or other dependent businesses. Contingent business income coverage addresses indirect interruption when the insured's property is not damaged. It protects against supply chain disruptions. Period of restoration. The time from when property damage occurs until property is repaired or replaced and operations resume, which determines how long business income coverage pays. The period of restoration ends when property is restored or could have been with reasonable speed. It establishes the coverage period. Extended period of indemnity. Additional time beyond the period of restoration during which business income coverage continues while revenue returns to normal levels. Extended periods of indemnity recognize that business may not immediately recover fully even after property is restored. They typically extend coverage 30 to 360 days. Universal life insurance structure. A flexible premium permanent life insurance design separating the protection and savings components, allowing adjustable death benefits and premiums within limits. Universal life structure provides transparency by showing mortality charges, expense charges, and interest credits. It offers adaptability to changing financial circumstances. Option A, death benefit. A level death benefit structure in universal life insurance where the total amount paid remains constant, with increasing cash value reducing the net amount at risk. Option A results in lower mortality charges as cash value grows. It is the most cost-effective universal life structure. Option B, death benefit. An increasing death benefit structure in universal life insurance, where the total amount paid equals the specified amount plus accumulated cash value. Option B maintains a constant net amount at risk and higher mortality charges. Total death benefits increase with cash value accumulation. No lapse guarantee. A universal life insurance feature guaranteeing the policy will remain in force even if cash value is insufficient, provided specified minimum premiums are paid. No lapse guarantees eliminate lapse risk from poor policy performance. They provide security similar to traditional whole life. Secondary guarantee. Another term for no lapse guarantee, emphasizing it as an additional guarantee beyond cash value adequacy. Secondary guarantees protect against lapse due to underperforming interest or high costs. They require premium minimums to remain effective. Shadow account, a separate accounting mechanism tracking whether no-lapse guarantee requirements are met independently from actual cash value. Shadow accounts credit premiums and debit specified costs according to guarantee formulas. They determine if secondary guarantees remain in effect. Policy lapse, the termination of life insurance coverage when cash value is insufficient to cover monthly charges and no premiums are paid. Policy lapse occurs when universal life policies can no longer sustain themselves. No-lapse guarantees prevent lapse if premium requirements are met. Persistency bonus, an enhancement to cash value or death benefit provided after a policy remains in force for a specified period, rewarding long-term ownership. Persistency bonuses incentivize policy retention. They may be paid as additional cash value or death benefit increases. Terminal illness rider, a policy provision allowing access to a portion of the death benefit when the insured is diagnosed with a terminal condition and limited life expectancy. Terminal illness riders typically pay 25 to 100% of the death benefit when life expectancy is 12 to 24 months or less. They provide funds for medical care and end-of-life expenses. Viatical settlement, the sale of a life insurance policy by a terminally ill person to a third party for a lump sum less than the death benefit. Viatical settlements provide immediate funds to insureds with life-threatening conditions. The buyer becomes beneficiary and continues premium payments. Life settlement, the sale of a life insurance policy by a senior, typically age 65 plus, to a third party for more than cash surrender value but less than the death benefit. Life settlements provide liquidity from unwanted or unaffordable policies. The secondary market purchases policies and collects death benefits. Death benefit acceleration, the payment of life insurance benefits before death when the insured meets qualifying conditions like terminal illness, chronic illness, or critical illness. Death benefit acceleration provides living benefits from death. Benefit proceeds, amounts received reduce benefits paid at death. Chronic illness acceleration, early payment of death benefits when the insured is chronically ill and unable to perform activities of daily living without substantial assistance. Chronic illness acceleration typically requires inability to perform 2 or more ADLS or cognitive impairment. Benefits help pay for long-term care. Per diem benefit, a long-term care or chronic illness benefit that pays a fixed daily amount regardless of actual expenses incurred. Per diem benefits provide flexibility in how funds are used. They don't require expense receipts. Reimbursement benefit, a long-term care benefit that pays actual expenses incurred up to daily or monthly maximums requiring documentation. Reimbursement benefits cover only actual costs. They maximize benefit duration but require proof of expenses. Indemnity benefit, a long-term care benefit that pays the full benefit amount when qualified regardless of actual expenses, essentially a per diem paid monthly. Indemnity benefits provide maximum flexibility without expense tracking. They pay predetermined amounts upon qualification. Cash indemnity, a long-term care payment approach that provides benefits directly to the insured without requiring expense documentation. Cash indemnity gives recipients freedom to spend benefits as needed. It simplifies administration. Shared care benefit, a long-term care insurance feature allowing spouses or partners to access each other's benefits if one exhausts their individual pool. Shared care provides extended benefit periods by pooling coverage. It addresses uncertainty about which spouse will need care. Survivorship life insurance, life insurance covering 2 lives, usually spouses, that pays the death benefit only after both insureds have died. Survivorship life insurance, also called second to die, is used primarily for estate planning. It costs less than insuring 2 lives separately. Second to die life insurance, another term for survivorship life insurance, emphasizing that benefits are paid upon the second death. Second-to-die policies are ideal for estate tax planning since estate taxes are typically due after the second spouse dies. They provide liquidity for estate settlement. First-to-die life insurance. Life insurance covering two lives that pays the death benefit upon the first death between the two insureds. First-to-die policies, also called joint life, provide income protection when either insured dies. They terminate after the first death. Joint life insurance. Another term for first-to-die life insurance covering two lives with benefits paid at the first death. Joint life policies cost less than two separate policies but cover only one death. They suit situations where one death creates the financial need. Split dollar life insurance. An arrangement where two parties, typically employer and employee, share life insurance costs, death benefits, and cash values according to an agreement. Split dollar plans help key employees afford coverage and may provide employer-owned insurance. They have complex tax implications. Endorsement method. A split dollar arrangement where the employer owns the policy, pays premiums, and endorses a portion of the death benefit to the employee's beneficiaries. The endorsement method gives the employer control and cash value access. The employee receives endorsed death benefit protection. Collateral assignment method. A split dollar arrangement where the employee owns the policy and assigns a portion of death benefits to the employer as collateral for premium advances. The collateral assignment method gives the employee ultimate ownership. The employer receives repayment of premiums from death benefits. Executive bonus plan. An arrangement where an employer pays premiums on a life insurance policy owned by an employee as taxable compensation. Executive bonus plans, Section 162 plans, are simple to implement and give employees ownership. Premiums are tax-deductible to the employer as compensation. Section 162 Plan. The tax code provision under which executive bonus plans operate, treating premium payments as compensation. Section 162 plans allow employers to provide life insurance benefits while deducting costs. Employees receive policies they own and control. Deferred compensation plan. An arrangement where an employer promises to pay benefits to an employee in the future, often funded with life insurance. Deferred compensation plans supplement retirement income for highly compensated employees. They're subject to creditor claims and forfeiture risks. Supplemental Executive Retirement Plan, SERP, a non-qualified deferred compensation arrangement providing additional retirement benefits to key executives beyond qualified plan limits. SERPs are often informally funded with corporate-owned life insurance. They attract and retain top talent. Corporate-owned life insurance, COLI. Life insurance owned by a corporation on the lives of employees or others with insurable interest. COLI serves various business purposes, including funding, deferred compensation, key person protection, or general assets. Tax benefits and regulations govern COLI usage. Bank-owned life insurance, BOLI. Life insurance owned by banks on the lives of employees, used as a tax-advantaged asset and funding mechanism for employee benefits. BOLI helps banks offset employee benefit costs through tax-free death benefits and cash value growth. It's a significant bank asset class. Key person insurance. Life insurance owned by a business on the life of a key employee whose death would cause significant financial loss. Key person insurance compensates businesses for loss of valuable employees' knowledge, relationships, or skills. Proceeds help recruit replacements and cover lost revenue. Buy-sell agreement funding. Life insurance used to fund business succession agreements obligating surviving owners to purchase a deceased owner's interest. Buy-sell funding ensures liquidity for business succession without business disruption. Death benefits provide purchase funds immediately. Cross-purchase agreement. A buy-sell arrangement where each business owner maintains life insurance on other owners and uses proceeds to purchase the deceased owner's interest. Cross-purchase agreements result in step-up in basis for surviving owners. They become complex with many owners. Entity purchase agreement. A buy-sell arrangement where the business owns life insurance on each owner and uses proceeds to redeem the deceased owner's interest. Entity purchase agreements, also called stock redemption, simplify administration with one policy per owner. The business purchases the interest. One-way buy-sell. A buy-sell agreement where only one party has the obligation and right to purchase, common in parent-child or key employee transitions. One-way buy-sells facilitate planned business transitions. They're used when succession to a specific person is intended. Wait-and-see buy-sell. A hybrid buy-sell arrangement allowing survivors to decide whether the business or individual owners will purchase the deceased owner's interest. Wait-and-see agreements, also called option agreements, provide maximum flexibility. The decision is made after death considering circumstances. Estate planning life insurance. Life insurance designed to provide liquidity for estate taxes, settlement costs, and wealth transfer. Estate planning insurance ensures estates can pay obligations without forced asset sales. It's particularly important for illiquid estates. Irrevocable Life Insurance Trust, ILIT. A trust that owns life insurance policies, removing death benefits from the insured's taxable estate. ILITs are irrevocable to achieve estate tax benefits. They require careful planning and administration. Crummy power. The right of trust beneficiaries to withdraw contributions for a limited time, making gifts to irrevocable trusts eligible for annual gift tax exclusions. Crummy powers are named after a court case and essential for ILITs. Beneficiaries receive withdrawal notices but typically don't exercise rights. 3-year rule. A tax provision including life insurance death benefits in the insured's estate if the policy was transferred within 3 years of death. The 3-year rule prevents deathbed transfers to avoid estate taxes. It applies to all incidents of ownership. Incidents of ownership. Rights in a life insurance policy that cause inclusion in the owner's taxable estate, including the right to change beneficiaries, borrow, or surrender. Incidents of ownership determine estate tax treatment. Eliminating them removes policies from estates. Generation skipping transfer tax, GSTT. A federal tax on transfers to beneficiaries more than one generation below the transferor, applicable to life insurance trusts benefiting grandchildren. GSTT prevents avoiding estate taxes by skipping generations. Exemptions and rates parallel estate tax rules. Dynasty trust. A long-term trust designed to benefit multiple generations while minimizing transfer taxes, often funded with life insurance. Dynasty trusts can last for extended periods, sometimes perpetually, in certain states. They preserve wealth across generations. Premium financing. Borrowing money to pay life insurance premiums, typically for large policies where cash value growth and death benefits justify loan costs. Premium financing is used in estate planning for wealthy individuals. Loans are secured by policy values. Life insurance loan. Third-party financing for life insurance premiums secured by the policy's cash value and death benefit. Life insurance loans allow wealthy individuals to acquire large policies without cash outlay. Complex structures manage interest costs and collateral. Loan regime. The system of charges and credits applied to borrowed amounts in a universal life policy, affecting how policy loans impact performance. Loan regimes may use fixed rates, variable rates, or wash loans, where loan interest equals credited interest. They significantly impact policy results. Policy loan provision. The policy feature specifying terms under which policyholders can borrow against cash value, including interest rates, repayment terms, and consequences. Policy loan provisions vary by product and can significantly affect policy performance. Loans reduce death benefits if not repaid. Direct recognition. A policy loan approach where cash value used as loan collateral earns a different, typically lower interest rate than unloaned cash value. Direct recognition reduces returns on borrowed funds. It affects the cost of taking loans. Non-direct recognition. A policy loan approach where all cash value earns the same interest rate regardless of whether amounts are borrowed. Non-direct recognition treats loaned and unloaned cash value equally. It may result in favorable arbitrage opportunities. Wash loan. A policy loan feature where the interest rate charged on loans equals the interest rate credited to loaned amounts, resulting in no net cost. Wash loans effectively provide free access to cash value. They're valuable features in certain policies. Overloan protection. A policy feature preventing lapse when loans and interest exceed cash value, often requiring additional premiums or death benefit reductions. Overloan protection ensures policies don't unexpectedly terminate due to excessive loans. It manages risks of policy loan strategies. Modified Endowment Contract (MEC) testing. The 7-pay test applied to life insurance policies to determine if premium payments exceed limits, triggering MEC status and tax consequences. MEC testing occurs at issue and when changes increase benefits. Failed tests result in less favorable tax treatment. 7-pay premium. The annual level premium amount that would pay up a life insurance policy in 7 years, used as the MEC testing threshold. Premiums exceeding the 7-pay premium in any year trigger MEC status. The calculation considers age, death benefit, and guarantees. Tax-free death benefit. Life insurance death benefits paid income tax-free to beneficiaries under Internal Revenue Code, Section 101A. Tax-free death benefits are a fundamental advantage of life insurance. They ensure full proceeds reach beneficiaries. Tax-deferred cash value growth. The accumulation of cash value in permanent life insurance without current income taxation on growth. Tax-deferred growth allows compounding without tax drag. Taxes are deferred until withdrawals exceed basis. Basis in life insurance. The total premiums paid into a life insurance policy, representing the policy owner's investment that can be withdrawn tax-free. Basis determines taxable amounts when surrendering policies or taking withdrawals. Only gains above basis are taxable. FIFO withdrawal treatment. The first-in, first-out tax rule treating life insurance withdrawals as recovery of basis, premiums, before gains, avoiding taxation until basis is exceeded. FIFO treatment applies to non-MEC policies. It allows tax-free access to premiums paid. LIFO distribution treatment. The last-in, first-out tax rule treating distributions from MECs as taxable gains first, before recovery of basis. LIFO treatment applies to modified endowment contracts. It results in less favorable tax treatment than FIFO. 10% penalty tax. An additional tax on distributions from modified endowment contracts before age 59 and a half, similar to early retirement plan penalties. The 10% penalty applies to taxable amounts withdrawn early. Exceptions exist for disability, annuitization, and other circumstances. Annuity contract. A contract with an insurance company providing periodic payments in exchange for a lump sum or series of premiums. Annuities provide guaranteed income, often for retirement. They come in many varieties with different features. Immediate annuity. An annuity contract purchased with a lump sum that begins paying income within 1 year of purchase. Immediate annuities convert assets into guaranteed lifetime income streams. Payment amounts depend on age, sex, and payout options. Deferred annuity. An annuity contract with an accumulation phase before income payments begin, allowing tax-deferred growth. Deferred annuities serve as long-term savings vehicles. Withdrawals are typically subject to surrender charges early on. Fixed annuity. An annuity providing guaranteed interest rates during accumulation and fixed payment amounts during distribution. Fixed annuities offer predictability and principal protection. They don't participate in market growth. Variable annuity. An annuity where accumulation values and payments vary based on the performance of underlying investment sub-accounts. Variable annuities offer growth potential but expose owners to market risk. They include investment options similar to mutual funds. Indexed annuity. An annuity crediting interest based on the performance of a market index with floors preventing losses and caps limiting gains. Indexed annuities, also called fixed-indexed annuities, offer market participation with downside protection. Returns fall between fixed and variable annuities. Annuitization. Converting an annuity's accumulated value into a stream of periodic income payments that cannot be reversed. Annuitization provides guaranteed lifetime income but eliminates access to principal. It's an irrevocable election. Payout option. The choice of how annuity income will be structured, such as life only, joint life, period certain, or combinations. Payout options balance income amount, survivor protection, and guaranteed periods. More guarantees mean lower payments. Life-only annuity. An annuity payout option providing the highest payment by guaranteeing income only for the annuitant's lifetime with no beneficiary rights. Life-only annuities maximize income but provide no death benefits. Payments stop at death regardless of amounts received. Life with period certain. An annuity payout guaranteeing income for life with a minimum payment period to beneficiaries if the annuitant dies early. Life with period certain balances income maximization with death benefit protection. Common certain periods are 10 or 20 years. Joint and survivor annuity. An annuity continuing payments for 2 lives, continuing at the same or reduced level after the first death. Joint and survivor annuities protect spouses but reduce initial payments. Survivor percentages are commonly 100%, 75%, 66%, or 50%. Annuity certain. An annuity paying income for a specified period regardless of whether the annuitant lives or dies. Annuity certain options guarantee payments for the selected term. They're not life contingent. Guaranteed minimum withdrawal benefit. A variable annuity rider guaranteeing the ability to withdraw a percentage of premiums annually regardless of account performance. GMWBs protect against market downturns while allowing continued withdrawals. They provide lifetime income protection. Guaranteed lifetime withdrawal. Benefit. A variable annuity rider guaranteeing lifetime income withdrawals at a specified rate regardless of account value or performance. GLWBs ensure income won't be outlived even if accounts deplete. They provide longevity protection with upside potential. Guaranteed minimum income benefit. A variable annuity rider guaranteeing a minimum annuitization value for calculating future income regardless of actual account performance. GMIBs protect future income purchasing power. They typically require waiting periods before use. Guaranteed minimum accumulation benefit. A variable annuity rider guaranteeing that account value will at least equal premiums paid, or a growth rate, after a specified period. GMABs protect against market losses over time. They provide minimum value guarantees at future dates. Living benefit rider. Any annuity or life insurance rider providing benefits while the owner/insured is alive, such as guaranteed withdrawals or accelerated death benefits. Living benefit riders add valuable protections beyond traditional death benefits. They address lifetime needs and risks. Insurance to value. The relationship between the amount of insurance carried and the actual value of the insured property. Proper insurance to value ensures adequate coverage and avoids coinsurance penalties. Underinsurance creates significant out-of-pocket exposure at the time of loss. Appraisal process. A dispute resolution method specified in insurance policies for resolving disagreements about the amount of loss without addressing coverage. Each party selects an appraiser, and if they cannot agree, they select an umpire. The appraisal process is binding on loss valuation, but not coverage issues. Adjoining property. Property located immediately next to or sharing a common boundary with the insured property. Adjoining property considerations affect exposure analysis, particularly for fire spread and other external hazards. Damage from or to adjoining property raises coverage questions. Betterment and obsolescence. The improvement or depreciation in property value resulting from repairs or replacements. Betterment occurs when repairs improve property beyond pre-loss condition. Obsolescence refers to decreased value from outdated features or technology. Business income waiting period. The time period, typically 72 hours, that must elapse after property damage before business income coverage begins paying benefits. Waiting periods eliminate claims for brief interruptions. They function like time deductibles. Civil authority coverage. Coverage for business income loss when civil authorities prohibit access to the insured premises due to damage to nearby property. Civil authority coverage addresses losses from government-ordered closures. Access must be prohibited by order of civil authority due to covered perils. Dependent properties. Locations not owned by the insured but on which the insured's business depends, such as key suppliers, major customers, or sole manufacturers. Damage to dependent properties can interrupt the insured's business even without direct property damage. Special coverage addresses these exposures. Named insured and spouse. A policy provision automatically extending coverage to the named insured's spouse without specifically naming them. This simplifies coverage for married couples in personal insurance. The spouse receives the same coverage as the named insured. Pair or set loss valuation. The method of determining payment when one item of a matched set is damaged, typically limited to repairing the item, replacing it, or paying a reasonable proportion of the set's total value. Pair or set provisions prevent paying full set value for partial losses. They balance fair compensation with preventing windfall gains. Reasonable repairs. Temporary or emergency repairs made to protect property from further damage after a loss, typically covered in addition to policy limits. Reasonable repairs include boarding up windows, tarping roofs, or securing property. They are a policy duty and separately covered expense. Spoilage. Loss of property due to change in temperature, humidity, or contamination, particularly for refrigerated goods or climate-sensitive materials. Spoilage coverage requires specific endorsement in most property policies. It addresses both mechanical failure and power outages. Sue and labor clause. A provision requiring the insured to take reasonable steps to protect property from further damage after a loss and providing coverage for such expenses. Sue and labor obligations are duties after loss. Expenses incurred are typically covered in addition to policy limits. Theft definition. The policy-specific meaning of theft, which may include burglary, robbery, larceny, or all forms of stealing. Theft definitions vary by policy and determine what stealing-related losses are covered. Some policies distinguish between types of theft. Burglary. Forcible entry into premises with visible signs of forced entry for the purpose of stealing property. Burglary requires evidence of breaking and entering. It is more narrowly defined than general theft. Robbery. The taking of property from a person by force, threat of force, or violence. Robbery involves confrontation with a person. It is distinct from burglary, which involves premises. Mysterious disappearance. The unexplained loss or vanishing of property without evidence of a specific covered peril. Mysterious disappearance is typically excluded from coverage or sublimited. It lacks proof of a covered cause of loss. Vacancy provision. A policy condition suspending or reducing coverage when buildings are unoccupied for specified periods, typically 60 days. Vacancy provisions address increased risks of vandalism, freezing, and undetected damage. Occupied and vacant are defined specifically. Unoccupied. A building condition where furnishings remain but people are temporarily absent. Unoccupied buildings retain most coverage. This differs from vacant buildings which have greater restrictions. Actual cash value formula. The calculation method for determining ACV, typically replacement cost minus depreciation, though some jurisdictions use broad evidence approaches. ACV formulas vary by jurisdiction and policy. They determine the valuation basis for loss settlement. Broad evidence rule, an approach to determining actual cash value, considering all relevant evidence including market value, replacement cost less depreciation, and other factors. The broad evidence rule is used in some jurisdictions rather than strict formulas. It allows consideration of multiple valuation methods. Market value approach, a valuation method based on what property would sell for in the open market. Market value approach is one method of determining actual cash value. It reflects willing buyer/willing seller transactions. Rent loss, loss of rental income when insured property cannot be rented due to damage from covered perils. Rent loss coverage, also called rental value, pays the lost rent the insured would have collected. It requires covered physical damage to the premises. Fair rental value, coverage for lost rental income when the insured's residence cannot be used due to covered damage, minus expenses that don't continue. Fair rental value applies when insureds would have rented premises or could have rented them. It compensates for lost rental opportunity. Ordinance or law, increased cost. Coverage for additional construction expenses required to meet current building codes when repairing or rebuilding. Increased cost coverage addresses the difference between standard replacement and code-compliant construction. It is a component of ordinance or law coverage. Ordinance or law, demolition. Coverage for the expense of tearing down undamaged portions of buildings when ordinances require complete demolition after partial damage. Demolition coverage pays to remove portions of buildings that weren't damaged by the covered peril. It addresses legal requirements for complete removal. Ordinance or law, loss to undamaged portion. Coverage for the value of building portions not damaged by the covered peril, but which must be demolished due to ordinance requirements. This coverage addresses the economic loss of viable building parts that must be removed. It compensates for losing undamaged property value. Joint loss agreement, a contract among insurers establishing how losses will be shared when multiple policies respond. Joint loss agreements facilitate coordination among insurers. They prevent disputes and streamline claim settlement. Loss payee clause variations. Different forms of loss payee provisions with varying levels of protection, from simple loss payee to lender's loss payable to standard mortgagee clause. Loss payee clause variations provide different rights to secured parties. The standard mortgagee clause provides the strongest protection. Building code enforcement, the requirement to comply with current construction codes when repairing or rebuilding damaged structures. Building code enforcement can significantly increase repair costs. Standard policies exclude these increased costs without special coverage. Innocent party protection, coverage provisions protecting co-insureds or secured parties from exclusions applicable to other insureds who caused losses. Innocent party protection prevents one insured's misconduct from eliminating coverage for others. It is particularly important in mortgagee clauses. Aggregate extension endorsement, a modification increasing or restoring aggregate limits after losses reduce available coverage. Aggregate extensions provide additional capacity within policy periods. They may be automatic or available for additional premium. ISO, Insurance Services Office, an organization providing statistical, actuarial, underwriting, and claims information and analytics to property/casualty insurers. ISO develops standardized policy forms, rating information, and loss data. It is a major industry advisory organization. Standard form language, uniform policy wording developed by organizations like ISO and used by multiple insurers. Standard form language provides consistency and benefits from regulatory approval and court interpretation. Many insurers use ISO forms with modifications. Manuscript language, custom policy wording drafted for specific situations rather than using standard forms. Manuscript language allows tailored coverage for unique risks. It requires careful review and may lack extensive court interpretation. Policy period clarification, provisions specifying exactly when coverage begins and ends, including the precise times and time zones. Policy period clarification prevents gaps or overlaps in coverage. It establishes the temporal boundaries of coverage. Newly acquired locations, automatic coverage. Extension of coverage to locations acquired during the policy period without immediate reporting, typically for limited amounts and time. Newly acquired location coverage prevents gaps, while acquisitions are reported and added. Reporting requirements apply for continued full coverage. Debris removal. Coverage for the cost of removing debris of damaged property following a covered loss. Debris removal is typically included in property policies with separate limits. It may also be covered as an additional amount beyond policy limits. Pollutant cleanup and removal. Coverage for the cost of extracting pollutants from land or water at the insured location. Pollutant cleanup coverage is typically limited and applies only to sudden and accidental releases. It is distinct from environmental liability coverage. Fire department service charge. Coverage for charges imposed by fire departments for responding to covered property losses. Fire department service charge coverage is typically limited to small amounts like $1,000 to $10,000. It addresses fees some departments impose. Expediting expenses. Additional costs to speed up repair or replacement of damaged property beyond normal construction costs. Expediting expense coverage pays for overtime, express shipping, or other acceleration costs. It helps reduce business interruption losses. Electronic data restoration. Coverage for the cost of restoring or recreating electronic data lost or damaged by covered perils. Electronic data restoration addresses the expense of reconstructing digital information. Standard property coverage typically excludes or severely limits this coverage. Valuable papers and records. Cost to research. Coverage for expenses to investigate, replace, or restore valuable papers when originals are destroyed. This goes beyond the physical value of paper to the cost of recreating content. It requires special coverage or endorsement. Accounts receivable, collection expenses. Coverage for reasonable expenses to reestablish accounts receivable records and collect outstanding amounts after records are damaged. Collection expense coverage helps recover money owed when records are lost. It supplements lost receivables coverage. Functional building valuation. An approach that pays to rebuild with materials serving the same function but not necessarily identical to originals, reducing costs. Functional building valuation is practical when exact replacement is impractical or unavailable. It focuses on utility rather than identical restoration. Extended business income. Coverage for continuing business income losses after property is repaired, but before operations return to normal levels. Extended business income coverage, also called extended period of indemnity, recognizes business doesn't immediately return to prior levels. Common extensions are 30 to 360 days. Extra expense. Coverage for additional expenses beyond normal operating costs incurred to continue operations after a covered loss. Extra expense coverage pays costs to minimize business interruption, like renting temporary space or expediting repairs. It helps maintain business continuity. Errors and omissions coverage. Professional liability insurance covering damages from mistakes, negligence, or failure to perform professional services. Errors and omissions, E&O coverage, is essential for professionals providing advice or services. It covers both actual errors and alleged errors. Claims made retroactive date impact. The effect of the retroactive date in limiting coverage to claims arising from incidents occurring on or after that date. Retroactive dates prevent coverage for known prior acts and liabilities. Moving to a new claims-made policy may create gaps if the new retroactive date is later. Prior acts coverage extension. The extension of a claims-made policy's retroactive date to cover incidents occurring before the current policy inception. Prior acts coverage, also called nose coverage, is essential when switching insurers or policies. It prevents gaps in claims-made coverage. Self-insured retention versus deductible. The distinction between SIRs, where the insurer has no obligation for retained amounts, and deductibles, where the insurer may pay then seek reimbursement. SIRS place more responsibility on insureds for handling retained claims. Deductibles involve the insurer from the first dollar.